Yesterday was awesome. I think we had, somewhere between 8 and 10 panels and discussions all in, plenty of different topics. I think we covered raising capital with security tokens, secondary trading and liquidity issues, solutions more so coming tomorrow. We covered different blockchains and how they could all work together. We covered certain industry players. We covered JP Morgan's Onyx division and what they're doing, riding off a huge announcement with Barclays and BlackRock just 2 days ago, pretty much yesterday. And today, we're diving in a bit more institutional focus and seeing really what the big banks are doing, what are the big asset managers doing, what does that plumbing look like, because really everything's coming down to that. First off, to kick day 2 off, really excited to have the whole team here and to have everyone joining us shortly. Wanted to thank our sponsors in no particular order, but really, really thankful for these firms in the space: Block Time Financial, Red Swan, Fusion IQ, Oasis Pro, Invenium, Fairchild Acquisitions, and Invest Ready. Folks, also remember, thank you to our media partners, Benzinga and Securities.io, who is live streaming the event as well. I know most of you are tuning into YouTube right now. Anyone who wants to leave comments or ask questions throughout all of these discussions, please register at summit.stm.co. That's where we could actually interact with you guys and kind of take it from there. So let's look at today, we're going to look at the current state of the market more than anything. Like I said, we're going to hear from some of the largest heads of innovation, heads of digital assets, and strategic partnership players at a lot of these big banks and big firms that are issuing either security tokens or working with tokenized products. They're kind of building that plumbing and anywhere in between. Yesterday was interesting. So we thought, we were looking at the secondary trading side, for example. We have a couple different solutions like securitized markets. We had Castle Placement with their CP-Go ATS, and even kind of an interesting entrant back from May of this year, OTC Markets Group, who, OTC handles about 10,000 OTC securities to date. The fact that they're now in the game with digital asset securities is tremendous. And I think that's something that really went over the heads of a lot of the industry, both, the existing tokenization industry and the legacy capital markets. I mean, a lot of firms are already working with OTC Markets Group and their OTC Link ATS. What really caught my eye there, I know a lot of our team will probably agree, the fact that it's so difficult these days to really aggregate good trading volume and to really, if I'm an issuer, if I'm an investor, to get feasible trades and order book depth, it's tough with just one marketplace or venue. The fact that OTC Link ATS is an inter-dealer quotation system, pretty much instead of going from investor to investor, we're going from broker to broker to other broker. We're acting kind of, as an order aggregator and facilitator rather than a standalone, venue itself. I think that's tremendous. And I think yesterday some eyes were starting to light up even on the panel itself, and some other viewers and industry players. We got some really good feedback. So, hopefully that panel actually sets the stage for 2024. We start seeing a bit more integration on that front. I think that'll help the industry tremendously. Similarly, even looking at it from a primary capital raise standpoint, it's very tough to raise capital in this macro picture right now, let alone with a brand new technology coming to the forefront. And it was interesting and pretty reassuring to hear from some of the brokers, some of the investment bankers that really boots on the ground right now, actually raising capital. We had Dalmore Group, we had Castle Placement, we had INX, we had DigiShares, who is raising capital themselves, actually. All unique, different perspectives, some more so on the crypto side, how are we getting retail in, how are we integrating wallets and really making that formidable with that plumbing, to the more traditional side, looking at just how big the space is, how brokers can actually complement each other and raise somewhere from 10 to 20, 30, $50 million, from a retail raise, but also from lower level of creds and onwards. I thought it was very interesting. Kind of my takeaway is that the future, not even to say future, it's happening now, is a multi-tiered capital raise system where maybe you'll have a traditional layer for institutions and private banking clients, but you'll also have some tokenized raise kind of in the mid-ground with, high net worth individuals who don't yet meet certain criteria, maybe on the qualified side. You have some retail also, maybe they're separated. Eventually they could kind of, if the instruments are fungible, they'll mix, they'll trade together, and they'll be active. But I think to really unlock the future of this, it shouldn't be just like a one pile of one investment class. Rather, it will be different tranches. And I've heard that from a few different industry partners. I think, and we kind of saw that come out to play yesterday just in discussion. So a lot of eyes on that. I think the big theme, same topic on that capital raise side, is enabling, company managers, corporates, issuers to really monetize their own user base. And that's something that's talked about a lot. And Eitan Butler had it perfectly. So this is more like e-commerce than a traditional capital raise, right? You want to make it simple. You want to make it like your users come into your website, boom, they click a button. Obviously, all the compliance, the KYC, the verifications have to be there. But the way investing is changing, it's becoming a bit more e-commerce, like you're shopping on Amazon or on a Shopify storefront. So pretty cool to think about that. And you're going to retail plus everything I just said before 2 minutes ago, complementing all that with traditional channels. I think that's really where issuers and corporates are going to find their ideal blend of user base of capital. Similarly, even, looking at, so I kind of think of that as interoperability on the capital raise side. We got all these partners, they got to work together. It's more collaborative than competitive. We heard that verbatim from Richard Luftig at Castle Placement, for example. And I think, when people in this industry hear interoperability, we're usually thinking of the technology. We're thinking of the blockchain. So going from Ethereum to Avalanche to Algorand to Polygon. So things of that nature rather. And yesterday, Jason Barraza at our team hosted an amazing panel with a handful of these blockchain groups, Hyperledger, we had Avalanche, we had Coinbase's Base, we had Polygon, we had Stellar. So all in all, it was a kind of a recurring theme. And we even had industry players kind of chiming in saying the future, all these players will have to work together to really unlock all this liquidity. You can't have, $8 billion fragmented across, 5 to 10 different blockchains with no way to interact. Eventually, to really unlock the floodgates, things will definitely move and converge. We're already seeing that even from the private blockchain side over to the public blockchain side. Such a common debate in the space is, are private blockchains necessary? A lot of people in the crypto side will tout private blockchains just as kind of another database, another, Excel type layer that's not really changing anything. No, I see a lot of efficiencies on the banking side, and that's something we're going to dive into during my keynote later today. But also things to keep in mind, you have R3 Corda, who's been pioneering stuff on the enterprise blockchain solution side, and now they're EVM compatible. So working right along with Ethereum-based projects. All extremely promising developments, I would say, and this all came out in 2023. So I think this is really the year of this whole tokenization game. The plumbing is getting there, the project types and use cases are getting there. Google tokenization, you'll find some keywords. All the major banks that you probably work with anyway, if you're in the capital markets, all doing this type of stuff. So things are getting extremely, extremely interesting. I know we have a handful of panels coming up. We have the global adoption and regulatory arbitrage coming up in just 5 minutes, in fact. So I don't want to eat up too much time. I want to make sure that panel is coming on and getting all ready. And we're really excited to bring this to, to everybody listening. I think we have somewhere between, we have a ton of viewers, let's just say, and some really good quality names. I think a lot of people are getting value so far. Look to continue doing that today. Talk to everybody in just 5 minutes. And we have a good purpose for kind of calling it that. First of all, everybody, I'm Peter Gaffney, head of research at Secure Token Advisors. Great seeing everyone on the panel today here and everyone in the audience. STA is an advisory consulting firm, so I lead a lot of the research initiatives and working hand in hand with the asset managers and the infrastructure providers in the legacy capital market space to pretty much implement tokenization and ideally start working with industry partners, much like yourselves all here on the panel. I figured a quick round of intros and then we could kind of hop in. And I think the main goal and, what we hear from the audience and from our clients is really, how are different industry players taking advantage, not taking advantage, but how are they making use of their own, geographic location, the jurisdictions, how are they working with regulators, and overall, what's the kind of traction, the feedback they're seeing, any particular use cases standing out, and then, the eventual collaboration between all the parties here. So, we'll just kind of go down the line. Oyi, do you mind starting it off with an intro on yourself and ADDX?
Sure. Hi, Peter. Hi, everyone. Great to be with you all this evening. My name is Oyi. I'm the CEO of ADDX. ADDX is a alternative investment platform out here in Singapore. Of course, it's built on a blockchain platform. We're actually a fully regulated, licensed by MAS, as a, both as a capital markets dealing in securities, a recognized market operator for the exchange, as well as the custody side. So we've been operating now for about 4+ years, though the company is about 5 years old, and we tokenize all sorts of funds and credit and pre-IPO shares and structured products. Glad to be with you all this evening.
Fantastic. Thanks for the background, Oyi. Jacobo, why don't you talk to us? How are you doing and what are you doing at Deloitte?
Yeah, great. Hi, everyone. Nice to be here with all of you. I'm Jacobo from Madrid, Spain here. I'm from the Deloitte firm in Spain. We, as you know, we're a leading global professional services firm, so I think we're the different ones here. And our efforts regarding tokenization are offering end-to-end professional services. So from helping companies to define their strategy in how to approach these security tokens ecosystems. So this is setting their vision, where to play, how to win, etc., to providing light on regulation, to helping in issuances, helping with the tech part of it, leverage on our technology or partnering up with some tech providers and so on. So we focus on professional services and tokenization.
Fantastic. Thanks so much, Jacobo. Lorenzo, tell us about yourself and about Block Invest.
Hello, everyone. It's great to be here. Lorenzo here from Italy, Milan. I'm the founder of Block Invest. We are an infrastructure provider for financial institutions to adopt the tokenization for real, I would say, of real world assets, particularly with focus on corporate bonds, on fund shares, and on something that I don't know why no one won't touch, which is non-performing exposure. So the bad loans. So these are the three main underlying in which we are focused, and we are working with several financial institutions, but also with regulators in Italy with this brand new law to, assist our client in adopt the tokenization and use this new transactional layer for this underlying. And just for Jacobo, we are working in several pre-production projects with Deloitte in Italy. So for sure, you're part of the game, even if you're a consultancy company in a really complex project. The consultancy part is really important, because when you need to disrupt the financial market, you need to connect the dots in different services especially when we talk about the banks. So really glad to find you here.
Fantastic, and great to hear about the collab already. And finally, Graham, why don't you tell us a little about yourself and about Archax?
Sure. Hey, Peter. Yeah, thanks for having me. Great to be here with you and the panelists. So I'm Graham Rodford, co-founder and CEO of Archax. Spent about 20 years in hedge funds, most recently as Chief Operating Officer and Chief Compliance Officer of one here in London. Got interested in crypto in about 2013. Started to realize around 2017-ish that this technology was going to change every instrument out there, not just cryptocurrencies, but every single instrument that we trade. Kind of figured if that would happen, institutions would come, they'd need credible partners, decided to be regulated. So set up Archax in 2018, went to the regulator in 2019. In 2020, became the UK's first regulated digital securities exchange, custodian and broker, and got our crypto asset registration as well. So spent 5 years building, I think, whilst watching the other spaces take off. Obviously digital securities has been a bit of a slower pace, but I think now we're at a point where we're starting to see a lot of traction in everything we're doing. So looking forward to talking through it all.
Fantastic. Thanks, Graham. And just so to clarify, just to give everyone a baseline. So Oyi, ADDX is primary and secondary capabilities, correct? Okay.
Yeah, that's right.
Okay. Lorenzo, Block Invest is primary? Like primary issuance?
Correct. No, we are in the primary phase. We can make also secondary market, but not yet like ADDX can do that for regulatory constraint, at least in South Europe. So
okay, perfect. And Graham, Archax is both primary engine and secondary MTF or maybe in the works?
Yeah, no, exactly, with an underlying custodian as well.
Right. Very, very powerful stack. Awesome. And Jacobo, I'm sure you're seeing a blend of all these through your own clients and kind of different partners. But listen, it seems like everyone more or less has a different regulator. There's some overlap, I'm sure. It's a global marketplace. It's tough to stay in just one location as a whole. And I'm sure, we have MAS, we have FCA, we have ESMA, I think on the call that someone in way, shape or form is answering to and has to stay in line with. I think the first kind of, easy question and trying to focus a bit more on the business case rather than the raw compliance guidelines. Is there anything notable, and we'll just kind of go through each panelist, anything notable that your specific regulator is working with you guys on or kind of helping mold? And that could be, a certain product type, a certain asset class, or just certain, sandbox capabilities or movements along those lines. Anything stand out in a very positive way that you're able to share?
Yeah, I'll go first. I think MAS is sort of a little bit beyond asset classes. I think they see tokenization applying across the full securities and fund spectrum, and whether it's to consumers or at least to accredited investors in Singapore, or it's B2B, they're pushing that very hard via this project called Project Guardian, right? Yep. And Guardian is meant to be, it's a steering column of about, I think, 13 or 14 financial institutions, which have tokenization initiatives. So it's actually, most of that belong to most of that sit with the global banks and the regional banks. We're one of probably the only fintech startup that's within this committee. But really, the idea is now no longer just about the asset class. It's actually about interoperability among financial institutions and across fintechs like ourselves. So it's a great initiative. What they're doing right now is not only are they pushing very aggressively on the technology and how do we connect as different, because everybody's built on different chains, but also they're starting to apply a bit more thought as to what might be the regulatory evolution for some of these areas that we need to think about.
Yeah, very interesting. And Project Guardian, yeah, I mean, JPM's involved, the HSBC is involved, DBS Bank, a laundry list, let's say, for a few years now. It's some extremely impressive and frankly, just industry beneficial initiatives happening out of Singapore, and a lot of that to thank is due to MAS. So good background, Oyi, thanks for that. Lorenzo, curious with you and the Italian regulator and some of your work.
I mean, for sure, Singapore is more advanced with respect to Italy, but I mean, with respect to the past in which also Block Invest was involved in tokenization, mainly in Luxembourg or in UK. Oh, yeah. But now we are working seriously in Italy with the regulator because especially the Bank of Italy, launched this call for proposal initiative dedicated to the blockchain. And I would say that 3/4 of all the biggest financial institutions are involved. So in different use cases, we are, launching this kind of project with the direct support of the Bank of Italy. So the support on how integrate the tokenization with existing AML and KYC, or integrate with the new infrastructure layer that is going to substitute the centralized repositories. So we are going in very little detail on what this means tokenize an asset class. And there are different tables depending on the asset class. So we are involved mainly, as I was saying, in the bonds and the NPLs. There are other tables on the secondary market structure. So how to translate a classical MTF into a tokenization world, or also table dedicated for digital identity, which is something that is also really, really important, at least for what we think. So it's really interesting what the regulator is building here. And they are doing that because there is a huge market interest with respect to the past. all the main financial institutions are investing time and resources in this kind of project. So,
interesting. The digital identity piece we'll have to come back to that because that's definitely a hot topic. It flew under my own radar for quite a while until it was coming up in every other call. And it's really something that has to be solved for, right? Even whether you're even looking at things in a single country or region, just on a single platform, but obviously more widely across different jurisdictions. And as things become more global in nature, it'll be extremely interesting to see how that kind of plays out. So I think we'll revisit that topic a bit. But Graham, even you know, over in the UK, and you're doing some interesting work, I know, with Aberdeen, looking at FTSE listed equities and even government bonds, you know, curious what that looks like with the FCA and everything over there.
Yeah, no, I guess, you know, the history of the FCA, I think like a lot of regulators about 5 years ago or so, I think regulators were kind of spooked and a lot of them rushed in some regulations, which probably could have been better, but actually probably overall started us heading in the right direction of putting appropriate regulations in place. So I'd say we always iterate in the right direction, and whilst I think they can always be improved, there's no doubt the trend is into a kind of more stable regulated environment. So you know, we've had various crypto consultations across a variety of topics recently. They've adjusted the financial promotions rules. Before that it was around money laundering, and now there's a wider consultation piece which looks like crypto assets or unregulated crypto assets will move more into the regulated sphere. So I think all that's heading in the right direction. And then we've also, much like Europe, started to put in place a financial market infrastructure sandbox. And that will be interesting. What that's starting to do is saying, can an MTF, which is an exchange in the UK, act like a central securities depository, or potentially the other way around? You know, can you have a record of ownership uniquely existing on blockchain rather than the CSD? So that's something we're watching pretty closely. I'd say overall, though, like Singapore actually, and a few other jurisdictions, the UK is looking to be a global digital hub. And that really only works if you have a really stable regulatory environment that can attract people. So I think we've got larger problems in the UK around bank accounts and other infrastructure issues for crypto asset related companies at the moment. Actually, I think the regulation is heading in the right direction.
Cool. No, interesting to hear, and kind of that history of how, you know, what was kind of pushed out just in recent times and how it's evolved. Good point about the CSD too. I mean, that's something we hear in the States, looking at the transfer agent side and what the SEC deems a source of truth and what it doesn't. And right now, at least on the private fund side, or rather on the public security side, a lot of that is being, you know, routed through transfer agents. So I think it'll definitely take some time to kind of unhinge that. Although, of course, a lot of even blockchain foundations are looking to solve for that themselves directly. So definitely some stuff to keep an eye on. And Jacobo, in Spain, you know, more recently, I know Securitize is working with REITs in Spain. That was something pretty notable within the country itself. Very curious what your clients are looking at, what Deloitte specifically is looking at. I'm sure you guys work quite closely with the regulators. Like, what is their take? How are they looking to compete with the rest of Europe, if at all, or if it's more of a collaborative type thing?
Yeah, actually, it's important to note what Graham was saying right now, because here in the European Union, we have a common regulatory framework. First step, that is the DLT pilot regime, to set these multi-trading facilities and waiting on the CSV part of the value chain also. So again, we have this common regulatory framework, so it's not that much of competing against the rest of the European Union, but to actually collaborating, because we part from a common regulatory framework. It's a pilot, actually, so it's a bit limited on issuances and allowed trading. So actually, in general, the goal is to foster experimentation and to show the benefits of the DLT use cases while preserving investor protection, market integrity, and so on. So we have this common framework. And then in Spain, or some European Union countries have transposed this pilot regime to local regulatory frameworks. So I'd like to put into value too the effort from the Spanish regulator that went farther than expected in pilot regime, this pilot I was talking about, because it provides like greater legal certainty to tokenization by seeking to equal security tokens to their traditional financial instruments. So they are equaling it in terms of warranties, charges, encumbrances, lies, and so on. So they express this in the proper regulation. So of course, the regulator is still learning together with the projects we have also in our national sandbox, and that we will go to the pilot regime in the European Union with all these evolving matters. So they are pushing towards exploring tokenization and just putting into value this effort from also Spanish regulator.
Okay, so in Spain, would you say it's everything is still in like sandbox mode, more or less?
Yes, it's like the first step. Like we're seeing some sandbox projects, some pilot projects. We're seeing some biggest institutions going to tokenize bonds, tokenize debt, and so on. But these are experiments. We're seeing some serious or real life projects, but they are all starting. We're seeing associations or joint ventures between financial institutions and, for example, illiquid asset owners, as for example, real estate developers that are let's say, partnering up to build these issuances and trading platforms here in Spain. We're seeing some native startups or crypto-native startups trying to build these platforms and also to aim for being secondary market trading platforms. So we're seeing kind of everything, but of course, everything is in its initial steps right now.
Okay. Let me add something on what Jacobo said, because I think it's really important to underline that probably it will take much more time for Europe, but the common regulatory framework that now it's a pilot, but it's going to be a common legislation which will put Europe, I mean, in a very interesting position also with respect to US, let me say, for what's happening in this month. So it will take a bit longer. For example, in Italy, we were, I mean, at this stage till May the 10th. So the local regulation was applied by May, so it's relatively new. I know that in Spain, we are also close. But for what we analyzed, also together with Deloitte, actually, is that in Spain, in Italy, in France as well, the national regulation are not so different. So this will give us an interesting position in how to build a real collaborative environment. So we are also planning with other startups to use the same standard to build together a sort of secondary market. So it's something that Euronext probably is not able to do with centralized authorities, but we can use the blockchain to do that. So I think it's a huge occasion for European companies in the next years.
Okay, interesting. And that's a great point, Lorenzo. And you mentioned just thinking about the different standards to create that. I'm actually curious if are there strong guidelines or preferences to certain blockchains or certain blockchain mechanics, within your regions, let's say. I'm aware of certain foundations, certain agencies are limiting things to either private chains or kind of extremely permissioned to start. And I know that's a common thought process from certain banks and institutions, just as they kind of dip their toes in. But I'm very curious what the regulators themselves are saying. Is it cool to use public chains? Is that kind of something that is slowing them down? You all have established services up and running, and I'm very curious to hear what that is kind of like, if it's feasible, if you're hitting roadblocks on the tech side, any color you're able to share with the industry.
Yeah, this is a great point, because it was a nightmare at the beginning. Because at the beginning, the private blockchain was the suggested one. But I mean, with time and patience, we explained to the regulators, but also to the financial institution that, what a private blockchain can do, probably a database can do better. So the real innovation is done by a public ledger. For sure, you need to explain why you're going to use that blockchain and what standard you're going to apply to respect the the obligation that the national regulation will impose. But now I would say that now they understand that the real innovation is the use of the public blockchain. For sure, you need to show them that it's sustainable. So and sustainability not only for the environmental impact, so you need to say that it's, I don't know, a layer 2, so you are carbon neutral or carbon positive, but also that is scalable. And we think that using a private network is not scalable because it's something that we are already doing in finance. So
yeah, we're on the same page as Lorenzo there. Like it's, I think, across I think all of us probably on the panel, we're chatting to a wide range of clients and potential clients, and you can see why banks want to work in private and in permissioned walled gardens effectively, because they're a bit uncomfortable. But I just, whilst I'm happy to work with them, I can't see how that fulfills what I think this technology can really do. And I completely agree with Lorenzo. You need, like, public blockchain is where this is at, and it can be permissioned. You can create subnets. You can do a lot of things with it. But having the whole world of developers building interesting and innovative developments on a chain is so much more powerful. If you look at all of the things available on Ethereum, I mean, it's quite remarkable, all of the side chains that have come off of it, wallet infrastructure, borrowing, lending, dexes. It's going to take a long while for the banks to catch up on that. And all the while, I think they're going to start to be disrupted by new people moving into the space. I actually have never had a conversation with the regulator, other than them asking if we had a preference. I've never had a conversation really where they expressed a view of a preference of one over the other. I think what they really care about is that appropriate AML KYC source of funds is done on all of our clients and everything we do. The fact that you can see transactions is a bit more of a problem for the types of clients that we occasionally speak to. And potentially sometimes the way that these chains raise their money can be an issue for some people. But the fact is, whatever financial rails you're talking about the world over, there's institutions that use it, there's non-institutions that use it, and a public blockchain can be used for good, for bad. Shouldn't necessarily rule out anyone. So we support both, but I'm very much in the camp of public is really where this thing takes off in the future.
Yeah, I agree with Graham. I think the end goal is public. But I think regulators sort of need sort of different developments of sandboxes, as it were, right? And right now, if for the piece of scalability that at least in Singapore the regulators are very focused on, is around sort of making that interoperability work. And at the moment, it's sort of like everybody has this little chain, right? So you kind of got to figure out how to connect that. But more importantly, for at least in the Singapore context, because it's not just about securities. Actually, they're thinking much broader and how the full financial services settlement system is actually going to sit on fiat tokens, basically, and the securities. So I think they do have to solve it, whether public blockchain or you figure out some really, really neat way for interoperability to happen across TradFi and DeFi. I think it'll take a while, but you can see that where they want to head in the end is probably the most efficient and the most elegant solution is the public chain. But I think there's still a lot of elements: KYC, AML, all of that, right? Securities laws. How do you bridge that?
Interesting.
I think to add a bit more on that, I think regulators and everyone is concerned on privacy, scalability issues, but mainly on ensuring all KYC, AML processes, as Raham was saying. So it may be easier to control all these on private blockchains, at least at the beginning, because we're starting to see some token standards that actually do all this. But also, to the point on the settlement, as regulators see the settlement and ensuring the delivery versus payment of these tokenized securities against probably a wholesale CBDC. So it's difficult maybe to ensure all these DBP against a wholesale CBDC on public environments. So that's, I think, one of the points. It's also important to consider permission blockchains at this moment, because if not, you could even do this with the tokenized deposits or stable coins, but from what we're seeing, I think regulators are more on, or they are starting to explore all this DVP against wholesale CBDC. So that's a point in which I think permission blockchains will stay, at least for the moment.
Yeah. All great points, all four of you. And even now I'm curious thinking about it, you know, OE, I think you mentioned, and Ram, you mentioned the KYC AML side. Aside from regulators, let's just talk individually from a business side. What are, you know, you're all working with institutions, with big players. How are they kind of viewing you? What are the hurdles that, you know, even onboarding them? I'm sure you're getting past the comfort level, but really onboarding and meeting their criteria internally. Is there any color, anything you could shine on that? It'll be interesting to see how it differs just around the world, but more so in platform to platform. Like, how is Hamilton Lane and Partners Group working with addicts? How is Bank of Italy, Credit Agricole, how are they looking at Block Invest? Aberdeen with RHX, a few examples. You know, what are those conversations like? And are they helping kind of set precedent for future, I don't want to say competitors of theirs, but for future companies of similar profile?
Yeah, I'll start first. I mean, I think we make it a little bit too easy for them. They don't really see the technical part of that, right? I mean, we literally sort of, you know, act as if we're one of their distributors, and you know, we mechanize the whole back end of that. I mean, that's what they like. They see the digit, and interestingly, it's not just about the tokenization. Actually, for them, it's about the digitization of the distribution process for them, and how that suddenly, you know, you're redrawing how an investor should be operating on a digital platform, and the subscription process, and how it actually could, you know, be very, very efficient, how distributions could be extremely efficient, how you can keep a ledger, and you're actually, you understand who is your investor base at any one point in time. So it's not, they're not particularly wedded into the tech and how that works, and certainly that I think should evolve over time. I think in Singapore, at least, the thinking around market infrastructure is increasing. And so how does then the whole funds world, both at a mutual fund level and a alternative fund level, become increasingly digitized and tokenized? So that's a bit more the thematic here. And I think if we can figure out the full value chain, because now we capture a very small part of the value chain, right? The supply chain. Really, when you are able to tokenize fully the fund, and all institutions, including high net worth, all on the chain, that's, I think, when the technology will really fully express its efficiencies and its capabilities. But we're very far from that.
Yeah, we're in the on the AML KYC side. I mean, we're fully regulated. There's nothing kind of special about what we collect. How we collect it is probably a bit more advanced than some of the traditional institutions, I guess. But kind of to Wuyi's point, and a bit about digital securities, especially if you kind of think about what crypto did, how freely transferable it is, the types of markets that open up. That's kind of the dream for asset managers, really. They'd like to be able to tokenize the fund, have it flow between us, ADEX, Block Invest, Securitize, wherever around the world seamlessly. And, you know, abiding by local regulations is one thing, but also solving this global AML KYC challenge is another, whether it's, you know, having some sort of global whitelist, using something like an ID in a wallet, like Securitize ID, I have the one actually, you know, something whereby everybody can contribute, and having some globally acceptable standard would definitely help these. And whenever you've seen something in DeFi, you know, like I won't name anyone, but let's say DEXs that have tried to launch walled garden versions, they just get no traction at all, because most people don't want to give up their AML KYC to a DEX. You have limited participants. You don't have anything in the liquidity pool, so they just develop no traction. And I think it's all linked, actually, the kind of the distribution, the uptake, the AML KYC. Kind of, if we can solve that at a scalable size, not just on our local level but internationally, then it will start becoming really interesting.
I have to say that for us it's a bit different, because as a software provider, in some case, with the distributor is easier. With the API that where they can manage and the distributor bank can just plug and play. But with the arranger and with the asset manager, that there is also sort of integration that is required. And I can share with you that I remember at a conference call with more than 40 people just from the compliance of the bank, just for the bonds, just the team bonds. I don't even imagine the number of compliance for, in general. So it's the difficult part is not the tech. I totally agree, but it's how you connect the dots. And I think that since I agree with you that if we try to put all the data related to the financial transaction on the blockchain, probably every blockchain will collapse. So the best way we found is actually link what is really worth to put on the blockchain, so something that is meaningful for the transactional part with the legacy system. For sure, it takes a bit more time in terms of development, in terms of integration. But for example, probably we come back on it because it takes a while to explain. For the KYC AML part, most of at least for the big financial institution, they want to give up their own process, their own screening. So what we are doing is providing them like a summary of this process. Everyone will keep its own process, and we are listing 5 to 10 attributes that will flow into a token. So it's like a soul-bound token that basically, at least for Europe, will define the MiFID profile. So the attributes like risk exposure, the category of underlying for which you can be accredited, like for example, you can invest in a real estate, but not in non-performing loans because it's more dangerous, or a derivative token. So put on a token, on a soul-bound token, what can be useful to understand whether or not you can make this investment. But all the rest of the data, all the compliance will remain, at least for now, on the legacy system, and we are finding the best way to integrate our stack, the Web3 stack, with their Web2 infrastructure.
That's a very interesting point, Lorenzo, you bring up. It's something we talk about fairly often, about what to put on chain versus what to leave off chain, maybe API call in. And we've heard stories, I'm sure we're all familiar, even with companies who've issued, if there's something, let's say you find some error that was baked on chain, you got to burn all the old tokens, reissue. It's a cost. It's definitely an expense. Or should something change in the future, you definitely want some ability, and it kind of goes against the crypto thesis, but you may need some ability to modify certain either even financial benchmarks or even personal info. So thinking about the digital identity challenge, so even let's say if I'm not an accredited investor, if that's baked on chain that Peter is retail, let's say 2 years from now things change, what do? How do I update my profile? Is that going to cost me to update things on chain? Is there a way to API call where we're off chain verifying and then it's just kind of getting verified? So these are things to think about kind of moving forward as the whole digital identity, especially from a global standpoint, begins to change and kind of formulate a bit more. And even like with all the progress and zero knowledge proofs and stuff on the digital asset side, that's a very strong argument for putting more things on chain about your own identity, and it kind of remaining more or less closed off from certain parties. But still, I think it's like a whole rabbit hole that even I still have to go down to talk more about. That's kind of more the surface level thinking. But curious if there's any other thoughts on that. I was actually pretty interested in, and something I didn't even think about asking before, Graham, until you mentioned it. You mentioned different DEXs with like compliance. It's something we've heard from our advisory side and certain, industry players who are looking at this. Do you guys see any near-term integrations with decentralized finance and tokenized securities, or is that still way off? I mean, considering where the regulators are and the licensing needed and how to really delegate, if you're running an MTF, how do I know only permissioned MTF investors are swaying down into a Uniswap type? Curious if you guys are looking at that or if it's just way off.
Yeah, no, I mean, we're looking. I think quite the shape of it, I don't know, but I think the future is a DEX of some kind. If you think about the journey that we've gone on as well, so talking about the Aberdeen money market fund that we've tokenized recently, and also we've tokenized some UK shares, UK gilts, a few other bits and pieces as well. Kind of what's the point in all of that? Well, the point isn't just the kind of fractionalization, liquidity, and all these points people talk about that I don't think is the main point. The thing is upgrading the technology of all of those instruments. And when you think about everything happens that in the decentralized space, it's the same. So pretty much everything that exists in DeFi can be applied to digital security. So the way that we're looking at it is we've created permissions tokens. You can pretty much create replica copies of most of what exists in DeFi today, apply our tokens to it, and there you have it, a fairly regulated venue. Now, the difficulty comes around the detail, actually, when you start talking about transaction reporting, market surveillance, market abuse rules, these kind of things, kill switches that you have to have on regulated venues. It's all the kind of, they're called RTSs in the UK, regulated technical standards. They're the harder things to apply. Kind of conceiving of it and getting the base level stuff in, that's pretty easy. It's when you get into the detail of making sure you do right by the regulator at every point, that's where these things take a little bit longer. But I'm pretty sure you'll start seeing them first half to third quarter of next year. I think a lot of people are looking at this now.
Interesting.
If you see what's happening, I mean, at least in the Singapore context, the focus is still the regulated entity is going to be sort of held by the neck, right? Like sort of, I mean, the regulators want to be able to hold someone responsible. So as a collective, even if we do sort of, well, at least combine or connect with any of the DeFis, I'm not sure. But I think the regulators will still want to make sure that the regulated guys are responsible for what they're doing. So I think it would stay relatively mainstream, is my sense.
Yeah, sorry, or to be clear, I couldn't agree more. The concept of a regulated DAO, that's difficult and that's a long way off. I'm talking about, it's very clear Archax runs this DEX. It's centralized and we kind of control who can participate or not. But yeah, I couldn't agree more. I think I see it already in some of the things we talk to the regulator about. When it's a DAO, they don't like that there's no one to go after. So I think we can use the technology, but there's going to be a centralized element to this for a bit of a while.
Interesting point. And Graham, even to that, if let's say Archax is running the DEX, do you think your clients would be open to providing liquidity, or would it be a pure, we got to bring additional investors onboarded and have them act as liquidity providers? I'm curious.
No, I think you look at the way it's working, like, well, in the UK, to be a market maker of a regulated security, you need to be regulated as a special type of broker. I think that still exists. The question is whether they stream liquidity in or they provide it via an AMM or a liquidity pool. Like, I think they're the interesting questions, but I think they will exist, and I think actually there'll be more people participating because a lot of these things can be kind of naturally algorithmic. So I don't really have the same liquidity concerns that a lot of people do around security tokens. The way I think about the whole space is a lot of these things have tons of liquidity in the traditional market. They're all moving onto this technology, and that liquidity will come with them. Something that was illiquid before is probably going to be fairly illiquid on a new technology. I think you start moving tokenized Vodafone, Tesla, Apple into a DEX where people can operate, there'll be liquidity there for sure.
Awesome, interesting points. And listen, we have a few minutes left. Very curious, and thanks so much for all the insights. I know we went off, not just looking solely at regulation, but it's always interesting to hear what business cases are happening kind of behind the scenes. I would love to hear, and kind of for the audience, even for each other, what is the, anything that you're able to share, of course, what's like the near term, the midterm roadmaps look like for each of your, your firms, your services. I think there's a lot of people watching, and it'd be nice for them to know if they have to get in contact with you, if they have projects that kind of align with your vision, with your areas, feel free to kind of take the stage.
Okay, I will start first. I mean, we have worked together with a lot of other projects here. Always because our idea is to build together an ecosystem to co-design the euro on chain, because the cash lag, particularly for some business case, the bonds and the open-ended funds, so the fund shares are, I mean, it's fundamental to adopt and exploit full potential on the blockchain. It will take probably a lot of time to have a proper CBDC, but we need to work on something in the middle, because in euro we don't have a stable coin. And I would say that even with the stable coin, for many use cases will not be enough, because you need central bank digital money to invest, or when you collect the money from the market, especially in open-ended funds. So it's something that will involve also Block Invest and other parts of the Italian ecosystem together with the regulator. This is the first goal. And after that, we're going to launch probably the first native tokenized fund in Italy. So it will be really hard, but it's something that we're working on. So finger crossed.
Awesome. That's a good point about the digital euro too, in waiting. I was going to say if there's any good settlement mechanisms or anything, but we'll be covering money markets, treasuries, deposits later in today. Actually, we do have a quick question I want to sneak in before we wrap up from Alex. You know, we like to use the phrase "no bad bonds, just bad prices." How do you guys think about liquidity and return? Meaning, you know, providing T-bill liquidity at 5% might not be interesting. There is a cost of liquidity. However, providing real asset liquidity at 10% might be interesting. Have you guys looked at these markets, I guess, in the real estate space?
I mean, I'm sure over the last 5 years, we've spoken to a lot of people tokenizing a lot of things. And there's a bit of a negative selection bias, I think, to a lot of people that have come to talk about tokens, in that they didn't necessarily raise money previously, and then they come to a token, so it still can be difficult to raise money. And whenever we've looked at these projects, trying to distribute them in scale and then bring them potentially to a secondary market, which is seemingly what a lot of these illiquid assets want, is actually a bit of a challenge. There is no doubt there are people out there that are interested in a 10% return in real estate asset. I mean, Aberdeen has funds full of them, but is there an advantage right now of them having a token? No, I think there is, but I've been living and breathing this for 5 years. But when you speak to most real estate investors, it's a bit of a struggle to distribute to anyone else that's not already buying it. So I think there's a big opportunity there. There's a lot of these residential products that struggle to distribute. That's what I see.
Sure.
Yeah, I agree with Graham. I mean, tokenization doesn't mean that the product suddenly becomes appealing. At the end of the day, I think the investment profile still needs to sit with the right type of investors, right? And it could be very local. So there's a localization bias for investing as well. Japanese investors love Japanese real estate. Could you ever sell a, Singapore residential? Probably very difficult. So the projects still need to match the demand, and tokenization may facilitate that. It may open up a slightly different sort of angle and a slightly different capital pool, but I don't think it completely, you can't sort of repackage an ugly asset. But I guess a 10% yielding asset is still relatively interesting, but it does need, the marketing still needs to be very targeted, is my point.
Absolutely.
But you touched a great point, because it's a common misconception that you take a bad asset and if you tokenize it, probably it's easier to sell. It's not. Especially when you talk about real estate, the underlying should be valuable also without an internet connection. Okay, so forget about blockchain and tokenization. Instead, this kind of solution, as far as I think, are more valuable for very complex and structured processes rather than invest in a residential property, because I will never invest probably in a residential property in Japan, because I know the market. in Milan or probably Madrid, but it's something that I would say also the crowdfunding can do. Instead of tokenization is really powerful for complex structure that you can decentralize, you can optimize. So this is where I think the tokenization will find its place in the next 5 years. But now, I'm one of the guys that tokenize basically everything. We tokenize a lot of real estate assets, but in long term, I think that it will be dedicated for other things.
Sure. I take this stage here to put the self-promoting stuff, and of course you need to tokenize good stuff. So linking with the previous question on the roadmap, we as a consulting firm help on these issuances, all this financial study that is behind it, and structure and where to list it and so on. So just to to link it with the previous one, and we as a consulting firm partner up with these tech providers that we have here. And we work with these financial institutions to work on this European pilot regime and regulators and central banks. Actually, with everything we've been discussing today in this panel, all that was previously discussed as KYC, MAL policies, and so on. So I think this issuance part is really important because you cannot tokenize everything, even though you can, from a technological point of view. We think it doesn't make sense sometimes. So it's important to tokenize assets that are healthy, at least, let's say it like that.
Awesome. Fantastic responses and insight. Listen, this is all we have for this panel. Really appreciate everyone's time. Thanks so much, Oyi, Jacobo, Graham, Lorenzo. Looking forward to chatting with you each more in the future. And hope the audience enjoyed. Thank you all so much for your insights.
Thank you, Peter.
Meredith Sapp from WisdomTree. They are doing some amazing, incredible things. If you haven't already heard, you're in for a treat, I believe, because this is truly what I believe is the future of tokenization. But before we get into it, of course, I want to give a chance. Meredith, please introduce yourself. Tell us about yourself and how you maybe got into tokenization.
Sure, I'm happy to, and thank you so much for having me this morning. Really excited to talk a little bit about what I'm doing, but then also more broadly what WisdomTree is doing. So I'm Meredith Sapp. I'm Director of Business Development here at WisdomTree. Prior to WisdomTree, I spent over a decade in traditional finance, like a lot of other folks you'll hear from over the next 2 days, and was at Morgan Stanley and Merrill Lynch. And actually at both of those firms, I came into contact with blockchain and also with crypto specifically. So at my time at Merrill Lynch, I was on a corporate strategy team looking at efficiencies across both wealth management and commercial banking, and found blockchain technology back in 2017 and said this must be a better way to do internal processing than faxing, because there was truly people faxing still, and there probably still are today. Unfortunately, at the time the bank wasn't ready to really embrace it, but I know now they are. And then at Morgan Stanley, I led business development for their outsourced chief investment office and was working with a lot of family offices and would go in with some really cool club deals for real estate investments and different alternatives. And they would stop at the end of the presentation and go, but what about Bitcoin? And I realized that this was definitely where those two were converging, and I found WisdomTree where we're working on crypto as an asset class, and then also blockchain technology and how that can create efficiencies in capital markets. And it was just a match made in heaven for my two experiences to come here about 1.5 years ago.
Well, that's fantastic. I think it's funny that you say that there might even still be people trying to fax today when we're here trying to kill the spreadsheet. So
exactly.
Very, very interesting. Well, let's dive into that a little bit. I want you to just shine some light on WisdomTree just as a company. Innovation runs in your DNA. For anyone in the audience that just for some reason isn't too familiar, I'd love for you to really give the highlight of why this isn't just a random decision or moving with the times. This is something that I think you're really taking a bold step and saying this is the future,
We absolutely are. And you're right. WisdomTree, we're a $95 billion asset manager globally, historically an ETF issuer. We're headquartered out of New York, but we also have a large EU and LATAM presence. And to your point, I think a lot of people ask us, so what does an ETF issuer have to do with blockchain? And it's actually our heritage in the ETF business that makes us uniquely positioned to succeed in the blockchain ecosystem. And you're right, we have a history of innovative products, but also we forge new paths. It's really in our DNA. We're a firm of firsts. So from gold ETPs to managed futures to crypto ETPs to now our digital funds, we embrace innovation in the spirit of making products easier for customers to access the markets. But we're also rooted in governance and risk management. And I think that's a differentiator for us. So all of our products, whether in traditional wrappers or in digital wrappers, are governed by the same high standards of rules and regulations, including our role as a fiduciary, but also with required financial disclosures and all the regulations that go around that. And I'll get more into this in a bit, but there's also a lot of similarities structurally, operationally, and from a regulatory perspective that are similar across these digital and traditional wrappers. And we see this as an advantage to already understanding and effectively navigating these key elements to securely manage these products. So we know what we're doing. This isn't our first rodeo. And so as we start to think about our strategy, it's bringing traditional assets into mainstream finance. So that's crypto as an asset class. I know not the discussion for today, but indexes, ETPs, potentially the US spot, Bitcoin ETF if it gets approved. But then it's also bringing mainstream assets into the digital world. So both through WisdomTree Prime, but then also soon into the broader digital ecosystem. So it's these things called digital funds that I've mentioned now a few times, which are pretty much tokenized real world assets like treasuries and equities. It's also physical gold, so think of commodities. And both of these, in terms of expertise and experience, really is our focus in utility around these assets. So it's not just investing, but it's the ability to spend and send them as well. So the bigger question we're trying to ask ourselves is, so your brokerage account is now on your phone, but why not be able to do more with what you have today? And that's really the problem that we're trying to solve with WisdomTree Prime and utilizing blockchain technology to do that.
Yeah, I love how you put that. This isn't, crypto assets for sure are a new opportunity, but this isn't just about access, which it is absolutely, but the idea that you can actually, what I like to call is financial services embedded into these things is really something we're going to dive deep into. I think it was your CEO that said, ETFs are today, but tokenization is tomorrow. So what would you say, what was that light bulb moment for the firm? When would you say that this really became important to WisdomTree?
Oh, absolutely. And that was our founder and CEO, John O. Steinberg. About 4 years ago, he posed the question to our team, what can do to ETFs what ETFs did to mutual funds? So again, as that ETF issuer, what's next? What's the next big innovation in financial wrappers? And we set out to answer that question. And we found blockchain technology. And we see it as ETFs disrupted the mutual fund industry because of their accessibility. All an investor needed was a brokerage account. Now we see a similar opportunity with digital funds and blockchain-enabled finance, where all an investor needs is a smartphone. So we see bringing traditional assets into the digital ecosystem allows for blockchain technology to be used in a more mainstream capacity. Again, this whole theme of democratization of finance and positioning WisdomTree Prime in the app is really the center of investors' financial life over time. And we know this, and this is what this whole summit is about. We're on the precipice of a major shift in financial services, and we see blockchain-enabled finance transforming that. And we are being able to be a nimble blockchain-based company gives us that backbone to evolve quickly and to meet future use cases as well.
That is a beautiful quote. I gotta say, we gotta record it. That's very aptly put. And maybe we can even get into a little bit more detail before we've been teasing this app. We're gonna get to it, folks. Don't worry. But let's talk a little bit more, just exactly some of those efficiencies, some of those financial services, if you will, that you're embedding and what you can experience being an app user as opposed to just a brokerage account investor.
Yeah, sure. And I'd say I'll talk about our approach to digital assets, and then I'll dig more into what those benefits look like. But over these years, we've developed our digital assets business as an extension of our existing business. And I think this is important because there's a lot of apps out there, and there's a lot of different companies that are starting to put out tokenized assets. But for us, it's three core principles that we were built on that continue into blockchain technology today that I think are really critical. It's regulation and compliance, which I've already touched on. It's smart innovation. So building innovative products that align with our core ethos and leverage existing operational efficiencies when possible. And then it's distribution. So expanding on and into a new customer base, knowing that what we do today, we're experts in. So from a regulation perspective, we started on this journey with regulators focused on really going through the front door. And that's a big focus of ours. So our digital funds, they're 40 Act funds for those that are familiar with the term. They're effective with the SEC. And we took many years working with, and more importantly, educating regulators on what blockchain technology is, what it means, and what are the benefits to the end consumer. And we also wanted these funds to be available to retail investors with low minimums. Again, really our belief is in the democratization of finance through blockchain. And we think retail investors should have access to all the same technology and products that institutional investors do. So it's a really key point of this. In terms of smart innovation, we've tokenized real world assets. I've already talked about bonds, equities. They're all public markets now to start. We started with the public markets. Again, it's more of our expertise and our heritage. And these digital funds are open-ended, registered 40 Act products like a traditional mutual fund that then they have tokenized shares on the blockchain. And we have 9 of them effective today. They're all available on WisdomTree Prime. Again, we'll do some screen sharing there later to show you what that looks like. And really how it works is that shareholder ownership is duly recorded and reconciled. So meaning that there's an off-chain book entry as well as a blockchain entry, and they're both maintained by our transferred agent. So again, this is really an evolution that we're going through as we start to develop into this technology and bring capital markets on chain. I will say just, this is a question I always get, so this might come up, but it's just specific to note when we talk about real world asset tokenization, none of this includes crypto. So we are talking about real world assets. Like when I say treasuries, I mean actually US treasuries. So again, we're able to leverage a lot of the same operational processes and efficiencies that we already have today in our traditional business. So it's a core competency of ours that is then now we're bringing that into the blockchain technology space. And then another really strong suit for us is commodities. This might be something that's well known if anyone from Europe's on, but we have a tokenized gold product that's actually physically backed gold. That's also part of the app, and it's not a fund, it's physical. So as one of the largest gold ETP providers, we leverage the same stringent operations and risk management to provide a physically backed gold in a token form. Why I bring this up too is what's really cool about this is that we have near instant settlement that you'll see in the app, and it's able to be physically redeemed, and it's a much more cost-effective option. So again, we see gold, because it is a commodity, as really the gold star and the North Star that we're starting to move towards, that hopefully the rest of our securities products will follow suit operationally as we continue to build out the ecosystem.
That I have no doubt about, and I wholeheartedly agree with your definition of RWAs. I think it's very important the industry can get on the same page, if you will, about that. And folks, if you're listening, I just want to highlight this again because I think WisdomTree gets the title of the most active on-chain 1940 Act fund issuer with over 9 available on the app, but I think there's already 10 that are effective, if I'm correct. Which just, again, I want to clarify, everybody, despite all the issues with, of course, trying to do a spot ETF and other things in the crypto space, this is moving forward. WisdomTree has already successfully done a lot of the work talking to regulators, getting them comfortable with having a public fund essentially available on chain now through an app, which providing that near instant settlement, providing that easy access, as you mentioned earlier, to a variety of different products. I mean, that is such a game changer that I don't know how much longer we can tease the crowd for showing off the app. But if you wanted to cover something before we get to the slides, I'm happy to talk about that too.
Yeah, sure. Why don't we just benefits? I said that I would cover on, and I realized I didn't now. So let me talk about the benefits really quick, and then let's get into it. But I think that these are 3 key areas that probably most of the folks on the phone know, but transparency, liquidity, standardization. I think we're all chasing these, and these are really critical. But from a transparency perspective, immutable, audible, we know this about blockchain. But I think from a financial standpoint, financial services standpoint, ensuring the integrity and the finality of the data. So think of transaction history, ownership records, asset performance. These are where these can be a complete game changer. Liquidity, faster settlement times, like I just mentioned with gold, almost instant settlement. Atomic settlement is something that's possible through smart contracts that self-execute. That's going to be a huge game changer as that becomes more and more prevalent. And also standardization. I've mentioned this as well, but financial inclusion and access. Anyone with a smartphone or internet access can access this app that we are going to show. So I think those are just three really key points, and those combined are collapsing the existing value chain where any token, regardless of the underlying asset. So when we talk about gold, when we talk about treasuries, Bitcoin, ETH, they're all on the same rail and can be used for payments, for peer-to-peer transfers, for savings. So to end customers, and this is again what we're building with WisdomTree Prime that I promise we'll show in a few minutes, where you can buy gold instantly, you can pay for a coffee with your T-bills, you can send your friend or yourself ETH cross borders, all transparently, quickly, and with less friction than today. And that's what we're building towards. And it's really remarkable that some blockchains can provide near instant settlement and 24/7, 365. And that's what we're working towards, which is really, really exciting. So looking forward to, unlocking future use cases for this. But I think WisdomTree Prime is on the road to get there and to showcase a lot of that.
Find me somebody who doesn't want all those features. I mean, come on. And I agree. I think you're probably only just scratching the surface, right, of what's eventually going to be possible. Like being able to just pay, why would you ever keep your money in a bank account when you can just pay directly tied to your treasury bills or your portfolio, et cetera? A very exciting concept.
And think about all of that in checking and savings that's not earning anything. And you could have all of that earning 5% in T-bills, and then you can pay your credit card bill with it or pay for groceries with it. So there's no dead cash. And I think that's what's really exciting about this too is, and if you're like me, I probably have 10 finance apps on my phone. They all do different things. There's a credit card one, there's a savings, checking, brokerage, crypto. The goal of WisdomTree Prime is to bring that all together into one app and to really make your finances work for you in a way that you're not going to all of these different providers. It's one centralized location that it can work for you.
And I think something we're going to see, which I think is a differentiator when it comes to tokenization, naturally this concept of self-custody is very cool and awesome and a main staple for crypto. But I believe, what you're doing is for a lot of us who get nervous about even sending crypto transactions, or it's cool, we can instantly settle, but I want somebody to do this in the background. I want somebody to take care of this. It sounds like WisdomTree's done the work of making this a pretty seamless experience. It doesn't require too much education from a crypto perspective from the user. Is that right?
Absolutely. Yes, that's right. And really, this is for the crypto curious, the people who just want a better investing experience. They want access to crypto. They want access to treasuries. They want access to gold. And in one easy to use, simple interface that you can see all of your assets in one page, and then you're able to spend off of them. So absolutely, that's right. And again, we think that there's a real benefit for that. There's always the people who are going to say, not my keys, not my coin. But there's a lot of people who aren't comfortable with that. And that's really the target market that we're going after here. So we're in 32 states today, just in the US, which is over 60% of the US population. That's hot off the press. So just came out yesterday. Nice. We're super excited about that, with a few more coming in the next few weeks. But maybe we can show the slides and I can talk through a little bit of what this looks like. Awesome, great. So this is the landing page. You'll see this if you go into either the Google.
One sec, Meredith. I just want to make sure that it's also updated for everybody else. I know that we can see it. We'll just give it 30 seconds. And we're good to go. So go for it. Yeah.
Okay, great. Thank you. Thank you for that. I can see it on my side, so got excited. So this is when you go into the app or the Google Store, this is the landing page that you'll see. And just to also take a step back, we recognize that there's a few problems in the market that we're looking to solve with WisdomTree Prime. So you'll see here around security as a priority. A trusted, reputable, experienced firm to provide access to these tokenized products is what we are. And we think that there's a lot of weight, rightfully so, considering the events of the last 2 years that make that a really important point to the end consumer. But also the actual utility of assets. Gold will sit in a vault for years, treasuries in a brokerage account. Again, to what I said earlier about what if you could use these assets to pay for your daily financial needs? And what if you could always be earning a yield on that cash sitting in your checking accounts? And that's a really, really powerful tool for the retail investor that we're bringing to the forefront in an easy way. And we also just think that there must have been a better way to invest that's faster, that's more efficient, and that's easier than what we have today. So that's WisdomTree Prime. If you look here, if you wouldn't mind going to the next slide, you'll see just some screenshots of the app. Again, we're not in all 50 states, so out of the US, so just teasing some screenshots of what it looks like when it does come to your home state. But the app provides users with a curated and user-friendly investing experience. And hopefully we can go to the next slide. I'm not seeing it up just yet.
Is it not going? Let me just.
No problem. Oh, and there's disclosures. So our compliance team will be very happy. So those are also, touch on those towards the end. But there's a select suite of crypto. So we have Bitcoin, we have Ether, we also have tokenized real assets, and exposure to mainstream traditional assets through WisdomTree's very own digital funds. So as of today, there we go. As of today, you can see how it looks from left to right, signing on, a main homepage, purchasing gold, what the gold screen looks like as you buy or sell it, and then what your holdings would potentially look like. So again, really clean, really easy to use, and you would have no idea that this is running on blockchain rails. And that's also really a goal of ours, is to say the technology will sit in the background just like the internet does, just like electronic trading does. And it's just a better, more efficient, faster way to invest, to save, and to spend. So we're really, really excited about this. And we think that there's a lot of potential here as we start to build this out. What's coming soon is a debit card. We'll also have additional functionality in terms of peer-to-peer transfers, as I mentioned before, for going outside of the app. But for now, it's a really, really great way to, first of all, start to dip your toe into crypto. Second of all, get access to yield. And third of all, if you're interested in gold, obviously physically backed gold is a great way to be able to hold this digitally. So really excited about this. And again, in 32 states, go to wisdomtreeprime.com to check it out, or you go to the App Store. We're both in Apple and in Google, and download the app.
I mean, just looking at this is just not what you expect when you think of an asset manager. I mean, not even 10 years ago would you expect something this clean, and now today you're rolling this out as if you're a natural born Silicon Valley tech company. It's pretty wild.
We have a great team. Yes, absolutely. Yeah, we're really excited about it. And also just the utility of it. We think that end consumers will find a lot of benefits from it as well, especially as we start to turn on the debit card and the spend and the send features. That utility is really a key for us, and the democratization of it too, that we have low minimums from an investment perspective. So it's an easy way to enter, not many barriers to entry. And again, it's all on your phone, which is what's really incredible.
Yes, it is. So that's why I gotta ask, did Florida end up making the cut?
It did.
I gotta go download the app and play around with it right after this. Count on that. But we still have a few minutes left, so I'm going to take full advantage. I think one of the hot topics, is around private and public blockchains when it comes to institutional adoption, potential barriers. Would love your thoughts on that. Shed some light, maybe even how you see the Prime app itself leveraging potentially public or private blockchains.
Sure. Happy to. And I think this is probably the most talked about question right now, but it's also the debate that's been going on for a long time. And that's what we joke about internally, that we're back at this conversation too. But I really think, and again, I think this is where my tenure in traditional finance, I do have sympathy on the private blockchain side that I know if other people were on would probably have a different opinion, but I really think it's dependent on the use case. So if we're talking about utilizing blockchain to gain efficiencies for trading with known counterparts, then I can see using a private blockchain or a permissioned subnet to facilitate those transactions. And you can see some real value, whether it's in cost, speed, or both. For instance, we joined the Avalanche Spruce testnet with Wellington, T. Rowe Price, and a few others to test out use cases like that. We do see a value there. But coming from over a decade in traditional finance, I understand that this is a journey for larger institutions. It's a good starting point to adopt the technology, begin to understand the benefits, but we're not going to get to the full scale and adoption needed needed to see that end goal of democratization until everyone's working on a public chain. So on the flip side, if we're talking about use cases for true distribution, getting real scale, democratization of finance, financial access, you need to be on a public chain. So that's why we've built Prime on a public blockchain, specifically Stellar. And we're starting to work towards how we can think about more broadly distributing assets across chains, specifically EVM compatible ones, to grant more people access and truly utilize this technology as it was meant to be utilized. So meaning eliminating barriers, borders, lines for everyone to have the same access to finance and banking. So I see both sides of that coin, but we're very much in the public blockchain space.
No pun intended. And it's obvious that you didn't let the debate hold you back clearly now that you're live with the app. So that's the most important thing. And that is the most important message, everybody, that tokenization is happening right now. Clearly, you hopefully learned that from our amazing conversation with Meredith from Wisdom Tree here. If you do have questions, reach out to the lobby. We might be able to get them over to Meredith, and maybe we can get you in the networking here and there. But other than that, this has been absolutely amazing. The recording will be available on the platform, everybody. And thank you again, Meredith. This was absolutely wonderful.
Thank you so much for having me. This was great. And yes, please send any questions. And I'm also online, so feel free to find me LinkedIn, Twitter. And thanks again for having me.
I don't know about everybody else, but I'm going to go download that app.
Thank you.
Move on to the next session, everybody. Ciao.
Bye.
Financial services companies, you name it. And today we're going to talk a little bit about the STA Success Network. But before we do, I do want to talk a little bit about Security Token Advisors. This is our consulting arm, our sister company. Most people don't know, but this is actually where the company started, helping others understand and apply the technology of tokenization. So Peter, maybe you can just give everybody an overview and understand exactly how we work with our clients.
That's what we do. Sure. Well, thank you for the introduction, Herwig, and good to see everybody again, going back to back today, it feels like, which is awesome. And yeah, STA, I mean, the whole goal of this is to have the pulse on the market with every regard, right? Every component. So we're not just dealing with asset managers, not just dealing with issuance platforms, not just with blockchain foundations, not just with custodians or compliance groups, not just with legal groups who are doing private placements here, and not just with any secondary trading venues, but rather kind of looking at everything holistically. And so I feel like the business has pretty much evolved the last few years, from kind of the cookie cutter. Okay, you have a real estate issuance, or you are a real estate developer, a property owner, maybe you're a real estate private equity firm. Maybe you're looking at carbon credits. Maybe you're looking at a small private equity firm, or even you have a startup that you're running. You want to raise capital with a security token offering. It's a tough lift. We were doing that for a few years, and we're still actively, obviously, taking on those types of clients. But things have definitely evolved from there. And so, it used to be more, how do we evaluate the market? How do we figure out which service providers and their technology stacks really meet our clients' needs? Some clients are cool with, hey, I want to, find me a reliable partner. I want to issue a token, raise capital, wipe my hands, and walk away, just seeing it as a new avenue for capital raise. Others really want a whole holistic built-out solution where, users come to their websites, kind of like our raising capital discussion yesterday, and you can invest, boom, directly right there. You want to own the experience. Maybe you want to create a secondary market for certain goods and products in the future. And that's a way more customizable, built-out solution. So we've kind of gotten hands-on experience looking at all that, evaluating, and ultimately architecturing it, bringing it together, constructing it. We'll use that better word. But of course, we saw things in 2022, and now we see 2023 as the year of the institutional adoption. Fun fact, we put out the State of Security Tokens Institutional Edition last December. So we pretty much called that 2023 year as is. It's really shaping up. If you go look at that, I bet 70% of the themes are playing out already. And I think our advisory side has really reflected that. So we're working now with kind of global asset managers, whose assets are in the hundreds of billions of dollars of range. We're looking at legacy transfer agents and legacy index providers saying, hey, STA, how do we get in the game? We see all these private assets. We see tokenized money market funds, security token offerings. We see, alternatives come on chain. How do we keep our competitive moat against our direct competitor? How do we service our existing big banks, big asset managers, big trading firms, market makers, whatever, hedge funds. How do we service them while also looking towards retail and towards where their future's going, which is all on chain and digital?
So if I had to summarize that right, in the beginning where we helped traditionally clients just understanding the legal construct, finding the right partners for tokenization and distributing that product, we've evolved now to an application level where whether you're a multi-billion-dollar asset manager transforming their back office, not even doing anything on the front end, whether you're looking to enter into the space and understand where might an index product play a role. Even I know from personal experience, we were working with layer 1 and layer 2 blockchains to say, how do you adapt to the growing RWA theme and security tokens? How do you play and participate in this ecosystem? And then naturally, as you pointed out, we're really trying to put out a lot of research, make sure that you can stay in touch about what's happening, other than the oddball press release here and there. I do think that we are one of the few companies, unfortunately, I wish there were more, that's really trying to put thorough research out there. And so your state of the security token reports, we do a quarterly report that you do. We just saw the Q2 one come out. Q3 will probably be, in the next month or so. So that is your way to stay tuned in to what's happening from the companies that are operating in this space, from the blockchains that are powering these technologies, from the institutions that are doing things, from the issuers that are actually issuing these products, and from the marketplaces that are trading these things and providing financial services. It's all in one place. And I think I would like to say, I hope that it's been helping the industry move forward, helping create validation. But consulting, we are a small shop. It is, our main business is not necessarily consulting. So we ran into a problem, didn't we? Where we said, hey, how can we take all of this knowledge, all of this research, everything that we're learning with our clients, the best practices that are being put out, how can we standardize that and scale that? Because naturally, we can't scale ourselves that easily. So that's, I believe, where the STA Success Network was born. Tell us about the origin story. Tell us about what you see as the purpose of our, our research community that we've built.
Sure. Yeah. The Success Network, what is it? It's probably 220 members strong now across some of the largest banks and asset managers that we talk to. Of course, all the service providers and chains that we, aforementioned. But really, I see it as the ultimate outsourced research group. I think the industry itself is still a tough value prop to really get a whole research team. It'd be hard for a bank to, cut their equity resources, let's say, and shift it to tokenization yet until they have real demand, even same on the bank side. But for us, that's our bread and butter. And so it makes a lot of sense for all these members to join, to get our weekly insights a couple times a week at this point, get office hours with the team, basically get that consulting touch, just all kind of in a box, if you will. And I know it's kind of evolved even from there, just as a research group, bringing weekly insights and kind of our take and our, however we're chopping it up and seeing that with our own clients to them, but rather to a full branding and kind of business development in a box, which I think is very exciting. It helps keep us, keep our pulse on the industry with all these players, and we get to see all the cool projects happening in real time. I don't know if any other groups really are seeing that, just given our status as independent third party, calling it as we see it. But that's really the benefit we're seeing.
Our lowest level tier, which is available just for $9 a month. We need to be able to power this research. That gets you access to our weekly insights and our premium webinars. These are select webinars that are available to our community to be able to tune in, much like a lot of the sessions that you're seeing today, but in a more close-knit, engaged group. I would garner to say that there are now maybe a dozen or more articles on average in each newsletter that goes out every Monday. Is that right?
It used to be, a good week would be 10 back in like April or May. Now it's like anything less than 20, 25 is, it leaves you wondering what happened this week.
It is no surprise that we have an over 70% open rate and that everybody gives us rave reviews about our newsletter every week, the STA Insights, because it really does allow you to just quickly scan, get plugged in. We do offer our weekly insights about what's happening in the industry, and it's a great way for everybody to get the word out. to stay in touch and naturally have a discussion. So we're going to give you in these last 5 minutes here a quick overview of our platform so you can see exactly what you get to take advantage of by joining the STA Success Network. But what I want to let you take away is that ultimately, this is an opportunity for you to essentially join a TokenizeThis that's happening 24/7, 365, where you're only talking to other financial professionals who are actively in the space, trying to, move the technology forward one way or another, whether a service provider, an issuer, an enthusiast, an investor.
We've already seen blockchains integrate with platforms in the network. We've seen issuers find their compatible service providers for issuance. We're seeing it all in real time.
It's our favorite thing to see happen is partnerships getting made. That cross-industry collaboration is what makes it all hum. And there are just so many pieces to tokenization that it's an absolute must. So just as a quick overview for everybody, as I mentioned, there is a weekly email, several emails that go out to keep you touched into the space, as well as we do have events that you'll be able to tap into. Naturally, we're going to be debriefing our event. We have, for example, some spotlights of different industry providers, as well as a variety of different webinars, different expert speakers to bring in, just so that every week you have a chance to, again, tap into what's happening in the space. I believe, there was an event we did with Securency. They had just announced a major new partner or something like that. Boom, they were right able to talk to us directly to everybody who's here in the network. And again, these are Zooms that are held that way, in order to be able to, again, engage, not just necessarily hope to be able to have your questions heard in this type of environment, simply because we can't get to everybody's questions. We do have a premium service for $99 a month, where we actually will have premium events, where, as Peter mentioned, we have office hours. You can easily just jump in with us. I get a chance to talk to us, get our insights. Really anything goes on the table. We have group discussions, as well as we mentioned, if you were here yesterday, our Powers Hour with Mark Powers. He is a former SEC enforcement chief who's an advisor, 40-year lawyer career that now is sharing his insights, as well as a lot of cool other features I want to point out real quickly. Of course, all of our events, they are available to take a look at. And then we have the STA Success Network library. A lot of the research that we've aggregated, for our clients in the past or for the industry, we've been able to standardize here, so that even if you're new to tokenization or you want to get into some of the more advanced stuff, we hopefully have a resource for you. And if we don't, by design, you can just go ahead and ask STA, and we'll go ahead and see if we can help you out with some research or answering your question and such. As Peter mentioned, we've got a member directory of hundreds of people that are some of the biggest names in the space. A lot of the folks that you've seen here on the different sessions are a part of this. You can actually just find somebody that you like. Matt was great on that real estate panel. I'd love to follow his activity. I'd love to send him a message. I'd love to connect with somebody. You can just search by keyword and start connecting with the movers and the shakers of the industry. Folks, they're all here. That's the idea of this research community, so that we can start to standardize. We have an enterprise plan for our partners as well, so that if you want to publish to STM and our news syndicate and take advantage of PR opportunities, we have that too. We, of course, have a member chat for everybody to stay active in. We've even got exclusive chats. I'm not going to show you those until you join and get access. We've got spaces that you can talk about different topics that are happening, so we can engage. It's all there, our research, our reports, and even a vendor directory, so you can learn more about our partners. This is a great tax partner of ours, Legible. You should check them out. All of that and more, and growing. We just launched earlier this year. So come help make this community as great as we can be, to become the leading, largest research consortium in the world for tokenization. And tap in and have fun. It's a great time every week on our webinar. So Pete, any closing thoughts you want to share about the Success Network?
No, you covered it perfectly. We'll see everybody in Stassen.
See you there.
financial revolution, because we're constantly talking about the efficiencies, the benefits, the cost reductions that come from working with technology for capital markets. Well, what better panel than to talk to the technologists themselves that are making this happen and to discuss the real exciting benefits and revolution behind the technology. So my name is Kyle Somlin. I'm here with Security Token Market, and we have a great panel here talking about transforming your back office. And so before we dive into it, we of course need to introduce our amazing panelists. I want to kick it off with my good friend, Dave Hendricks. Dave, could you introduce yourself, talk a little bit about Vertalo for anybody that may not know the company, despite the fact that you're an OG in this industry?
Oh, hey, thanks for having me on here. Great to meet everybody. Thank you all for joining us this morning. Super exciting. I am Dave Hendricks. I'm the CEO and co-founder of Vertalo. We were founded in 2017. Initially, we are an issuer. And then in May of 2018, after seeing some holes in the market, we pivoted to become a digital asset data management platform, focusing on transfer agency and data management really of the investor and asset data, which is thrown off, which is produced from the work that we do. We started out in the mid and back office. And after that, seeing the opportunity to help on capital formation, we started doing that in 2019. But I'm super excited to talk about the real benefits that can accrue from the proper implementation of digital asset technology, specifically distributed ledger technology in institutions. Thanks for this.
Exciting. Yeah, I have a ton of follow-ups that I want to get to, particularly even just defining some of the jargon and terminology here. But I'm going to put a pin on that just to make sure that we can introduce the rest of our panel. I'm going to go over to Marcin. Marcin, could you give us a little bit of background on yourself and your business?
Absolutely. So Convene's been around since 2017. We focus on the data layer for organizations. So our technology plays a role of a cross-enterprise service bus, where we touch data and information across different enterprises and different systems, being the bridge that connects the data without actually moving the data. So that way we're always data compliant. Now myself, I'm a reformed investment banker. I used to run funds, now I run data. I think I've moved on to the smarter part of the market, the smarter side of the market. Data whereas you actually have everything happening. So and it's about time. Most of my life I spent in alternatives. So a rather opaque market with a lot of data, but not very transparency.
Wonderful, wonderful. We anybody that has been in this industry also is very familiar with Invenium and the services that the company provides. So we're excited to have you on here. Kicking it over to Lou. Lou, please talk a little bit about Block Time Financial and what you got going on.
Yeah, thank you. Glad to be here. My name is Lou Morgan. I'm the Chief Technology Officer at Block Time Financial. We also started in 2017. 2019 started developing our platform. We're a middle and back office software solution, blockchain infrastructure. Okay, we do the not so fun, cool, sexy stuff.
But the stuff that matters, Lou, it's the stuff that actually matters.
You're sexy, Lou. Don't let anyone tell you you're not sexy. Come on.
But yeah, we we're doing we're cranking out the statements, we're creating the transactions, we're doing tokenization, we're doing all that kind of stuff, traditional back office stuff that blockchain really needs to get into the future. I spent 30 years in the in the trade fi industry as a member of the Chicago Mercantile Exchange, as a partner at a broker dealer. So very well versed in CFTC and SEC regs. We try and make our platform real easy to work with for the regulators to get at the data that they're probably going to need. So that's us in a nutshell.
Awesome. Awesome. Shout out to Block Time Financial for being a sponsor of the TokenizeThis conference here. Really appreciate you guys showing up and showing out and helping us make this thing possible. Finally, certainly not least, but last here for the introductions, we've got Siddhartha from Intain. Please, Sid, talk a little bit about yourself and what you got going on.
Hey, thanks, Kyle. Good to be here with all of you. This is the first blockchain conference panel where I guess having been founded in 2018, we are the youngest company. Otherwise, this seems very old. Intain is focused on structured finance. And our idea for people who have seen the Big Short movie really is that you see so many types of entities in the structured finance industry: the issuer, custodian, underwriter, servicer, trustee, investor, bringing them onto a common network. We have about $6 billion across 30 deals that are administered on our platform. And we use blockchain as a network, but we combine a suite of digital technologies. In fact, the origin of the Intain name itself comes from intelligent blockchain. So we've been combining components of AI. I'm happy to talk as we go along.
Awesome. Awesome. So we've got about 35 minutes. We're going to end here right at 12:30. And we've been really sharp on schedule throughout the event, and we're going to try to keep that up today. So I want to be as efficient as we can with our time. So first off, we have the fact that our panel is talking about back office stuff. Dave, you did mention back office in terms of your expertise in the software that Vertalo provides. Could you just kind of walk us through what that means and why there's opportunity in the back office part of the capital markets?
Yeah, I think that while the front office work is sexy and public, there's an engine room that needs to be connected to that front of house experience. It's the cooks, it's the ingredients, it's the storage. So much of what happens in even in TradFi is really behind the scenes. Okay, there's a lot of work being done in huge floors of people who are moving spreadsheets around, who are reconciling, who are emailing and faxing. They're doing all kinds of things. That's the interim. That's the heart of TradFi. In this new kind of DeFi world that we all participate in, there's been a lot of emphasis on things like capital formation or secondary trading. Those are both kind of front of the house operations. They can be done internally sometimes, but often they're done externally. So if you want to look at where the greatest gains are, it's really in helping reduce OpEx and helping manage like the bucket brigade of data that moves through an organization from capital formation through secondary trading and post-trade, and then the compliance and the reporting and all of that. So it's the mid and back office is a very, very meaty kind of target for evolutionary, not revolutionary, but evolutionary improvement. And so as a company that focuses on data management, and everything I've done in my career has been around data management, we started at that spot because we thought that was a great launching point. And I think that the other panelists here have lots to say. I know our friends at Invenium are really, really focused on that core data asset. And it sounds like Lou and Siddhartha are also thinking about how important the mid office is, that connection, and the back office where basically where the sausage is made. And where the sausage is made is where there's a lot of opportunity.
Right. I think that you make such a great point just around manpower and woman power for that perspective, but just the amount of people that are required to service the back office. The front of house is, the Robinhood application that moves smoothly and swiftly, and you just click buy and things happen. But to your point, somebody at the back end of that actually needs to receive that message and make that trade happen, or any financial infrastructural perspective. So you have to have so many people involved, and maybe a lot of the people could really be automated out in a lot of cases without the need of some of those middlemen by leveraging the technology. So I think that's really great points there, Dave. I want to go over to Siddhartha just because you were talking about structured products, and you certainly mentioned the the Big Short example. A lot of people are familiar with that whole cycle. We may be seeing something similar now with maybe just respect to a lot of the technologies continuing to be outdated, and that can kind of compound on each other, especially in high frequency environment situations that we see in today's market. Do you agree with some of the thoughts that Dave has, and where do you see the opportunity to squeeze a couple basis points to make these transactions cheaper and more efficient?
Sure, yeah. So completely agree with what Dave said, though our remit is far narrower, I guess, because we deal only with structured products. And in structured products, as Dave used the word, how front office is sexy. Structured product amongst the sexiest front offices is possibly the sexiest front office because there's just so much glamour. But people don't realize behind that glamorous structured product, there is a servicer who's collecting monies on loans, shipping an Excel sheet to a trustee acting as paying agent, who's converting data from that Excel sheet after applying those models and shipping out a PDF to an investor. So this great front office is backed by two great digital technologies. One is an Excel, the other is PDF. That is how bad that is. And this happens 55 days post facto. So monies that were collected, let's say in the month of September, in the first week of October, the servicer will start collating, cleaning up the data. Somewhere around 15th of October, the data will be sent to the trustee. And then the trustee will apply that models. And because we handle so many live transactions, around 25th of the month, which is the most typical payment date, the investor will get their monies and the report, which means on 25th of October, the investor will get to know something that happened on their portfolio on 1st of September. So that is kind of how the back office currently functions. And because everybody is on their own systems, and Dave talked about reconciliations, if we just looked at top 10 US financial institutions, they would be having at least 200,000 back office people just in India. So if you just added JP Morgan, Morgan Stanley, Goldman Sachs, etc., they would be having 200,000 people just in India. That's how huge back and middle offices are.
E plus 55.
E plus
55 on reporting.
That's crazy to think about. I think a lot of people don't realize that, at one point, the New York Stock Exchange and the stock market in the US is closed on Wednesdays, right? Just to rectify all of the transactions going on. They close for an entire day each midweek just to get everything aligned and consolidated. And yet we're not actually that far from that even today with what you're mentioning here. We're nearly 2 months ahead of all the transactions trying to catch up. Of course, you're going to have issues on locating these assets, and there's always going to be the occasional issue. So I want to kick it over to Lou. How are you seeing the technology developing from your side, and what are the trends that are actually being put in practice? Because there's maybe so much opportunity. Where are you kind of identifying are some of the lowest hanging fruit from a technological perspective?
Well, we're seeing with the tokenization trend right now. I think we're looking at the back office, the efficiencies of the back office that can be implemented with the atomic swap. All right, that's a big thing, right? All of a sudden we go from settlement T+5, T+3, T+1 to T+5 seconds now. All right, and that's really big. The atomic swap takes out a huge chunk of the traditional back office. And the blockchain just provides, the distributed ledger provides so much more efficiencies. You don't need a transfer agent-ish, right? You don't need a settlement. You don't need clearing. That swap just happens, right? So
can you explain that? I'd like to challenge that, because that's not exactly, I like the idea, but I'm interested in seeing like atomic swaps, which are super interesting. But who's doing that? And
define that term just for anybody that's
Yeah,
unfamiliar
yeah.
with what an atomic swap is before we get into Dave's question, which, by the way, great question. Anybody on the panel, feel free to jump in.
Yeah, so if you have US dollar coin in your wallet and I want to trade that for another token, I can take that US dollar coin and I can put it either into a smart contract or a distributed exchange that some blockchains run. And I can, if that order for that swap gets matched with the other side, that settlement happens. I've swapped my US dollar coin for the other asset in 5 seconds.
now I understand that, but I'm trying to map that to an institutional mid and back office use case. So what institution, first of all, wallets, okay, which is a complicated thing, just so everyone knows. A wallet is a thing that gets broken into by guys in hoodies, okay, because you use LastPass or you use Friend Tech and someone ran social engineering on you. So where is this wallet? Like, tell me where this wallet plays into mid and back office, because I understand Fireblocks or MPC wallets or things like that, but that's not an individual. This is it sounds like you're talking about a retail use case. Where does this fall into mid and back office in institutions?
Well, think about a custodial solution, right? Or transfer agent.
So I'm a transfer agent, okay,
Right.
and
Yeah.
I have keyless custodial wallets, and I
Okay.
can swap. So
Right.
So I'm trying to figure out which kind of wallet you're talking about, and who is the end user here. Is it someone who's on a desk in a huge on a floor with 300 other people, or is this a interaction with a third party who is transacting with an institution? I'm not trying to be difficult. I'm just trying to understand the use case here.
I think you hit on it. I think it could be a wallet. It could be a guy sitting on a trade desk. I think the biggest efficiencies are going to be the guy on the trade desk, right? Now he doesn't have, his back office goes from 10 people to 2, right? Because of our technology.
So someone at an institution is going to let someone on the floor control a wallet which belongs to the institution. That doesn't seem like it would fit either compliance or risk. So
Well, somebody controls an account, right?
Siddhartha, you're in this space with these structured products. So this is probably closer to what you deal with. I'm not trying to call you out, Lou, although it probably sounds like that. I'm just curious.
No, it's a great discussion.
By the way, these panels are really boring if we all agree. So you just expect more of this from me. Sorry, and you can do the same thing with me.
Jump in. From my perspective, I think Lou makes a really strong point, which is a lot of the operations that are done from these intermediaries probably can be improved. To Dave's point, we likely will still need accountability, and that's where the licenses may not necessarily go away. You may have underlying intermediaries that still manage a lot of these processes, but perhaps if this process can be extremely streamlined and improved from soup to nuts, then you're going to see a drastic reduction in a lot of the time and expense that any of these intermediaries need in order to kind of approve these things, because of technology like an atomic swap, where you can just bang, swap those assets immediately. We might still need some oversight to make sure that that swap is happening appropriately and the right individuals are involved. But the actual process of moving those assets now has been drastically improved. Is that kind of the perspective that you were referencing, Lou, or am I off base?
No, you're right on. I mean, these things happen with permissioned assets, private chains, public chains. There still needs to be some oversight, right? We have to do KYC and AML on the addresses, that kind of thing. So,
cool. I want to kick it over to Marcin. We haven't heard a ton from him over the last couple of minutes. He's been patiently waiting for his bit. So I certainly know that when we were here at the Invenium conference in Coral Gables earlier this year, which was an amazing conference with a ton of great panelists and institutions and players in the tokenization space, Invenium really put a big focus on data management, especially with respect to valuations and getting a better understanding of what's going on with an underlying asset's value, so you can much more appropriately handle transactions, collateral, all of those different pieces. What are your thoughts around how that relates to all of the back office kind of processes that are required to actually reach those valuations?
Thanks, Kyle. I think I'd start off with using Sid's playbook, mentioning a movie. One of my favorite movies is actually called Margin Call. And there's a scene that I keep referencing time and again, where the head trader calls a counterpart in the market, and he plays dumb. He pretends he doesn't know what's going on, and basically they settle on a number, right? Today, my loss is your gain, meaning you're going to make money off me. I'm happy, right? But truth is, it's a rather opaque market. So in those cases, we're talking about non-QM mortgages. You don't really understand what the underlying asset is. You don't have all the data points to make an accurate decision of what they're worth. Right now, the reason I like mentioning that movie is because you don't really understand what the MTM is of that asset. Now, if we move over to just hard bricks and mortar, like real estate, where you've got valuations on buildings, we can go down the same path for private equity, private credit, whatever it is. Understanding all the underlying data points takes time. And the truth is, in addition, it also takes a lot of reading and digging into stuff that you're not going to have time in order to actually trade. So the whole point is, all of a sudden, you've got your valuation agents, your auditors, your legal department, your GPs team, your LPs that are involved to some extent in whatever fund you're the admin for instance, everyone connecting data. So you've got the true definition of decentralized data repositories being unified through technology. Keep in mind, the data never moves, right? So, I mean, that's the main thing with our tech. The data doesn't move, but the whole point is everyone is operating, provided they're permissioned in, with transparency. So you are solving a stratified problem with DeFi technology. And that's where I think where we have middle and back office really shining, because without them, I mean, there is no MTM. There is no monitoring of legal and financial covenants. So you don't know, like on Sid's example, you don't know if they're actually compliant with their debt service coverage ratio, or if they've actually made a payment until it's actually too late. You've got lawyers that actually.
Marcin, can I ask a question?
Of course.
Are you saying that you see this as being useful in perfections, in like monthly perfections?
I see this being used all across the spectrum of data, whether it's financial, legal, asset level data. Doesn't matter where it comes from and how you connect it. You're able to act on it and make all your different systems speak to each other.
Yeah, just for the viewers who are not familiar with what a perfection is.
I was going to ask that, so I'm happy you're jumping to it.
Yeah, sorry. A perfection is a bank or a lender covenant. And so typically what happens if you have like some senior debt or some other instrument like that out to a lender, what they do is they send over a questionnaire or some survey type thing every month for you to report on some key metrics. Those key metrics are, that's referred to, that's a perfection. Okay. And what they want to do is they want to make sure that you're tracking to whatever the loan covenants are. If you go below certain thresholds, it's there, you get dinged, or your loan can get, your line or loan can get pulled. And so I think assisting in perfections is great use of your technology, but that's up to Patrick, not me. So.
Keep in mind that if you've got all the financial data that's reported and put together on a monthly basis, for that matter, right, when it comes to tracking loans and your covenants, not only do you report it, but you actually got the audit trail to everything reported. So let's try to think out an example. I'm going to supply all my financial statements, all my financial information. And our AI tool is just going to extract that data and feed it directly into your models and your systems. So at the end of the day, I don't actually need to fill out anything. All I got to do is supply you with data. And that's where
you haven't worked with my bankers then. They send you a PDF and then you have to like write it in by hand and sign it with blue ink and fax it back to them. But yeah,
that was actually what I was going to ask. If you don't mind me jumping in here, I want to ask a follow-up to Marcin. And I do a lot of reading around corporate inertia, where you have kind of a resistance to change from a potentially large organization until the benefits are really extremely clear, right? Because what a lot of, especially in the US capital markets, they work pretty well as they exist today, right? Certainly relative to almost anywhere else, they're pretty effective. So they potentially stand to lose a lot by changing that process as opposed to gaining maybe a slight margin. So how do you quantify the benefits of this kind of data management tool that you provide? What is that real quantifiable benefit for them? Do you see it more as the reduction of closing costs and from an M&A perspective? Is it an investor management style of tool for diligence? Where is it the corporate financing, getting better rates or quicker? Like, where do you see is the actual quantifiable benefit to leveraging a solution like yours?
That's a great question, Kyle. The thing is, everything is custom made, right? So your pain points are different than Lou's and Sid's and Dave's.
So then what are the common pain points?
So common pain points are actually being able to rely on your data. So as most organizations, most of our clients are, they're global. And as they are global, they've got different systems in different countries. Let's forget the different languages. Let's just stick to English, right? You're going to have different people operating high level investment, or in certain cases, in certain markets, they have a custom solution. And sometimes this custom solution is Excel. As weird as it sounds, Sid's on the money when he said PDFs and Excel and everything that we've seen in alternative investments, right? Meaning private funds, private markets as a whole. You need to make all of that connect. You need to make sure that that data is relevant and that you can trust it. The issue is you've got problems with version control, with permissioning, and now with data privacy laws, meaning most of the time you can't even move that data out of the country. So you need to be able to, first off, have a federated data room that connects all of that data. Then you need to be able to push out that data once it's properly structured into your different systems. So an example I like to give to my clients, and then we start quantifying, is basically introducing them to the knowledge pyramid. You've got the base of the pyramid, which is data. Once you structure data, it becomes information. Once you push information to the right systems, you got knowledge. Once you got your people in front of that, then you've got wisdom. So with that, you're able to not only be more efficient, be cheaper, be quicker, and scale up your business. So transacting becomes a lot more profitable, a lot more reliable. So I'd rather do business with Lou because I know that we're gonna do this in a week or so. We're gonna be good, no question about it. Everything is gonna be reliable, and that data is then maintained on a continuous basis. So that's where we usually see our clients tackling the issue on moving forward, on understanding their data, being able to do more with their data.
That's awesome. That's awesome. And Lou, a lot of people might suggest that a lot of this is digitizing capital markets, just taking it from paper to Excel or to a digital style of form. And then there's the tokenizing of leveraging blockchain for some of these things. What do you see as the role that blockchain plays in this system?
Well, we've got the efficiencies. We've got smart contracts that can basically you're creating the rules for the contract for the digital tokenized asset, and they happen and you can't change those. I think that's going to be growing in the future, and that in itself provides a big cost benefit for blockchain use, right?
Right. Makes a lot of sense to me. And we've got about 10 minutes left. So I have a question for Dave and then Sid, and then maybe we'll conclude with some final thoughts. Dave, I wanted to hear your perspective. I know Vertalo does a lot of white labeling style of services for clients. You build custom infrastructure. So could you talk about some of the differences between having first-party software that a client maybe has in-house versus working with third-party solutions, and how the different pieces come into the decision-making process?
Well, yeah, first, you said earlier in the call, let's get into definitions. Okay.
Yeah.
And so let's first tackle white labeling. Okay. White labeling is cosmetic. Okay. Branded is cosmetic. So if you ever see someone saying that they're offering either a white labeled solution or a branded experience, that's probably likely going to be something that's running on their architecture. Okay. And that is a non-starter for a lot of institutions when it comes to their data. Anybody can white label something. You can white label your, Facebook, Twitter, whatever, you can put little pictures around things. That's not, that doesn't solve security or risk problems. The second thing that you said with respect to us, and I would understand why this is a distinction, is the concept of custom. We actually don't do any custom work here. What we do have is we have an architecture that runs either third party. You can run it on our hosted. You can create a dedicated AWS and run our transfer agent and tokenization platform in a dedicated AWS. But unlike anybody else that we're aware of in the whole world, we can take our digital transfer agency and our tokenization platform entirely and place it inside an institution's first-party architecture onto their AWS. Now, in customization, sometimes people think customization is like, oh, we're going to create a new system for you. Well, that's really hard to manage. And so instead, we built an API-first platform that enables you to build your own UI, UX, workflow, et cetera, into on top of our core asset, which is transfer agency and tokenization. So you can do it in any language, you can build it into your flow, and you can white label that, but it's not really white labeling and it's not customization. It's really just the use of APIs, because the problem is we've got a lot of different players here. And the more custom you make, the more you fork your business. So the idea is to actually not fork your business, not have a different offering for everybody, but have an offering that they can use in whatever modality they want. And I think that, as we get through this phase of POCs and pilots, and we see institutions adopt this, they're going to be looking for a combination of interoperability. That means connection to third parties, but they're also going to be looking for control. And control of data, and specifically proprietary data like investor data and asset data, is not something that they're going to be willing to put out into the market. And so for the last 5 years, we've been developing our platform such that it could be implemented without customization, fully on someone's own architecture. And I hope that everyone understands that there's a lot of opportunity for everyone who's on this call and who's listening, but they're going to have to connect to other players. We do that through APIs. We do it through partnerships. This business that we're in, the sector only works without walled gardens. And with data exchange, mostly driven by APIs right now, not by blockchain, because blockchain's just a slow database, and it's on a network. But it's an exciting time, and so come check us out. We'll talk about it.
Dave, you definitely got me excited talking about with definitive speak, talking about once these proof of concepts are fully adopted, because I think that we've been on many conversations and panels before over the years where the POCs hadn't even started yet. So it's exciting to see that at least a lot of these institutions are actually getting very active in the space, even if, as someone said on a previous panel, it's still kind of a science fair style of project for a lot of these guys.
They're very, very engaged.
But they are very, very active. So over to Sid, before we give our closing thoughts here, where is your tech solution trying to position, and what are you seeing as the primary drivers of interest for some of the clientele and investors that you're working with from a quantified perspective? What do they see as the real benefit?
Yeah, so we have been in production on post-deal admin since 2020 now. So 3 years, there are deals running on our platform for 3 years. These are long tenure deals. And there are paying agents who have offered us up to 50% of their fees, which means that at least 70-80% of their costs are going away because nobody will offer 50% of their fees. On the custodian's role as a verification agent, there is a custodian, I think in Q2, I don't have Q3 data. They verified and certified about 75,000 SME loans on our blockchain using our AI solution, then certified and recorded as an NFT on the blockchain with less than one FT, one person dedicated to this. So just on the automation side, you recover costs in less than 3 months. Our estimate on $150 million structured finance transaction is that costs drop to about 50 bips from current about 150 bips. But more than the drop in cost for $100 million transaction, which is the minimum viable transaction size in the US currently, we would hope that we can make a $20-25 million transaction viable. And we are working on 3 transactions between $20 and $50 million.
Fascinating. Makes a ton of sense. We're talking about real volumes these days with real institutions getting involved. So with the final 5 minutes, I want to go one more time around the panel and just give an opportunity to share some closing thoughts. So kicking it off with you, Lou, talk a little bit about, just give us your closing thoughts. Who are you trying to work with? Who would you love to connect with? And what are some of your final thoughts on revolutionizing, transforming your back office?
Yeah, we're coming from the TradeFi world, we're targeting investment banks, broker dealers, financial institutions. We do have clients that are banks, credit unions. They aren't really doing a lot of token per se. And we're really seeing some traction with some POCs. As Dave mentioned, we're in the phase right now where we're throwing stuff out there. People are kind of figuring out what they want. They've seen some use cases out there now with Wisdom Tree, Franklin Templeton, putting Act 40 funds out there. We're really trying to get more traction in that area. And we think we've got a nice regulatory compliant platform for, compliant. When I say that, I say we have the data to give to regulators. I know how much they like it, and I know how much it changes every time they come in your office. So that's where we're kind of targeting, and hopefully the whole ecosphere gets bigger and bigger.
Great. And Marcin, leave us with your final thoughts here before we close out the panel.
We've broken the $70 billion mark on a platform in terms of assets on the platform. We're growing both stateside and internationally. Really happy to be working with institutional investors, fund managers, fund admins, sovereign funds, and this all across the globe in different geographies with different needs. And I think the reason we've been this successful and we continue to grow is the client has no lift to start adopting Invenium. Invenium is a layer that'll connect and sit on top of them seamlessly without compromising any security or any data concerns. So the people that I'd personally love to talk to is anyone in capital markets that deals with a lot of data. Obviously, we have been doing a lot in private markets within capital markets. But everyone that touches data within capital markets stands to benefit from Invenium.
Amazing. Sid, give us your closing thoughts here.
Yeah, so our end goal also is that we connect the front office to our platform and the transaction actually gets tokenized, structured, tokenized on our platform. But more than that, our target is that we can move from a $100 million transaction getting reported 7 weeks later to a $20 million transaction going through the same rigor that a public transaction goes through and getting reported in a day or two. And then if the same can be invested into in a digital asset, digital security format, which is what you call tokenization, then that's the cherry on the cake.
Perfect, perfect. And finally, Dave, we've got 45 seconds. You want to take it away?
If you don't want to give the most valuable asset you have, which is your investor and asset data, to a third party, and you want to update your back office and mid office systems and explore tokenization of assets and implementation of institutional distributed ledger, call me at vertalo.com. I'm easy to find. I will help you do this safely, securely, and scalably. Thanks a lot.
So that is our panel on transforming your back office. We've got some amazing panelists here. We have another panel coming up just after this. As a reminder, we are now best-selling authors. Blockchain Explained. If you want to check it out on Amazon, Peter Herwig and myself put 19 months of effort into writing that so that you can understand what's going on in the technology. And with that, gentlemen, thank you so much for joining me.
Thanks.
Thanks for having us.
Great. Good talking to you.
Yeah.
All right. Nice job, everybody. All right, welcome back, everybody. Another segment within the Tokenize This conference. Hope everyone's having a great day enjoying this panel so far. My pleasure to be joined by Mike Reed, Head of Digital Assets Strategic Partnerships at Franklin Templeton. For those who don't know, Franklin is a massive asset manager, a pioneer, one ahead of its time in this space specifically, and now really starting to see some nice traction come in. Always a name I had my eye on, real honor to be here joined with you, Mike. Real quick, would love to hear a little introduction about yourself, kind of what you're working on at Franklin Templeton, and then we'll hop in and move forward.
Yeah, sure. Thanks for having me, Peter. And I know my colleague Mike is going to be on the next panel as well. So we're thrilled to be a part of the event. So I'm Mike Reed. I lead strategic partnerships for the digital asset effort. I've been in this space for a few years now, and prior to that, I did fixed income at Franklin for almost 2 decades. And that's me.
Fantastic. I love it. Well, listen, we'll hop right into it after that. I think just to kind of set the stage for all of our viewers, listeners, anybody involved, we'd love to kind of hear what, how did Franklin really get into digital assets as a whole? Not even just looking at tokenization, but rather the broad-based, was it Bitcoin? Was it ETH? What was the whole strategy, or kind of how'd you guys approach that, and how's that developed so far?
Yeah. I'm hearing an echo. Are you hearing that as well?
What's that?
I'm hearing an echo. Are you hearing that as well, or?
I'm not.
No problem. Must just be my computer then. So if I was to trace our involvement back to a single moment in this space, or the kind of the first time I heard about blockchain technology, I remember the guy who leads our digital asset effort, Roger Baston. His son was, he came to the office one day, he's like, my son is playing video games online and people are watching him play and they're paying him to watch him solve different puzzles and different riddles in these games. And he's getting paid in Bitcoin. And we were all like, that's kind of interesting, different. And so we started to figure out like what Bitcoin was and everything like that. And then 2014, Ethereum, smart contracts came about, programmable money, like all those things. And we started just become obsessed with it. And learning more and digging into the space and trying to find it all out. But that was more like just intellectual curiosity that we all had and debate and discussion around it. We were in a trading floor environment, so people are just shouting things around and kind of thinking about things. We really started our development work in earnest because it stemmed from this idea of trying to find ways for the broader company to benefit from blockchain technology. So Roger's fond of saying that a lot of our efforts in this space have really just come from paying attention to words. Digital ledger technology. So when I hear the word ledger, and for anybody who's in finance, when you hear the word ledger, that word should really resonate with you because our industry is rife with ledgers everywhere. And so when there was this potential for figuring out, increasing efficacy of ledgers, efficiencies, whether that be cost efficiency or trust efficiency or just general efficiency of ledgers, was something that really attracted us to this space. So we started to develop kind of on the basis of that.
Awesome. So very interesting. So the entry story is one of a kind, of course, with Roger's son and kind of how that came to the radar. Extremely.
Sure. But I think a lot of us in this space, we have stories like that where I have a son who's a sneakerhead, and so he was really interested in some of the sneaker NFTs, and I think we all have our own kind of personal entry points that really resonate with us individually outside of anything workplace related, and that kind of drives that intellectual curiosity that pushes it forward.
Oh, 100%. And then it's nice to kind of see it come full circle as things do evolve in the workplace, let's call it.
Sure.
And even on that note, is there anything you can talk about just still on the crypto side? Maybe Franklin's work or involvement with EagleBrook advisors, or, if you guys are acting as a node operator in certain ecosystems. I think that's something even I hear from some of our partners, that they're always curious to hear how you guys are doing it.
Yeah, we made a bit of a splash at Consensus. We had a nice booth there, and the pillars of our digital asset strategy were on the side of the booth. And they're available on our websites to read about and stuff like that. We have kind of these key pillars of our strategy. One is the tech build around our on-chain products. Another is an investment strategies team. And then there's the node operations group that you mentioned as well. And the interesting thing about these things is one idea always kind of leads you to another. So when we started obsessing with this idea of ledgers and trying to build something on chain and figuring out, how could we possibly apply this to our company, we started learning about how all chains are different. They're all different. They have different ecosystems, different strengths, different weaknesses. Some are good at speed, some are good at security, some are good at both. I think a lot of chains are getting kind of branded now, where it's like, this chain is really good for DeFi, this chain is good for TradFi, here's a gaming chain, here's a pop culture chain. So you start learning that there's differences between all of these things. And not only that, but you start learning, okay, well, on each of these chains, there's all these projects that are being built, and there's different tokenomics, in the different projects that are embedded. And when you start thinking about tokenomics and feedback loops and value capture and stuff like that, to us, Franklin Templeton is a large asset manager. We manage portfolios where we offer active advice on individual assets. So this idea where there's value discrepancy between different assets is something that really resonated with us. And we thought, okay, so we're working on this on-chain development idea. What if we built an investment strategies unit that could really take advantage of the discrepancy in price, in valuation between different assets? So out of the development of the on-chain products came this digital asset investment strategies business unit, where we started to build things around that. Now, I think that a challenge we face in traditional finance, is that when you're looking at this ecosystem, a lot of the traditional products that are available in traditional finance don't really address it from a risk management or portfolio management perspective. So we built a lot of our own tools. There's massive risk systems and empires that are built around these risk systems in traditional finance. We actually built in-house our own portfolio management, risk management, trading platform to be able to deal with portfolios of assets like these all around that. And we were able to do that because we had this great tech team that was building something out already. So then we've got the tech build, we've got this investment strategies build out unit. Then we say, okay, well, there's typically in financial markets, a lot of the value capture happens in those early stages. So we built a capability around that also in the investment strategies, unit. And then the node op stuff kind of is what it is. We kind of feel like you have to be in the networks to understand the networks. And all these things are interesting enough. They're all related to each other. So I already talked about how, if you're building a portfolio of assets, you really need help on the tech side. But then you also have things like, if we're investing in an early stage operator who says, what about when I need validator nodes? What do I do then? And we say, well, we have that capability and can help, there if it makes sense for us from a business standpoint. What about when my token becomes listed on exchanges? What happens then? And we say, okay, well, we have a team that analyzes assets, and if it makes sense for us to include those in portfolios, we can. So we can, or if they say to us, we need help on the tech side, we have a group that can provide a consultative function. So it's really building this like complete, digital asset ecosystem in-house that we feel like has been able to help us have a good understanding, or a better understanding at least, of what's going on. Recently someone asked me, I was at a conference last week in Canada, and someone asked me if you could go back and do all of this again, only do it with external vendors, would you do that? And I said, it's hard to say, but I'll tell you that the learnings we've experienced from doing this in-house and building in-house have been amazing, immeasurable, and we feel like really help us to understand the space a lot better.
That's a very interesting endpoint there. Yeah, I mean, you guys have pretty much built up your own little conglomerate for digital assets with all those verticals in it. It's cool to see the relationship between, let's say, the node ops, and if you have smaller projects coming through, and that's how you can support them directly. I think it's also cool. Is all this going on through Franklin's US arm, or is it happening abroad? Is like an international effort?
Well, I mean, we're a distributed team, so I'm based in Chicago. We have colleagues in different states and different countries all around the world. So we're really a global company, and so having global business partners is something that we're very used to and accustomed to, and so yeah, it's happening all over the world. This build and this effort. Yeah.
Cool. Yeah, I mean, so you guys have the front row seat on the digital asset side. It's amazing. And even relating it back to, let's say, tokenization and this conference and some focuses, you guys actually have one of the first, if not the first, on-chain money market fund. And I remember seeing, the initial headlines, I think maybe in 2019 come out, and then kind of getting some boost in 2020. I know it went live April 2021. It seems like the product was kind of ahead of its time. I don't think people are really thinking about that, aside from a couple others. And now, obviously, in a different rate environment, it seems to be the talk of the town. Excuse me. On-chain money markets and treasuries and related products. What was kind of the motivation? How did that really come to the stage to you guys, and how did that move forward from there?
Well, I'll say this. We're not anarchists. We're not trying to blow up the banking system or anything remotely close to that. We're also not trying to blow up the stablecoin marketplace, because we understand what a valuable tool that is in this ecosystem. Part of it was luck, quite frankly. We wanted to develop something and kind of incubate it and do it. We're really fortunate that our CEO, Jenny Johnson, is really interested in what we're doing. We have regular meetings with her as a team, and she enables us and encourages us to try things and see what works and try and help to push our whole company forward. So this idea was really started out as a thought exercise. Can we do it? What will it look like? What will it feel like? And remember, when we launched originally, rates for all intents and purposes were zero, and nobody cared. So it wasn't this big, awesome asset gathering opportunity for us. It was really just a thought exercise that came out this way. And then, of course, the failure of the banks, a lot of Web3 natives who had their cash in those banks, people thinking about different ways they might want to diversify their treasuries, and we started to receive a lot of reverse inquiry for the product itself. And so now we're fortunate to have a lot of Web3 native businesses investing, treasuries with their treasury with us, which is great. And then also, I'd be remiss if I didn't say we also have some non-Web3 native groups as well who invest just because they think it's a cool idea, and the investment properties work for them.
Sure. Yeah, I mean, I think to start 2023, the fund was maybe around the $30 million mark. Don't quote me on that. I'm just going off some recent reports, but I know it surpassed like 308 million all in to date.
Yeah, well, I mean, we run it on a public blockchain, right? So you can see the money anytime. So it's all public information.
Yeah, and just kind of, if you're able to kind of clarify, so the fund, the Franklin US on-chain US government money fund, it's FOBXX is the ticker, but the token is Benji. Is that correct?
That's right. Yeah, the fund is we built it we registered it and built it specifically for this project. So it's a 40 Act mutual fund 2A7 government money fund, very boring traditional structure that's registered with the SEC. And then the way that you own that fund is in tokenized form. So you own purchase a Benji token, and one Benji token is equivalent to one share of that fund. And the transactions are recorded on a public blockchain, and the transaction records are that blockchain TA that we built is the source of truth for those transactions.
Nice. And originally it was on Stellar, and I know you guys have kind of rolled it out or have plans to roll it out to a few other chains. What is that motivation really, just to create as wide of an interoperable space and kind of cast a wide net as possible? I mean, yeah, the systems are so fragmented still. So,
well, I mean, I don't think we think one chain will win the day here. Yeah, it's really, we believe in a multi-chain world. The chains are almost like different digital nation states.
Yeah.
And like I said, like they all have different constituents and different ecosystem partners. And when we're thinking about those, you have to think about how if you want to proliferate your idea, you want to have access to as many potential customers as possible. And if each of those offers us a different customer base, in traditional finance, we partner with the financial advisor community to distribute our products. And we have partnerships with a wide variety of firms. And each of those firms have different end clients they deal with. And in the same way, the different chains have different constituents. And so it just gives us a broader distribution set. But then also, there's some suitability criteria that we run through when we're trying to decide which chains we want to develop on. And I'd really bucket those into two main segments. The first is kind of the technological suitability criteria. So Mike, who's on the next panel, if anybody's sitting in on both sessions, feel free to ask him a question about that. Mike really, has developed a pretty strong technology suitability criteria for the chains that we may or may not develop on. And then there's also this distribution suitability criteria. And some people may think that, okay, so you want a chain where there's tons of activity and tons of volume being done already. And that's a pretty good indicator for us. But then there's also this future state idea as well. So it's, if you don't have a large community already, do we see a path to that community being built and a community, potential for us to proliferate our idea that way? That's something we focus on as well.
Yeah, very interesting. And it always, it seems to come down to the incentives. Well, not always. Sometimes the incentives for issuers to build with certain chains versus choosing the existing larger base. And I think you even said it earlier, there's certain chains that are getting labeled a bit more like professional chains versus kind of novelty scenarios, DeFi chains, what have you. So it's interesting. I mean, you guys are casting a nice wide net, and it's also great to hear that a lot of Web3 firms are kind of, using their treasury capital for the Benji product. What I'm really curious about is, you mentioned distribution before, and in the traditional space, you're flowing out to financial advisors, to RIAs, to wealth groups. What does that look like for this specific product? Is it solely, on-chain of course, on-chain buyers, but is it solely Web3 firms? You mentioned a couple others, but do you have traditional channels that you're also kind of pushing this product out through, or is that still just all going to the existing legacy, U.S. government money fund?
So the way this product is distributed, there's a retail way to access this product for retail individual investors. Myself, I have if you were at Consensus, there was a QR code on our booth where it would send you to the app that you could download. So that's one way. And then another way is we have a institutional user interface as well, just because institutions have different criteria that they count on for investing. So we've kind of built it both ways. And like I said, there's Web3 natives who say, I like the idea of just knowing where my money is and having complete transparency into that. I like the idea of knowing who I'm facing, quite frankly. I think like that thing is something that a lot of people still want to know, is who is actually on the other side of this. So we have that going on, but then traditional investors have some of those same ideas, but then they also like the idea, I could potentially have strong earnings. I could potentially strong yield from this because of the savings that are achieved by running different functionalities on chain. So I think that both user bases are interested. It seems to us. I mean, we have clients in both Web3 and non-Web3 native groups.
Asking that net. It's funny you mentioned savings potential, and I know it still may be a little bit early, but I'm curious if there's been, if it's been well received from your team, savings using the blockchain fund versus not, and even beyond that. And this may be too early, but if you see different savings levels across different chains, so if it's Stellar versus Polygon, Aptos, whatever, if you're seeing anything tangible or material.
Well, I mean, the transaction costs are different across a variety of chains, right? So there's that. And when we think about the savings or potential savings we might achieve from running a product on chain, a lot of the legacy infrastructure for running traditional products, involves big monolithic databases and buildings and people who can make mistakes and stuff like that. And so a lot of that infrastructure, the need for some of that kind of dissipates when you're able to run a product with certain functionalities on chain. So there's definitely the potential for significant cost savings. But I think like from a cost perspective, obviously there's different costs there's different gas fees on different chains, and that's something we were well aware of.
Yeah, definitely. And considering you guys build a lot of the infrastructure in-house, is there anything you may not be able to talk about this, but anything that it's still kind of missing or that needs to be upgraded? Anything you're not necessarily satisfied with to really get that full flow going?
Again, Mike's going to be next, so I don't want to
save that question.
No, I think we're really fortunate to have a really high quality development team in-house, so that's been really great. But there's certain things that I think that we wish that we could have in terms of functionality. There's some future state stuff that we're working on that we're really excited about. I think there's some things that just quite frankly aren't going to go away over the near term for us. So, for example, this idea of knowing your customer, the KYC component, I don't see that going away for us anytime soon at all. And so being able to think about how we can know our customer in a space where assets are passed around pretty liberally is something that we think about a lot, quite frankly, because, we're like I said, we're a large asset manager. We have a lot of assets and revenue at risk if we make mistakes from a regulatory standpoint. So we just want to be sure that we're doing everything within the confines of our regulations.
Definitely. I mean, that's why it's kind of amazing how deep you guys are in the digital asset space with all that.
Well, I mean, we have constant conversations with different business partners and groups around the world to try and figure out where there might be applicability for the technology and applicability for the products. Certain markets, there's greater suitability than others, and some of that is down to how can you structure the products? What do they look like when you launch in different markets? Things like that. So yeah, we're constantly trying to get feedback, talking to our global salespeople to figure out how everything looks in different marketplaces around the world. Okay, understood. And even so, looking at, let's say, the Benji Investments app, let's say on the retail level, looking at the institutional interface, I think you said, and looking at utility, do you see any future where, I see a lot of headlines around the repo markets, around securities lending, just collateral mobility as a whole? Is there a future where, Benji is being used within these networks, whether it's with JPM or Goldman, Broadridge, or something even with other partners? I don't know. Is that something you guys see in like any utility along those lines? Well, I mean, like the idea that you could use, so I want to make something crystal clear. Benji is not a stable coin. It is not. Right. It's a digital asset security, so it's decidedly different. But the thought that you could own an asset and legally earn yield on chain is appealing to a lot of different market constituents. And so within this ecosystem, I mean, not just like traditional finance market constituents, but within people who are Web3 native. Mm-hmm. So yeah, that's something we're having like ongoing thoughts and discussions about. Again, like thinking about how we can do that in a regulatory compliant way with a US registered product is something we spend a lot of time on. Mm-hmm.
Definitely. Yeah. I mean, that's a lot of the stuff we're seeing lately, even from our asset management clients, is really how to even move beyond the product level. It's just given the lift that's there, and maybe there may not even be a target product in mind right now, but looking at all the different operational cases to kind of save some money before you make some money, if you will. So it's kind of interesting to see, how Franklin's trailblazing and kind of pushing that road, kind of like the offensive line, and just kind of opening up new materials and kind of new functionality. And so you're gathering the assets via Benji, you're gathering it through your other distribution channels, and you guys clearly have legacy incumbent partners. I'm sure there's a lot to be done with them. And if you're able to kind of offer this, to your point, as it's not a stable coin, it's a yield generating product. With a stable value, I guess that's really a superior form of collateral I see. And I think that's something that a lot of the banks are making use of behind the scenes, just in their own swaps and whatnot. So I was curious if that's looking on the radar, if that's something in the works, or it could go even beyond that. You guys may have your own proprietary system looking to do that.
Well, I mean, first of all, thank you for the football analogy as a diehard 49ers fan. But second of all, I think something that we've all seen, and anybody who touches this space sees, is that the collaboration level in this space it's redlining all the time. And some of our great collaborators and partners I've seen on panels already, and there are more to come. So, it's pretty amazing. So as people, and also I think there's this idea that, we're still so early, that being able to rise the tide for everybody is something that we're cognizant of. And, if we can provide some of that offensive line, like you said, blocking and tackling, we're happy to do it. And I think that this is a space that we really believe in as a firm. I think there are other traditional players who are starting to, see it and get involved. I think in some cases, competitors could become collaborators in the future, as we all kind of work together to help, like I said, rise the tide for all ships.
Definitely. I mean, have a cohort of, money markets and treasuries and get some more attention on that. It'll flow to the big names. You guys are one of the biggest. I agree. I think that's kind of the trends we're seeing. Even the other panels seem to agree with whatever topic is at hand. But listen, Mike, that's all I have right now. I don't see any questions flowing in, but if there's any parting words, or if there's any way, other, let's say, banking entities or institutions should look to partner with you guys, or kind of, work with Franklin in some capacity, I'm sure they could reach out to you at least and have conversations going for qualified discussions.
Yeah, definitely. We're open to talking to, we I think never say no to a conversation. We're always happy to have a conversation, but I think the biggest thing, especially for if there's traditional players on here who aren't involved in the space yet, the thing I always tell people when they ask me about the space I work in, I say one of the things you can do if you want to learn more is just to engage, do it. Like the way that I started learning is I dropped money into a trading platform and started trading assets. Then I opened up another wallet and started moving things around to see how it all worked. I bought an NFT and thought I lost it in a transfer, and then I didn't. And you start to see not just how cool and interesting it is, but you also start to see some of the places where there might be roadblocks, and where there might be some potential to be able to make everything kind of a little bit smoother for the end user. So yeah, like you said, like anybody who wants to reach out, please, LinkedIn is easy. I don't know if our contact information is shared on this in this platform or during the conference, but happy to always entertain a reach out for sure.
Fantastic. Well, thank you, Mike Reed from Franklin Templeton. Amazing conversation. Loved hearing about the history of the firm, the evolution on the crypto side, on the, blockchain transfer fund side, and everything to come. Looking forward to more conversions down the road. And thanks all for tuning in. See you on the next
thanks for having us. Really appreciate it. Thanks a lot.
Absolutely.
And we're live.
Awesome. All right, everybody. Welcome back to the Tokenize This virtual conference by Security Token Market. Another great panel coming up right now. Listen, we're going to be talking about the rise of the tokenized T-bill, and we can extrapolate that to money markets and treasuries as a whole, treasury funds, individuals, what have you. And listen, we have an awesome panel here today. I'm Peter Gaffney, head of research at Security Token Advisors, and I'm joined by Michael Moyer, head of digital assets technology at Franklin Templeton, Gerald David, JD, president of ARCA, Philip Pieper, co-founder of Swarm Markets, and Sid Powell, CEO, co-founder of Maple Finance. Listen, guys, would love to just kick this off. You know, I know we all know kind of what the agenda is here. It's right in the title, and we all have some involvement in that. But wanted to kick it off with a round of formal intros, if you guys don't mind. Michael, would love to start with you and work it around there.
Sure. I'm Mike Muir, and I'm responsible for our software development efforts as it relates to digital assets. Franklin decided to build an entire organization around this space and focus a whole bunch of people's entire attention to it. So we also build a lot of software to make all that happen.
Fantastic. Thank you. JD, you want to hop next?
Great. Thanks, Peter. Great to be with everyone today. My name is JD. I'm the president of ARCA Labs. ARCA Labs is the innovation arm, the division that's primarily focused on using blockchain technology to create digital assets that transform and work within the traditional financial system. We're the creator of the ARCA US Treasury Fund, which is the first 40 Act fund that issues its shares as digital asset securities, which are called ARCoin. And I'm super excited to be with the group today and to share more about what we've been working on.
Awesome. Thanks, JD. And Philip, what's going on with Swarm?
Thanks for having me. So yeah, we are a tokenization player actually out of Europe. We started off in the US and actually made our way over a couple of years ago. Today, we're a hybrid organization between being sort of a banking institution and at the same time sort of, you know, preserving as much of DeFi and sort of, you know, protocol layers as possible. But what we do with that is tokenize public stocks and bonds, as well as actually give this market infrastructure to different players for actually doing secondary markets and token markets. So tokenization, you know, is completed with that kind of functionality.
Fantastic. Thanks, Philip. And Sid, what's up with you and Maple Finance?
Thanks for having me. So Maple Finance is a debt capital market built on chain. We have, in the real world asset space, been doing pools that effectively lend against tokenized T-bills, and we've got about 40 mil in deposits there at the moment across Ethereum and Solana, and this has been an interesting product for DAOs, high net worths, and startups who have just done seed or Series A fundraisers to use. So very happy to be here.
Fantastic, great overview. Thanks, Sid. Listen, gentlemen, why don't we kick it off with kind of the obvious question that I guess we get from a lot of traditional financial folks. Why money markets? Why treasuries? Why are we starting there on chain? They're pretty liquid, pretty efficient as is. You know, what's the whole story and what's the narrative that's being crafted around that?
Well, I imagine our story might be a little bit different to others. We began our journey quite a few years ago now, really just thinking about the practical uses of blockchains as it relates to our entire industry, particularly the many roles that Franklin Templeton plays as an asset manager in the financial services industry. So our choice of a money market fund to begin this journey of tokenizing a product and really bringing to life a new type of transfer agent was really just a prototypical choice. We thought that money funds enjoy a large amount of transactional activity. This is one of the sort of promises of these technologies, that transactional activity becomes more fluid, lower latency, cheaper. And so we thought, well, we might as well just start with that. As you probably know, everybody recalls, I'm sure, a few years ago, as my colleague Mike Reed mentioned on the previous panel, yields for treasuries and the like that are purchased by money funds was basically zero. So it wasn't really a commercial intention behind this. Over the course of time, we've had a rising rates environment, and so there is now some commercial opportunity around this. But overall, this is still our prototypical example, and really what we've built is technology and by way of a transfer agent that can be used as a target state solution for all manner of pooled investment vehicles in tokenized form.
Yeah, it's interesting because when we started creating the U.S. Treasury Fund, which we did, 5 years ago, similarly, there were, rates were not where they are right now, and we looked at treasuries as something that we could use as a proof of concept in working with the regulators and trying to, really create a new vehicle, a new pool vehicle for for markets. And, when we think about how we approach things, our thought was, what is that we could present to the regulator that essentially, is easily digestible, is something that's, kind of quite understandable. And at the time had low volatility as well, and also backed by the full faith and credit of the US government. So when we began, creating what we call a blockchain transferred fund, which essentially is the wrapper that surrounds the SEC registered product that we created, our thought was that it was easily digestible for many to understand US Treasury. It made a lot of sense. Now, as rates are increasing, a lot of attention is being focused on treasuries, obviously, but more importantly for us, we think that there's a use case and utility for the tokens that are actually generated from these kind of funds, these different pooled investment vehicles.
I'll just add probably.
You got.
I guess that's Cindy's going to have probably a similar direction than I. Maybe a little different from the previous panelists here. So on the tokenized stocks and bonds, our target audience is basically crypto players in different shapes and forms, whether these are stable coins, trading organizations, but also the consumer that is in different environments, trading environments, that basically in this market actually is obviously very keen to get, yield-bearing assets actually presented to them. And, not to have a systems break once they decide to actually move back into crypto assets or purchase something differently. So the market pull and market demand on that side was basically to say, offer the consumer, meet the consumer where they are, and actually offer them something that right now in this market environment is actually attractive. And actually, we're being approached by certain ETF providers to actually be that channel for them in that sense too, right? And so it's not just limited to T-bills, but obviously that's a pretty attractive consumer group that has started to learn pretty heavily what sort of trading is and how to manage their finances. So it's actually a pretty good consumer group to actually expose this to.
Yeah, I think T-bills were a natural choice because it's a simple product for everyone to understand. So you can then work out the technology and kind of leave the other things in place. So reduce the number of things that could go wrong just from an engineering and products perspective. And one of the interesting applications I see happening now is that there's a lot of trading firms that have been having to use non-yield bearing collateral to collateralize their trades. And so I'm interested, and I think they're interested in getting things like tokenized T-bills accepted as eligible collateral, just so they can get better capital efficiency on the amounts that they're tying up when they're doing trading.
Yeah, totally. Philip, by the way, congrats that you're Sid, I agree, and I think that's an interesting point, similar to JD's I'm about to ask more about. But Phil, congrats talking. I mean, if the ETF players start getting involved in this a bit more, I think that's a huge domino to drop, and just like a very qualified one. That I think is great for the market as a whole.
And to my surprise, actually, the tonality is not, okay, let's create a tokenized ETF, but it's more, there's an option for the consumer to just digitize whatever they want to hold in terms of ETF. So it's just a hybrid, construct between these two worlds that now is becoming much more fluid between one and the other.
And even they saw the evolution from mutual funds to ETFs, obviously being in that business, and this is they're picking up that, okay, this is where things are going. So absolutely. And JD, you made an interesting point. I want to make sure I have it correct. Did you say maybe they're not able yet, but the goal is that, let's say, funds could actually distribute our coin or other on-chain treasuries to investors?
Yeah, so I mean, I think about the way that we created our fund, right? The ARCA US Treasury Fund has a portfolio of US Treasuries, and we're not a tokenized, treasury fund. We've got a, mixed, portfolio that we manage actively, going out the curve. Our mandate, as in our prospectus, says that we could trade out, 8 years. We traditionally are now on the front of the curve, 6 months out, basically. But essentially, what we've created here with this token is something that we believe is both an investment vehicle, but also can be used as a utility function. The investment vehicle component of it really is the evolution of the ETF, right? You've got mutual fund, ETF, and now we've created what we're calling the blockchain transferred fund. The blockchain transferred fund is essentially that portfolio of treasuries that issues shares. Those shares themselves can be held in a MetaMask wallet if you wish. You can receive 4.5% plus yield, whatever we're yielding right now, or you can actually take that and to Sid's point, you could take that and you can actually use that for collateral. You can use that for treasury management. Our thinking on that and the exploration that we've been engaging in is with larger scale financial institutions and trying to understand how it is that they could take those security movements that they have internally and replicate them with a digital asset. And in our case, it's a digital asset security, and there's no ambiguity there because our fund is registered with the SEC, and we registered that in July the 6th of 2000. So we've had some experience in working with the SEC for the past 5 years and trying to do so. So I guess to your point, Peter, the answer is yes. This can be transferred peer-to-peer on the Ethereum blockchain, to satisfy, any sort of a payment or collateral movement, or it can be used as a investment vehicle for someone who's looking simply to, maximize their yield on their capital.
Awesome. Sid, would you say a lot of your, let's say, Maple's users, are they kind of sitting tight in on-chain treasuries or money markets? Are they actively rotating in and out? Is it more like, that's just where they're kind of parking their capital till they see opportunities that are jumping at them? Curious if there's any.
Good question. Yeah, it's a good question. Funny enough, it's actually a mix. So it's probably 50-50. So I would say where it's let's say like a startup, they might have just raised 5 mil in like a seed or seed or Series A, and they just want somewhere to park it. So they're relatively inactive, and they might spread their exposure across a few different providers. Where we see more active allocations, it's is like high net worths or yield funds. So they will sit in it while they're waiting for a better opportunity to pick up. So we recently did like an over collateralized loan, and what we found was some people put their money into the cash management pool for like a week or 2 weeks while they waited for that one to become available. And so that's I guess more of a sophisticated investor and user type of behavior, whereas the different job to be done for your average startup is just keeping their money somewhere for a longer term. So we try and cater to both needs.
Yeah, very cool. Yeah, I'm sure you're seeing some interesting stuff, even like on the active side. Like it'd be very cool to see, and we don't have to go in now, but it'd be cool event like in the future to see kind of what the activity really looks like and how firms are making use and kind of molding their strategies just around. I mean, with the risk rate so high, and like seeing how that is affecting the rest of the, let's say, just loans on Maple and similar platforms. Like very curious how that's going to play out over the next couple of years in retrospect. But always good to ask about.
No, I agree, and I think interestingly, like another use case would be seeing these types of products. Everyone included on the call, those assets being supported at custodians as well, because that's when you start to unlock like those second layer of use cases where maybe their clients can kind of park them there as collateral for borrowing, or as collateral for like mirrored exchange trading, that type of thing. Like I think that's kind of where the puck is going.
Yeah, interesting.
But I would add to that also just, starting off with, DeFi platforms that then can take the nucleus of actually T-bills and actually build derivative products out of it, right? So it's not just limited to custodians on the institutional side, but actually there's going to be a lot of creativity that where these, elements are now going to be put into a different context. And I think we're going to be very surprised to see what actually comes out of that kind of world, because actually this actually the proper tokenization of T-bills is a fairly recent development in that solidity, right? So we obviously have to go down to the nuts and bolts to make sure that it's actually insolvency protected, and then as people can rely on really that asset being there the way that it's described. And now with this being there, I think there's going to be a lot of like different derivatives that are going to start to be created.
Yeah, Philip, and I think to that point, I think that's one of the reasons why we thought that the regulated path made the most sense, right? Because when you're dealing with the 40 Act fund, when you're dealing with kind of a fund administrator, you're dealing with transfer agent, you're dealing with fund accounting and a distributor, you're dealing with all the elements that are out there that are verifying real time that the assets you actually are stating that you have are being held in a custodian, and they're being held where they are, and there's full transparency through the publishing of like a daily NAV, for example. And we think that's one of the things that's super important why we opted to go down the path of an SEC registered product.
I could just add to something that JD mentioned earlier as well. In terms of this idea of new features, new capabilities, there's sort of this concept brewing here where there's new life being breathed into a rather old pooled investment vehicle construct called the 40 Act fund, at least in the case in the US. And these features, some of them are completely new that really haven't been seen before, and some of them are really just much faster and more granular versions of the same thing that's happened in the past. Like take transferability, for example, to authorized holders of a 40 Act fund can transfer shares between each other, but the process to do so in the traditional environment is quite cumbersome and very time consuming. So now we have the same capability, but it's far faster with lower latency and ostensibly less cost. That seems so tempting to think that we can just simply turn that on. And technologically, I think it's true. You can simply turn that on. But the regulatory environment is the real sticking point here, because the type of considerations that they make and the type of threats that they consider and the risks that they consider are quite different when you take the same functionality and make it a lot faster and a lot quicker and a lot easier. That's really going to be the uphill battle over the next year to 3 year time frame.
Interesting. I mean, kind of on that note, on utility and on different jurisdictions, I guess, what are your guys' thoughts on all the stuff we're seeing from the banks on the repo side, on just collateral mobility as a whole? Do you see that kind of, staying with a certain jurisdiction? Are you seeing that? Is that going to globalize? Is that going to offer a chance for all of your products to kind of have a say or kind of fit into a mold? Curious what that would look like.
Well, I think you will see over time, it's not as if this is a new thing, a sort of FOMO in the regulatory community, where some jurisdictions and their regulators will be more willing to allow experimentation to take place or simply allow for products to go live broadly across their economies and their citizenry, and enable greater capability for the investor at the end of the day. And you will see other regulators who have been a little bit more circumspect about allowing those things want to catch up. There will be political pressure applied to regulators that lag in this affair. And it's, I think, certainly the case right now that there's a huge disparity amongst regulators globally in terms of not just their willingness to enable these capabilities and this new substrate of financial services, but also their learning curve and their understanding about how these things actually function mechanically. So we're still, in my opinion, at the midpoint of that journey. We're nowhere near the end state where you have common understanding amongst global regulators about how these things actually will function, let alone a common willingness to allow them to function.
Yeah, I'll mention on top, basically, we are regulated in Europe under BaFin in Germany, right? So, and we specifically went to Germany because of, we believe, some of the hindrances in this space that actually we were seeing in the United States unfold. So we are happy that there's a homogeneous European market that has stepped forward and actually brought out a framework about this. But still, even with the UK and the FCA, there's basically still some dissonance, and it will find its way. And I believe over time, like Mike was mentioning, actually sort of will be a good test bed for a lot of things that then, the legislators in America will actually then be able to incorporate. And I think that they're looking very excited and, curious actually how things might play out in Europe as a result of what's happening right now, right? But, it's really, it's not unclear actually when this is going to happen in terms of homogeneous legislation or regulation, and how far you can actually go and actually bringing out something that normally is a globalized industry, but now in these dimensions, we have to think a little more regionally just because the constraints are there.
I think the capital mobility is interesting because effectively what you're doing when you tokenize this stuff is you're locking it down in the off-chain side of things. So it sits with the custodian, and then you're providing mobility to the tokenized version of the asset. So you have the T-bill, let's say that's the underlying core asset, and then you have the derivative of the T-bill, which is the tokenized version, and that can theoretically move much more freely around the globe, just subject to kind of legal restrictions on transfers and secondary sales. But I think over time you would hope that the natural arrow of development is towards more freedom on the secondary side of things, so that people, effectively, if you think of money in the financial system as a network, like what you want is lower latency and less capital locked up in pockets where it's not really doing anything. Like money is ultimately a commodity, and so it should be able to kind of move freely around the globe and go to kind of where the best commercial opportunities are available. So I hope to see a lot more kind of cross-border repo transactions now that you have these tokenized low risk or lower risk instruments.
Yeah, I mean, and to build on that, I mean, our vision is that anytime that you see a securities movement in any sort of financial institution, our vision is that that's going to be, tokenized at some point, and you'll be using a tokenized version, whether it's our coin, whether it's, other instruments that are out there right now, in order to increase the efficiency, to lower risk, and to, effectively ensure that transferability and time are maximized in both ways. And if you think about the way that the financial system works, we talked about this on the prep call, kind of there's cash and then there's securities movements. And, the securities movements really, are something that's very, very ripe for tokenization and for the ability for folks to really mitigate risk by increasing transparency, transferability, and time as well.
Interesting.
And maybe to add maybe the consumer here, right? So, I mean, so far the crypto space has been obviously sort of, driven by believers in cryptocurrencies, and that's great, and it has led to this great marketplace. But we're already seeing the early innings of actually trade finance coming in, and basically sort of using that automation and the sort of the digitization abilities to actually just do a much faster settlement when it comes to sort of goods and products movement, et cetera. And I think that is going to be a huge driver. Like it just surpasses in orders of magnitude actually just the cryptocurrency market if you actually capture a couple of percentage points of that market. And I think we're going to see like tokenization being driven by that more than just tokenizing a piece of real estate. It's going to be really efficiency gains of actually dealing on a global scale with trade finance, rather than actually sort of thinking about replacing a financial market ecosystem.
Yeah, I like that you mentioned the trade finance option, Philip. I think like the repos seemed maybe they still are to be the low hanging fruit or the Trojan horse. Trade finance and letters of credit. I know like Citi was doing a fair amount of work with that, and I've rolled it out more formally. Next up is probably like securities lending and anything in that nature. And then beyond there, I don't know, things in the alternative space. I think it's TBD, but it's all moving in that same direction. What I think is really, a big question in this industry, and maybe this is a little removed from even this topic, but how do these on-chain products really get distribution? I just held the fireside with Mike's colleague, Mike Reed at Franklin Templeton. And we had, Benji Investments on the retail side, Benji Institutional, or maybe not Benji, but the institutional interface. Like, I'm very curious how you guys are finding, is it organic users or banks or asset managers looking to diversify? Is it on-chain companies, DAOs, just firms with their treasuries looking to work with on-chain products like this? Or is it really like more formalized on the banking side, on the traditional side?
Well, our experience so far has been that there is interest from, we'll call them native actors, crypto native actors, whether they're individuals or whether they're businesses that are really hinging their businesses on these technologies. That's where the natural interest is, in the idea of, well, I'm going to use these technologies to drive my business, and I'm going to traffic in cryptocurrencies. Well, I'm going to manage my treasuries with something that's on chain as well, that I can use all the same tools and have all the same benefits that I enjoy with a cryptocurrency. Now, having said all that, we're at a sort of a version 1 of the big picture of distribution capabilities. We are currently permitted with 40 Act fund to distribute directly through our broker dealer to clients. We're not yet permitted to distribute through third parties, and a third party distribution model is the norm for certainly our business and the general industry of gold investment vehicles and public vehicles at that. So that's going to be a pretty major unlock when the regulatory community, as well as the distribution community, realizes the efficiency gains that can come from stripping out intermediaries that no longer need to reconcile the movement of shares from an issuing transfer agent to a distributing broker dealer or a network of broker dealers. That goes away with these technologies. When there's a broad realization of that, and the kind of, improvement in just quality and accuracy, not to mention the stripping out of an unnecessary intermediary, along with a regulatory embracing of that style of distribution, I think you're going to see a sort of a step function in the distribution of these things, particularly in the United States.
Interesting. And Mike, is that, I don't know if you could say, but is that third party, is that pending kind of something on your end, or is that on the regulation side? Is it just other brokers that are not necessarily comfortable or confident dealing with the technology yet?
there's not enough regulatory clarity in the United States on what licensing exactly is needed for third-party distribution of tokenized securities. So as it stands, there is only one entity on the planet that's been granted such a license, the special purpose broker-dealer license to do so. However, that's not a live platform. So there is a regulatory journey to go through there, and I think that's achievable. I think that it can be demonstrated quite simply that this is a more reliable environment, a safer environment with better information security qualities than single databases held by a variety of different companies that have to be reconciled together with each other and then come into sync with each other periodically. This idea of a shared data state on public blockchains is simply a better solution to that kind of data synchronicity between different entities. That's the sort of, call it compliance / regulatory gate to go through. And then there is the need for parties to come to bear as third-party distributors, broker-dealers. There are businesses that we all know that handle cryptocurrencies and exchange and offer cryptocurrencies as broker-dealer type entities that can do this, but they need to know from our regulatory friends exactly what type of licensing and registration processes they need to go through.
So Peter, for all the reasons that, Michael's mentioning before, we opted to set up our fund as a closed-end interval fund. And some of the benefits of our fund, which are very different than, kind of the product that, that Michael has, is the fact that our tokens are allowed not only for subscription and redemptions, which happens through the fund, but we also are allowed to peer-to-peer trade these on the Ethereum blockchain. So anybody who themselves is, whitelisted on, for our fund through our transfer agent has the ability to be in receipt of these actual tokens, digital asset securities, and they can move freely from, Philip's, wallet to Sydney's wallet, from my wallet to yours. And that, kind of for us is a really, really, really big thing because it allows for us to, kind of mitigate that entire concept of distribution, right? We've got a fund distributor, we're required to, we've got some distribution agreements in place that the fund distributor authorizes, but our tokens can be transferred freely from anybody who's whitelisted, which really, is a super, super cool feature. And one of the things that, we had thought about, early on. The final leg of the stool for us is going to be able to trade our tokens on an ATS. So then you'll have 3 different pools of distribution. You'll be able to really, kind of, or liquidity, I should say. One's through an ATS. The second is peer-to-peer transferred on the Ethereum blockchain. And the third is to redeem those through the actual fund itself.
Okay, interesting. And Mike, you mentioned, let's say going through third parties. JD, you're mentioning the ATS listing and all this. I don't know if you guys were able to see the liquidity panel yesterday, but even OTC Markets Group was talking about their inter-dealer quotation system and basic routing orders to a bunch of different broker dealers and how now they support digital asset securities as of May. I always thought that was for the last few months, thought that was a pretty big deal. And that's something that, kind of flew under the radar for a lot of people in just the general capital markets. Do you think that would be as big a deal as, maybe it sounds on paper? I mean, if that could be a central distribution point that is now going out to all these different brokers, I guess it may come back to the same regulatory comment, Mike, but, curious if that's something that we should all keep an eye
on. There's no doubt in my mind that the capability brought forward by a public blockchain where you have this common data set, basically, that all actors observe the same state of information at the same time. It's just a materially better data distribution mechanic than everybody running their own databases and trying to synchronize those things together periodically. That's at the real root of these capabilities. So everything you just said, Peter, is certainly possible technologically. The rub right now, and why I think we're in the middle of this whole journey, is because when you have the authentic system of record on chain and you're not putting that somewhere else, so that you're actually presenting something new to a regulator, they are being very circumspect about the features that are being enabled for that. I don't think there's any obstacle to these things being enabled over time, but they're certainly looking to take a baby step approach to enabling these things step by step, so that they can fully understand the systemic risks and fully understand the actual ramifications of these products before they become a very significant part of the global economy.
And to that point, I think, it took us 3 years in intense conversations with regulators to get to that state. And we're thankful for that clarity that Mike was actually referring to, that we in Europe now know how to distribute, and we can actually deal at this point with third parties, and we can start the ignition of these businesses, which is a huge deal, right? Because in the end, it's about bringing these things into the real life of people, and connecting them with the way that they can normally spend with a credit card, possibly, right? And it's not like this distant system that is away from everything else, but we need to actually get the clarity to put it into the daily lives of investors and users and anything in between, right? And the other piece I think to mention is that we as an industry, obviously, because we hadn't been there yet, we have not been able to yet work on the simplicity that actually is then required to actually make everyone feel as if it's just another investment platform. And it's not something where you need to know what a wallet is. We just recently had, crypto custodian licenses really clarified also in Europe. So, that allows us now to actually sort of build, technology and user experiences that basically look as if you're signing up to a Web2 portal, but underneath, obviously, there's a very, very different guts of the system that then carries all the benefits and then brings them forth into that experience.
We talk about this a lot, in fact, and I really like the point that you're making there. It's almost like there's a new type of interface going on here. When you think about Web3, we've got our user interfaces, right? In our case, we've got a retail-oriented user interface. It's a mobile app, and an institutional-oriented interface. It's a web app. And then we have programming interfaces, as you might classically think of them. There's really a new type of programming interface inherent in this, which is this idea of signing transactions and submitting them to blockchains to interact with smart contracts. And so that can be done in a more decentralized manner than a traditional programming interface through a centralized web server. And I like to think of that as a new type of interface for these things to come about. So we can have kind of our cake and eat it. We can have an interface that hides the technology from an end user, a retail end user that really doesn't care that there's a blockchain involved. And you can go all the way to the other end of the spectrum where you're dealing with a programmer who wants to deeply integrate some kind of trading system to a financial product, or orchestrate some kind of programmable functionality, recomposability of these instruments that are being represented in token form, and everything in between. I think that is really the big picture of what we're all trying to achieve.
Definitely. Is there any key, I mean, this could be an endless question, any key infrastructure components that are missing or that just have to be upgraded, or do we really have like a minimum viable digital system, in our hands today?
My view, it's on and off ramps and number of stable coins. Like, just the quantum of stable coins is too small. Probably needs to be like 10x higher. And then we just need ubiquitous on and off ramps. So I think particularly like the main way today is you have to on ramp into USDC through Coinbase Prime, send it to a wallet, and then you can purchase these or access them through smart contracts. But I think we need more different gateways to do that, and we have a very narrow kind of a narrow funnel at the moment.
Yeah, Peter, I think that there's generally speaking a lack of standards, across both geographic locales, industries, and the way that folks are approaching things. I feel like there's a whole slew of different, banks that are looking at, the way that they want to deal with, tokenized treasuries in a very, very different way. I think that there are standards that need to be adhered to. I think there are standards that need to be implemented. And I think that, kind of if folks were able to be a little bit more cooperative and stop working in isolation a little more, I think that we'd start seeing some greater steps forward right now. And I'm not pointing fingers at, institutions specifically. I think it's because of a lot of different regulations that they need to step through. Things like, the conversation regarding the private blockchain and the public blockchain, and, what folks can actually deploy on as well. I think are, some of the things that are creating the friction that exists within the marketplace. But common standards throughout the industries, I think, would allow for a lot more progress made and a lot more faster.
I'd just like to echo what Sydney said earlier. I think it is something we certainly face as a challenge right now, and that is what we call the cash leg, for a subscription or a redemption, is incredibly slow and painful. It relies upon the existing banking system. Now, there's efforts underway, as you all know, to speed up that banking system, but it's nowhere near close to the kind of latency and speed of transfer that's going to be necessary to keep up with the capability of these tokenized products in the future. And I think it's just a pain that we're going to have to deal with until there's a critical mass of activities taking place natively on blockchains, and you don't have to go back and forth through a banking system so much. The other thing I'd really highlight here, and it's more specific to pooled investment vehicles, is fund administration and market availability or market hours. If you sort of think about the lowest common denominator of these instruments that have been purchased in a pooled investment vehicle, those instruments are only available certain times of the day, certain days of the week, usually excluding holidays, depending on the marketplace. And so a pooled investment vehicle can't come in and out of any instrument that it buys and sells outside of those windows. Those things have to be modernized as well before we get to this kind of, target state solution for the entire financial services industry, where everything is 24/7 by 365 and happens more or less in real time.
Sure, makes a lot of sense, and I think that's probably why banks are looking at even tokenizing deposits if they're going to look at their own internal digital systems. Like, you need some mechanism. I think people are starting to think that, myself included, money markets or treasuries could just help rotate out of stables in the meantime. But I also see value adds for each of them, just simplicity wise and whatever. But listen, guys, this has been amazing so far. I know. We're coming up on, I think we got like 5-6 minutes left. There's a question, and I got a couple. So actually, let's kick it off there. Question for Philip. You mentioned you specifically picked Germany. Why not Switzerland with its pro-crypto regulation? And do you plan to expand to Switzerland?
Oh, so we're big fans of what Switzerland has had historically and how innovative Switzerland has been. But in fact, actually, I'm in Liechtenstein because actually the mother company is actually in Liechtenstein. So we started coming from the United States in Liechtenstein because it was much more advanced as a small jurisdiction to actually have a much more comprehensive view. The reality, though, is that with MiCA coming in, that Switzerland is going to be an island within the regulatory environment around it. And you cannot just passport a regulatory situation in and out of Europe at that point in time. So a lot of players that traditionally were outside of Europe will have to actually build a local regulatory presence for dealing with crypto asset values. And the same will actually apply to Switzerland. So I think this is just a choice of, like how big the market is that you can service with, simplicity. And I believe that Switzerland will find a way to actually sort of be compatible, but it will take a little bit of time, just realizing that MiCA, as dealing with crypto assets, has just been established. It's going to take effect actually to the end of next year. So there's a lot of regulatory work for a lot of companies, much more companies from a numbers perspective than today actually have been going successfully through the regulatory process. And that's going to be effort after that. So it's going to be like two before that can happen.
Bill, I was going to say, do you think it will turn out that MiCA has perhaps overdone it on the regulation? Like, I know it was one of the first ones.
There's a lot of elements that we luckily got out of MiCA, which didn't take place within MiCA. I think it's striking a good balance right now. I mean, they were even talking about hosted wallets and sort of, kill switches for smart contracts and, and basically, preventing Bitcoin from existing because it had, no ESG sort of data associated with a lot of silly things, right? But I think that the benefit of all this is right now there is a large part of, economic value markets that basically now can deal with regulatory confidence. And I think that will actually, I call this sort of the Brussels effect that, we've seen in data that basically Brussels with data regulation had an effect on California, had then an effect on the wider United States market. I think similar things are going to happen here, where the trial bed or test bed of what we're being able to do here in Europe is going to actually educate the legislators in America to maybe look a little more favorably into these things. But if we don't do this right, then obviously it won't happen.
All good insights on the regulatory side, always appreciated. In terms of the market phasing, I think we may have touched upon this altogether, but where are we in the industry? And with regards to this topic specifically, how is this kind of acting as a stepping stone to the next phase of ultimate adoption and what that looks like? I know super broad questions, but I think there may be some cool answers.
Well, I sort of touched on this earlier. I think we're at an early innings of the entire journey. Certainly from a capability perspective, and this idea of some kind of uniformity growing across the globe of regulatory entities, regulators. So that's one way to look at it. The other way to look at it is how long until a certain proportion, a critical mass of existing instruments and products of all sorts of financial services migrate to using these type of technologies, blockchain specifically. I mean, quite frankly, I think that's a multi-decade journey at best. You're going to see a lot of inertia there. But as I said before, there'll be some kind of a hockey stick tipping point or inflection there when it becomes just abundantly obvious that certain capabilities and features are trivial to implement using these technologies and just vastly quicker, and in the end, a lot cheaper at scale. I don't know exactly when that'll be, but it's not going to be in the next couple of years.
Anyone else, any opinions to vest before we close it out?
So the idea of tokenization has been around for like nearly a decade now, right? So I think, people tend to forget that there's a lot of heavy lifting that has already been done in terms of like getting clarity. And still, I agree with Michael that is just happening, and now we're going to have to see how that manifests itself into tools and institutions. And we know institutions are slow on these things, and they need to take care of custody first before they actually can create new offerings on the digital asset side for their customers. But I think it might be actually I'm a little more optimistic that it's not going to be a decade before we're going to see some significant things happen in comparison to what the crypto market was. So in terms of like, it may be a blip on the radar in comparison to what the overall financial market is, that it's not going to take over the entire market on that side. But I think it's going to be significant from actually the importance of what, this segment carries for the overall application of blockchain and technology into the financial market space. So, and that is not necessarily just digitizing something. So it's not like taking the New York Times and putting that into PDF and sending that out by email, which is already great, but it's actually creating products that actually look more like, the New York Times today, which is a very different product than the print product, right? So it's up to us to really make that shine and not just be cost efficiency, because in the end, if the institutions get paid the fees that they get paid, they couldn't care less in transitioning over to this. Actually, it's more like a new product that we all have to create together now that these elements are in place. And I think that's going to be the exciting piece of the next 2 to 3 years.
Yeah, absolutely. I mean, plenty of room for them to eat too. The institutions were seeing that, and eventually we'll see savings pass through, and that's good for the bottom line. But listen, gentlemen, thank you all so much for joining. Mike, JD, Sid, Philip, amazing conversation here. Great insights across the board, even outside the topic of Convo. Hope you can stay around for some other panels, and looking forward to more to come.
Thanks, guys. Appreciate it.
Joined by Meredith Sapp, Director of Business Development, Digital Assets at Wisdom Tree. Great presentation earlier today, Meredith. And Anthony Morrow, CEO of Providence Blockchain Foundation. Always on the up and up. Love covering both your firms and our research, our reporting, and of course, talking to our clients about all the amazing work. Listen, this is going to be a great discussion. I mean, there's so many avenues to take. We have Wisdom Tree's approach with Wisdom Tree Prime. Obviously, Wisdom Tree is a firm that's kind of seen the evolution from individual stocks, bonds, other products into ETFs, and now into mutual funds, and now into ETFs was the original goal, and now into 1940 Act digital funds. Amazing stuff there. And Providence Blockchain is definitely a professional or financial services built out layer one blockchain, a lot of different partners, a lot of name brand partners, building on the asset-backed security side, on the private fund side, even on the tokenized deposit side. So always some fun stuff. Why don't you guys, just quick intro just for the whole crowd. We'll keep it nice and short, but Meredith, if you just want to kick it off again.
Yeah, sure, absolutely. And thanks again for having me. Meredith Sapp, Director of Business Development at Wisdom Tree. As Peter already kindly introduced us, a $95 billion global asset manager based out of New York. We also have a large European business. Traditionally, historically, an ETF issuer, and now we're really investing in blockchain technology and particularly tokenization of real-world assets. So thanks again for having me. Looking forward to the conversation.
Fantastic.
Thanks, Peter. Hey, Anthony Morrow, CEO of Provenance Blockchain Foundation. We are a sovereign layer one built in the Cosmos ecosystem, and we are a public chain, but we're properly permissioned and built specifically for the regulated financial services business. We think our governance and our technology makes us the chain that's going to certainly be a large player in financial services going forward. As a result of our technology and our governance, we believe the largest public layer one by the metric of financial assets outstanding. Some people call them real world assets. I like to debate that term. If you're talking about digitally native assets, or do they exist in the real world or not, maybe we can talk through that a little bit. But I spent my career, if this is Maxim joining, 20 years at BNY Mellon, running various security servicing businesses. And then from there, I went into a publicly traded New York Stock Exchange listed REIT, and then found my way into Provenance Blockchain a year and a half ago.
Fantastic.
Great.
Thank
Apologies, everyone. So yeah, go on.
Hey, Maxon, how are you doing?
I'm doing well. Apologies for the technical problem. We tend to block everything, as Anthony probably know, because he spent some time on the melon. But yeah.
Sure, of course. If you want to give a quick intro, and then we can go back and forth kind of on some topics in the next half hour.
Perfect. First off, apologies again for all the trouble. My name is Max. I work in our digital partnership and strategic investment team at Bank of New York Mellon. I sit here in London, but majority of my team are based out in New York, in the US. I spent some time at Barclays Corporate Strategy, previously trying to write up their digital asset strategy. Before that, I spent 3 years at Finastra trying to tokenize syndicated loan. Back then, when tokenizing wasn't really a cool thing, but yeah. So very nice to meet everyone.
Awesome, and this is an interesting blend we have on here actually, because WisdomTree is an active issuer, Provenance is connecting that via on the chain level, and of course BNY has to act as that base level on the custodial side. Also, the Barclays reference, obviously big news a couple days ago with JPM and with BlackRock. So, I mean, it seems, Anthony, I know you love in your pitch when people say, when are institutions entering, and they're already here. So I figured, to kind of keep it high level and kind of keep it based, what are the real conversations being had? What are some of the cooler use cases that are really taking off or finding traction? And where, I guess, should other institutions look? So Anthony, maybe you even have the best boots on the ground view of this.
No, fair enough. And yeah, certainly WisdomTree is absolutely one of the best use cases, but I'll let Meredith, I won't steal her thunder. I'll let her speak to that. I think the only industry, the only asset class that has been truly disrupted so far by blockchain is the consumer credit, home equity line of credit space. If you think about it holistically, Figure and 10 of the 20 largest HELOC originators who are using Figure's technology, all built on Provenance, equate to about 6% of all HELOC originations in the United States. So if you think about 6% of an industry, you could make the case that it's the first one to be distributed, right? I think every other industry is probably less than 1% of assets have been put on any blockchain, whether that's fund services or private equity or you name it. HELOCs have been disrupted. And the reason that it's gaining so much force and speed is that blockchain makes the process cheaper, faster, and very importantly, safer than the traditional financial services model. Using the Figure and its movement mortgage, home rate, guaranteed rate, again, 10 of the top 20. Generally, you log on as a homeowner into a Web 2 experience, great UI UX. You can apply in 5 minutes. You can get funded in 5 days. And while all that process is a good UI UX in Web 2, the loans are ledgered on the blockchain, and that creates some nice efficiencies. But where the real efficiencies come in is when you warehouse the loans and then you securitize the loans. You can take 150 basis points out of the process because of the immutability of public blockchain, the cryptographic proof of the loan. You don't have to go back when you're buying a pool of 1,000 loans and re-audit 1,000 loans. So that takes an immense amount of time out of the equation. It also takes an immense amount of cost in terms of funding the warehousing for that period of time, especially in this high interest rate environment. And at the end of the day, what it allows you to do is if you take out 150 bips, you can offer lower rates to homeowners at the end of the day. So you start to do a bit of societal good that only blockchain can enable. And then all these securitizations, there have been 4 or 5 or 6 now rated, first ever rated securitizations of blockchain native assets in the history of the world. DBRS Morningstar rated them, and like every other HELOC tranche, there's a AAA tranche and a AA junior tranche, and they get sold off in $300 million tranches to institutions. Now they get sold off to like every other ABS, to a small handful of institutions. And selling a $300 million ABS in the ABS world isn't a big deal. But I would just pose it that if you took that $300 million rated ABS and you sold it to 3,000 crypto wallets, the crypto press would go crazy because it would be the biggest, coolest thing ever. We're not there yet for retail. It's not a retail audience. If you can sell institutional, you can sell institutional as opposed to retail. It's just easier. But these are real world examples of how blockchain benefits society, plus how blockchain is getting distributed institutionally.
Fantastic, holistic overview right there. I love it. And I think that's a key thing. I'm going to steal one of those lines for the keynote later on today, if that's cool with you. No, awesome insights. And I agree, the ABS side, like if you can start seeing savings, as you're talking about, 150 bips is no laughing matter when it comes to the mass size. And we see blue chip investment banks getting in on the underwriting side. And we always talk, Anthony, about the inputs and the outputs moving more and more digital as a whole. And that's, I think, we'll see those eventual real savings, like in the full, end-to-end digital side. So pretty cool. Awesome. And Meredith, if you want to talk a bit more about, WisdomTree Prime, but even anything beyond that you're seeing that obviously, don't tell us stuff you can't talk about, but if you're seeing anything like in the future roadmap, we're all ears.
Yeah, absolutely. I would just add to what Anthony was saying too. I mean, I know in certain use cases, going to retail is really difficult, but in our case, that's our heritage, and that's what we've done for many years. So actually for us, that made a lot of sense for us to start with retail and then go up market into institutional, which is what we're looking to do next year too, from a roadmap perspective. But from a retail perspective, we saw that as an opportunity with building out tokenized exposures in fixed income and equities, but also as one of the largest gold ETP managers to also do physically backed gold, actual tokens, not funds, and deliver a lot of those types of savings, efficiencies to what Anthony was saying for his process, but then directly to retail investors. So for us, gold through WisdomTree Prime is really exciting because it trades 24/7, 365, nearly instantly settles. Again, it's physically backed gold, able to be physically redeemed if you so choose, but it really is just a better way to hold gold, which is exciting for us. So as you start to think about that progression from traditional financial markets and products into blockchain and tokenized products, that's a great example and kind of our North Star of what we want to see the rest of our fund suite start to move towards. So we're excited about that. But for WisdomTree Prime, we're solving the problem of distribution and of access. So there's all these tokenized products out there, but how does someone, a normal US retail consumer, consume them? They are not comfortable with managing their own keys. They're not comfortable using a MetaMask. They don't really know how it works. So how do you make a really easy, slick interface to consume these tokenized assets and build out the ecosystem where frankly, the retail investor doesn't even know that they're using the blockchain and they're using the blockchain. It just is a better way to invest. It's just an easier way to get access to different types of exposures. So that's what really excites us. But on the institutional side too, I think from this tokenized assets and real world assets, there's a lot of use cases for treasuries. I'm sorry that JP isn't on here today, but just what they put out yesterday with Barclays and BlackRock for collateral management, but even just broader use cases around securities lending pools, et cetera. There's a lot of different use cases that I think we'll see value over time. But we're still in that early adoption cycle of where we're moving from POCs, so proof of concepts, into commercial opportunities. And I think that's what's really exciting right now, is that I think we're on the cusp of that as we go more into production and as institutions are more comfortable building and actually executing these in real time, we're going to see more of that scale and that efficiency. And I think then adoption is really going to grow from that.
Yeah, fantastic. And from what it seems, it just makes, it makes everything a lot more actionable, I guess is the word to use. Having them on chain with the whole vision that WisdomTree's built out here. I remember even from the payment side, right? From the payment side, all that. we mentioned JPM. We know all the repo transactions. We know securities lending is not too far. Trade finance is another great case. There's so many that are just going to keep popping up, I feel. And then these are all little, not little, these are all niches in very big markets that are then just going to slowly but surely kind of steady and capture that market share. But yeah, Maxim, would be very curious to hear kind of what you're seeing on the BNY side and what you guys have your eyes on, or if there's anything kind of mutual that you're able to share.
I think to Anthony's point, Meredith's point, I think a lot of the use cases that they mentioned is something that we're definitely looking at. From I guess our side, from a strategic investment perspective, to be honest, we've been looking at the market for some time, and a lot of it comes down to think about operational efficiency. When you think about doing a trade with financial transactions, for example, there are three things that come to mind, right? You first need to have the information, and then you need to have the asset tokenized, then you need to figure out how do you then make the payments on the other side. So we tend to think from that fundamental level perspective, right? So try to figure out what kind of assets are we trying to tokenize, and then try to figure out, how can we then facilitate those payments, as well as how can we facilitate those information that is relevant from those assets perspective. And on top of that, once you have those exchange become more, I would say, efficient, that's when the operational efficiency starts coming in, when your information flows better, when asset can settle quicker, as well as payments can move, DVP, for example. So I guess there's a lot of use cases around that. So a lot of the use cases that both Anthony and Meredith mentioned there are things that we're looking at in that sense, or that we dare say to like what the market is looking at as well.
Okay, awesome. And Maxim, we just got that's great background, by the way. Makes a lot of sense. We just got a quick question in the chat. What chain or chains is BNY thinking about working on?
Yeah, that's a good question. So I think they're definitely looking at different types of chains. I think it's very hard to say, one chain is what we're going to go with. I think it really use case dependent. So you could think of all your obvious chains out there, we're looking at, but we're also working with, some chains that are less known, but then they might have some sort of capabilities that we are looking for. So yeah, I'm not going to name names at the moment, but we'll leave it to the team to come up with whatever it is that they're dealing on, because there's no fixed winner per se, I must say.
Sure. No, definitely. Even thinking about like the past, I was gonna say few panels, the past couple of days of panels, a common theme, and even just what we hear from our consulting clients and our advisory work. Where are the actual buyers of these assets coming from? And I've been asking this in a couple of different discussions. Very curious if you guys have any insights just from all three of your perspectives and levels. I know Meredith, you touched upon this, but we have individual retail buyers for certain products. We have a lot of companies who want to raise from retail, but is the market, it's tough macro timing, but we can't really blame that. It's like, I'm curious where the actual distribution channels are coming from. Are there traditional investment banks also now taking on these types of deals? Can I go to like Morgan Stanley's alternative distributions team and have them, kind of shop a deal around? The quality, of course. Is it family office buyers? Is it pension funds? Like, what does that look like? I think we're all ears as to what that whole landscape is sitting on.
So I can start, and then Anthony, I'm sure you have lots of ideas here and might want to respond on the chain topic too. And I should have given my background. I came from Morgan Stanley and started my career at Merrill. So I very much come from the traditional finance space before starting here. We think that retail investors are definitely low-hanging fruit per se in terms of people and consumers who are really looking for these assets and frankly looking for yield, looking for Bitcoin and ETH exposure, spot exposure, and also on the commodities front, again, looking for a better way to invest. And that's really the problem that we're solving there, and that's distributed through our WisdomTree Prime app. But on the institutional front, I don't think that the pensions are there just yet, or endowments or foundations, but definitely on the crypto native firms, the startups that have a lot of cash, idle cash that they're looking for yield and looking for access. I think those that are more crypto native on the institutional in the institutional space are definitely looking for these. And you've seen that as there's been more treasuries come on chain, and the volumes there have definitely picked up. But also from those larger shops that you mentioned, like the larger banks that a lot of us have come from, and definitely BNY too. I do think there's an appetite there. I don't think it's there yet for full-scale distribution, but I do think there is a institution to institution appetite to see how these transactions can be processed in a more efficient way. And I think from there, once everyone is comfortable, we'll see more adoption where there can be distribution through to the wealth channels or to their own retail networks, is what I'm guessing will happen over the next few years. But Anthony, I know that you've also have a few ideas too.
Yeah, I'll double click on some of that. So on retail, the 60-40 traditional portfolio, I think we've shown over this last credit cycle, is a troublesome model for a lot of investors. They wish they had access to alts in a way that they can hold it through the brokerage account or in their WisdomTree Prime app in a way that is relatively easy and a good UI UX. And they just don't have that option, right? You have some crowdfunding sites. You have some direct investment into private equity if you're an accredited investor, but the experience is terrible. Generally, you can't take out loans against your alternative investment, and you certainly can't trade your alternative investment. So generally, you're locked up for whatever 7 years. So the experience is pretty horrible. Blockchain fixes a lot of that. If you're able to spin up an alt asset on chain and make investments homogenous, you can perfect ownership in them so you can lend against them. You can rehypothecate, right? The whole issue around that is you can't double lend. So if you can eliminate the double lending process with blockchain, you've got a big leg up. At some point, the ATSs, there's far too many ATSs in the crypto world, but at some point the ATSs will start to trade on the secondary market alternatives, whether it's the non-traded REITs or true private equity funds. Apollo, for instance, has a very large fund on Provenance. They have their stated intention to build out their entire fund platform on Provenance over time, so that you can log on, for instance, to apollo.com and you can get in and out of their funds as you wish. You can also lend against them because your ownership is perfected. So that's retail. Institutional, I'll say that figure has done $15 billion of consumer credit over the past couple of years. 100% of that has been bought institutionally. It's been a mix of digital securities. Everything is digitally native in, and the out part of it is how you own the investment. It's been a mix of signing papers that say you own a digital asset, and it's been a mix of DTC ledgered assets. And more recently, it's been digitally owned assets. So it's evolving as institutions get more comfortable owning digital assets. They're leaning into that. It is more efficient. It's just a different set of risks than what they're used to. But I would argue that a wet ink signature on a document that's held in the file cabinet at your lawyer's office does entail some degree of risk. It's just different risks. And then, Meredith set me up for the layer one conversation. Yeah, I'm not a multi-chain kind of guy. I firmly believe that Provenance is going to be the blockchain for financial services, financial assets. And the reason being is, again, we're safer. There's a lot of great blockchains out there, but those blockchains have different purposes. They're all generally generic blockchains that require a bunch of smart contracts to be put on top of them to get to a useful state for, NFT art or crypto trading or gaming. These blockchains really can be anything they want to be. Provenance can really only be used for financial services. And because of that, the governance around that, it has to be properly permissioned, right? You don't want to, BNY Maxim doesn't want, 50 cents of its delegator value going to an EVM validator in North Korea, all right? Mm-hmm. So these are the safety issues that a lot of other blockchains just don't consider because they're generic and multi-purpose, but these are the things that Provenance thinks about every day.
Interesting. Well said. Max, and anything from the BNY side about, I guess, distribution? You're kind of on the base level with client accounts, if you will. I'm curious if you guys have had any discussions around that. Just a lot of good insight from Meredith and Anthony on that front, and even beyond that.
I think from a distribution standpoint, from our perspective, we obviously manage, I mean, Anthony probably know this, right? So we probably manage a lot of the accounts on the, I would say at the base level when it comes to who owns what. But at the same time, if you follow how investments are being made today, a lot of all this, TA function, managing who owns what, gonna get abstracted away because, on the line, you would have said, one distributor is owning X amount, let's say 20% of the entire asset, but that distributor will then manage their own ownership list of people who owns those assets, of those fractional of those assets. I think by tokenizing it, by pulling everything into one ledger, kind of just provides better clarity on who owns what, number one. Number two, and also makes things a lot easier. It will change the function of TA in general, which is people who actually manage who owns what. So I think the blockchain really brings out the idea of doing everything on one ledger instead of multiple different ledgers in multiple different levels, which is what's going on today in the investment world, right? From your asset manager, when they create those assets, they break it down into smaller chunks. They split it via TA to manage X amount of chunk, and then X amount of chunk will then be broken down into even smaller chunks via distribution. And the distribution folks are saying that your end client, which is your retail folks, are looking for more specific, bespoke way of investing in assets that they like, instead of just given some sort of set investment choices. So I think those kind of dynamic coming from end user down to how distributor need to distribute assets going forward will change the way we account for ownership, the way we capture those ownership, as well as the way we transfer those ownership. So eventually it will change, I guess, how investments are being made, whether or not they're more efficient in that sense. So that's from Bank of New York Mellon's perspective. We're obviously a huge funds TA. We're thinking a lot about things like this. How would it change the nature of how ownership being recorded? So it's just going from, instead of just being one system transfer from one person to another, you now break it down into, someone will own a digital representation of their ownership. And legally, if that becomes the ownership, means someone will have to manage that. It will have to go to a ledger, for example. So the security becomes a big question, which is to Anthony's point. You don't want someone else in Korea trying to validate the ownership per se. Sorry, if I lose you, just let me know. But yeah.
Oh, you're good. I mean, it makes a lot of sense again. And even just looking at it from a record keeping standpoint, like you're touching upon. I mean, there's a lot of regulatory pushing for, I mean, look, the SEC is looking at T+1. That's been in conversation for a while, but it looks like next year that actually may have some legs to hit that. And I feel like I've seen multiple sources saying, without like a decentralized ledger tech, without a DLT blockchain, how can we really hit T+1? It'll never hit T0 without that. And so when I think about it that way, a lot of major firms their hands may be forced to come to this side of the space. Anthony, any comment?
It's because there's 7 entities between.
Right.
So Peter and I want to. You want to sell me 100 shares of Amazon? I want to give you $1,000 for 100 shares of Amazon. If we do it through my broker Schwab, your broker's Merrill, there's 7 parties who touch that transaction before we can settle 2 days later. The cost of capital of 2 days these days is not free anymore. And those 7 parties exist because you don't trust me and I don't trust you, right? And that's fair, and it makes the trade safe. It also injects a ton of cost and reconciliation and all the agency functions, and certainly the cost of capital. It's even worse when you think about something like a securitization. I think in a securitization, I saw a PwC stat, there's 15 different parties within a securitization, tax and accounting agencies, custodians, reporting agencies, liquidity providers, backup servicers, paying agents, a lot of these things that BNY, State Street, and Northern do as well. And they exist to protect investors at the end of the day, which is a wonderful thing, but they evolved in an era when blockchain technology, shared ledger technology didn't exist. And what a common ledger can do is theoretically, you can give me the $1,000 and I can give you the Amazon shares, bilaterally. I can have on, for instance, on Providence, we have an exchange function, which holds in escrow your Amazon shares and holds in escrow my $1,000 and will only process a trade when it knows that both sides of the trade are able to fulfill their obligations. That happens T plus instant, and there's nobody involved because I don't need to trust you. I can prove that you own what you have, and you can prove that I own what I have. And this is clearly the future. It's just my old shop, BNY Mellon, and a lot of other service providers have, a lot of, technology that they need to adapt to, a lot of people and processes that they need to adapt to. And it's a process. They're working hard at it every day, but it's turning literally, a battleship tied to an oil tanker, and they're working hard at it and they'll get there, but it's a long time coming.
Sure. I mean, what's the delay in like the mortgage-backed security side? 55 days, I think, from reporting, or just from like data to actual reporting. I think that's
well.
the
Think
lag.
about it. Nobody trusts the loan, right? So if you're buying a pool of 1,000 mortgages or HELOCs, you're going to have an auditor go in and audit the entire package, and that takes months of time and a great deal of expense. Now, if you could put all the mortgage docs, and the mortgage process obviously isn't entirely digital yet. You still have liens that have to be filed with the counties. You have a title which is filed with the counties. So there's a huge amount of digitization that still needs to happen in that, not necessarily blockchain, but just digitization. But anyway, what you do is you can put all those documents into an encrypted object store, and you can hash those objects to the chain. And what that chain tells you, it doesn't really tell you what's in the documents, but it tells you those documents haven't changed. The second you put one more character into that document package or do something that changes the data, the cryptographic hash is no longer valid. I'm going down a rabbit hole here, but if you go to audit a package and 99.5% of the mortgages haven't changed, you really only have to audit the 0.5 that have. It just makes that process significantly more efficient at the end of the day. And because of that, it takes cost out. And again, because you're taking cost out, you can lower rates to homeowners.
Nice. Speaking of, we did have one question come in. I assume it's, does Providence value the home, and at what LTV are you lending? And I know it's not Providence, it's the partners that build on it. But I assume they can find all that info at onprovidence.io or at Figure.
So we like to think we're the operating system for financial services. And I liken it to, you get a new computer, you turn it on, and there's no programs on it, and you have to go download Microsoft Word and Adobe Acrobat and all the other stuff that you want. I would think WisdomTree is a program. I would think what JP Morgan's doing is a program. We're just the operating system.
Mm-hmm. Okay, perfect. Listen, I think we got a couple minutes left. Any parting thoughts or anything I missed that I should definitely be asking or that we should be thinking about?
I think from our perspective, I mean, I will say that to Anthony's point about the intermediaries and to just take it one string further, I think this is also about financial access and the democratization of that. So again, being able to bring these assets on chain, being able to deliver them in an easier way, and the utility around that is really what's critical here. And institutions will adopt that because there's obviously cost savings, but then seeing that through to the end investor, I think is where this is really game changing. So as we continue to build, I think it's exciting to look at adoption, and also just to really focus on how this is a better wrapper than what you're doing today within your brokerage account, within what really the limitations of Web 2 are. So lots more to come, and definitely on the utility side, I think that's where this is going to be a differentiator of being able to, whether it's take a loan off of your alternatives in an easy way through a simple app, or whether it's, buy your cup of coffee using your gold or treasuries. I think both of those are just going to change the way that we use money on a day-to-day basis. And that's all powered by blockchain.
Absolutely. Very well said.
Yeah, I'll just add, we're top of the first of a sea change. I think it's the early days of the internet in financial services. There's like one of the stats at $16 trillion. We'll see, right? It's a $500 trillion TAM, total addressable market, that we're all playing in here. And there's no reason that, every investment needs a database, right? It needs a cap table. You learn your first day of security servicing that everything starts with the cap table, right? Who owns what you're selling? There's no reason that every cap table in financial services shouldn't be on blockchain. And I think that's our opportunity, and I think we'll get there because it's cheaper, faster, and safer.
Fantastic.
Yeah, I think I echo the other two panelists' thoughts, right? So I guess personally, this is not being Bank of New York Mellon's thoughts, but how I think about it is financial services is just a giant incentive mechanism. Anything that makes it more efficient, we should think about ways of making it more efficient. And therefore, the incentive mechanism can then work as it should be. So that's just a thought, a very high philosophical thought. But if you go from that, everything else should be quick and easy.
Base layer, yeah. Fantastic. No, most definitely. Listen, Meredith, Anthony, Max, and thanks so much for joining. Thanks for the insights. Be keeping some close tabs on all your firms, and always happy to kind of chat. I'm sure things are going to converge a bit more than we expect. So looking forward to more to come. And thanks again for joining the panel.
Thank you so much.
Good to be with you.
Thank you.
Thanks again.
All right, you'll be live in 3, 2, 1.
Hello, this is Pat O'Meara. I'm the chairman and CEO of Invenium Capital Partners. It's good to be with all of you. Thanks so much for joining us. I'm super excited to be with the security token markets folks and everybody else who's a participant. This is a fantastic event. The speakers are amazing, and I'm honored to be among them. I want to start just by taking a minute as it's been a big week for a lot of different things. We have employees in Israel. We have shareholders in Israel. And I know this isn't the typical way to start, but I think we need to acknowledge the reality on the ground that there are a lot of people hurting who are defending themselves, protecting themselves against really unspeakable acts. And what I'd like to do is maybe take a moment and ask everybody, I know everybody prays in a different way, to just have a moment of silence where we pray for Israel and their defense and all the victims of this past week. So I'm just going to take a moment to do that. I want to thank everybody for joining me in that as we pause for Israel for a minute. And we're here to talk about tokenizing real world assets and the state of that. And in Invenium, we play a critical role in allowing multiple parties across the ecosystem in a cross-enterprise service bus or process automation where everybody's looking at the same data. And, we have a very technical function, everything from the asset to the token, right? We are facilitating everybody looking at the same piece of data so that if we're going to have real world assets trading, we're not building the world's largest referenceable database in the middle, but we're creating financial instruments that can surveil assets at the edge. And that's a technical thing that we do. Then we have some really cool tech. We've been around for a little bit. We've got about just under 80 billion of assets on our platform. We have over 70 patents. So we've got some really cool things that are going. But I want to remind everybody why we're doing this, right? And that's really the topic. The topic is, why does real world asset tokenization matter? And the reason is, if we think about banks and the role that they've played really for the last 650 years, they have played as an intermediary of trust between individual parties, individual corporations, individual cities and policies, individual states, where the mechanism moving beyond barter was a massive shift. And the role that banks have played, where you could deposit your excess capital and that could be deployed to a third party, and everybody agreed to a certain set of rules. I'm going to deposit the money, the bank acts as the intermediary, they deploy that capital. That was invested in innovation, expansion of means of production, civil infrastructure, sovereign infrastructure, technology innovation, whatever it might be, over the last 650 years. And that has been massively impactful in spurring creation and innovation. And these banks acted as a middle intermediary function for that, both to originate deals. They were the arbiter, understanding risk, managing the risk on behalf of the depositor. And what happened is capital markets developed, and there were commercial banks and investment banks, and those investment bankers were structuring things that bankers were involved in, and then other asset managers came in. But at the end of the day, the primary denomination of that thing in which you stored your value was a dollar, a euro, a won, you name it, right? And the British pound, right? Whatever it might be. And you stored your value in that thing. You deposited it or you invested it. And even if you deposited it, it ended up being invested, but you were really taking the enterprise risk of that bank. And in today's day and age, the government for most banks who are backing banking, which we don't want to talk about the moral risk inherent in that, but this is an issue. And this banking structure spurned an enormous amount of growth in a large part of the economy. The problem is there's a whole part of the economy that wasn't there. And how do we expand the ability to spur innovation, creation economically for people to feed their families, for them to be the primary agent of change in their own life? And this blockchain function, crypto is a version 0.2 of blockchain, right? I heard that as Bitcoin is blockchain 0.2, 0.1, and we're starting to get 0.3 and all these kind of other functions, but full on blockchain and tokenization of real world assets, tokenization of securities, where we're tokenizing pieces of the capital stack. I'm really going to say that's 1.0, and we're not there yet. We're getting there, but we're tokenizing real world assets, and we're allowing people to invest their money into a real world asset that will inflate along with the currency. Why does that matter? Because when you're a saver, which is the large part of the middle class globally, and you're a cash saver, you're a native currency saver, right? So you're saving in there. And then that central bank is printing, and there's a monetary policy that is not advantageous to you as a saver. Your savings are deflating every month, every year. We saw massive printing, right? We can talk about, the M3 that's out in the market, what the Federal Reserve did, quantitative easing, and they gave it many other good names, right? To mask the printing of this money that's deflating the value for the cash saver. Now, if you were an asset owner or an asset creator, this inflation, you're protected. But if you're not, literally the middle class and really the lower middle class and the poor are getting hurt the worst. And what we're seeing is an evolution from 650 years of banks being the primary mechanism by which excess capital is distributed for the innovation and creation of economic means being created by individual actors, corporations, entrepreneurs, technologists, governments building infrastructure, to now this global economy where the internet is connecting the supply chain, and we're moving beyond this concept of what's the cheapest place for me to create this thing, this widget, and then I'll ship it everywhere from there, right? To what is the cheapest place for me to deliver the quality widget to the degree it wants to be used. So it's locally sourced, it's organic, it's farm fresh, it's whatever it might be, right? There's no blood diamonds, there's no conflict minerals, whatever it might be. What is the mechanism to deliver that unit to you in the cheapest manner? Now, that global supply chain where the internet has transformed how we think about the economics of delivery, we're also rethinking with blockchain and internet of value how we can deliver my stored value to somebody who wants to use it in this next iteration, where we don't need an intermediary oracle of a bank, where the medium needs to be a currency. And instead, to the degree that we can begin to tokenize a real world asset, and that tokenized real world asset has daily, weekly, monthly, quarter liquidity based on good data using Invenium and Work Great and all that kind of good stuff. But literally what happens is we change store of value. Why does that matter? It allows people to access the capital markets in new, innovative ways where there are not choke points that are controlled by the incumbents who are extracting rents, right? And when we think about financial models, right, I think when there is confusion, there's a profit. That's been a financial model for banking for years. Or where there's complexity and confusion, there's profit for these intermediaries. And what we're doing is using the blockchain as a mechanism to commute trust in I'm investing actually in an asset. And not only am I investing in that asset, so my paycheck is going into multifamily housing. My paycheck is going into a light industrial warehouse. My paycheck is going into commercial real estate. It's going into infrastructure assets. It's going into a portfolio, assets that are inflating. And as long as I can connect that to my MasterCard and I can buy my latte or I can pay my electric bill, et cetera, the role of a bank and a commercial bank is not going to go away, but it's going to change dramatically. Change 100% inexorably, where banks are going to play a role, but they're not going to be that central intermediary. And this is what tokenization of real world assets is doing. It is allowing for a store of value that if we pair that store of value with real-time data and a third-party oracle, and then we attach that with a liquidity function, think of it as an AMM with a pairing of the equity and some type of digital USDC or whatever it might be. And then we can price that asset once a day by a trusted AVM that has a monthly mark for a real estate asset that's done by somebody like a Cushman and Wakefield, who's an oracle that's trusted. Or if we want multiple oracles, we add Regan JLL or CBRE or Houlihan Lokey or Mercer or Deloitte or name somebody. All of a sudden, we have these needed elements where I can trust that my wages that I earn every 2 weeks are being stored in that. And as I'm storing in that, and I'm not a cash saver in an asset that is deflating in value because of monetary policy. Now, we've seen this in Argentina, we've seen this in Zimbabwe, we've seen it in Venezuela. This is how Daniel Ortega took control and created one of the largest middle classes in the Western Hemisphere. He destroyed by printing massive amounts of currency and destroying that middle class instantaneously and stirring up conflict in order for him to maintain power. And what we're going to do is we're going to see people being able to store their value away from risk, perceived or real, and participating in a global economy. And now the dollar's not going away, the euro's not going away, the pound isn't going away, but they are going to exist in a world where Bitcoin is next to it, and Bitcoin Cash and Ethereum and those type of utilities. But not only that, we're going to be able to go in, and I'm going to be able to facilitate a 10,000 unit multifamily housing where each one of those assets is being repriced. I own a piece of that. My paycheck is going direct deposit directly into that, hitting an AMM. And then that's connected to a MasterCard, and I can buy my latte, I can pay my electric bill, I can buy my groceries. Now, when I need a line of credit or I need something that is pure real world, maybe I will have to go in and get a mortgage in order to construct an asset for a construction loan. And eventually, even that, we're going to start to see new types of DeFi protocols that are going to be developing. And this is when DeFi plus traditional commercial banking and mortgage banking is going to be integrated, and an asset owner is going to be able to take their asset, put it online, credential their data. That performance is going to be able to be seen real time. They're going to be able to say, what's the cheapest source of capital for me? Is it a traditional bank? Is it me going into the capital markets, going to the institutional, or can I directly tap a DeFi protocol? And if they do tap that DeFi protocol, you need more than just, Web 1.0 technology going to an oracle who's then giving you a number. You need actually the ability to surveil that asset real time. And what this does is it changes fundamentally the role and what we use to commute trust. And we're able to access data. And you might be, instead of going to JP Morgan to store your value, you might be going to a new type of registered investment advisor. Trust banks are going to develop. You're going to see Wisdom Tree and all of their innovation where you're going to them and you're direct depositing into those assets. But not only that, you're going to be able to go into local developers where you say, oh, I want to invest in that asset. And, one of the things that we've seen in the development, we had
around 200 stock exchanges in the United States 100 years ago. And we literally had 6x the number of public companies. Now, the size of those companies were much smaller, but Minneapolis had a stock exchange, Denver had a stock exchange, Salt Lake City had one, San Francisco did, et cetera. And all of these smaller local firms were there. But then the big exchanges bought up all the small ones. And what it did is it raised the bar of how big you needed to be to get listed publicly. And why is there an advantage of being listed publicly? Because lots of people can participate. People trust the exchange. There's a finality to that trade and that settlement that when I buy on an exchange, literally, even if there's bankruptcy, they're not going to come back and claw that back. We're on an OTC desk. That judicial finality isn't really there. And even though we can use an atomic swap, we're still going to need to have these exchanges that produce judicial finality that are going to allow people to get into this next version where we don't have one stock exchange and you got to be a giant to get there, but different levels of reporting and data so that people can have trust in the source data. They can see it real time. They've got oracles that can define them, just like a bond, right? When you go in and you're buying some bonds, that bond is denominated. Is it investment grade or is it junk, right? Or non-investment grade. You get a Moody's, an S&P, a Fitch, who help you understand where that bond is. The bond funds are denominated by that, and then they literally buy. There's going to be new denominations where we're literally buying real estate, and it's going to be denominated by Cushman & Wakefield. I'm going to buy this type of asset that Cushman & Wakefield denominates on a monthly basis. There's marks given, there's AVMs on a daily basis. But literally, as that then begins to move, we can all of a sudden start to see mechanisms for daily, weekly, monthly liquidity. I'm getting in and out of these assets real time. And I'm using these real world assets as stores of value. And I'm going to different intermediaries, what would have been 100 years ago, the Salt Lake City or Denver Stock Exchange, but where we're going to go to somebody who is the next incarnation thereof, an Oasis Pro, a Rialto, right? Some of these other new exchanges. We're going to a tokenization platform that's going to not only technologically deliver you the ability to tokenize with the needed information, but with the financial expertise to help you understand who the right buyers are. And as we develop this, the data is going to develop where you're going to reverse engineer the capital stack if I'm a developer in Topeka, Kansas, or in Kuala Lumpur, or in Bangkok, to institutional buyers. And I'm not just going to see what are the 5 comps in that local neighborhood. I'm going to see what are the 5 comps in the top 85 MSAs, or metropolitan statistical areas, that are correspondent to that in those countries. Meaning, I understand, if I'm going to finance a building in Eden Prairie, Minnesota, right? What is the nature of that suburb in relationship to Minneapolis, St. Paul? Most people don't. I understand what Rochester Hills is to Detroit, right? I understand what Far Hills or Summit is to New York City, or Greenwich is to New York City. But the reality is, if I'm in St. Paulo, I don't. Or if I'm in Greenwich, I don't know what those right neighborhoods are in St. Paulo or Kuala Lumpur. Now I can get those 5 local comps by a local real estate appraiser of the 5 buildings in Kuala Lumpur, but then we can start to see partnering with these large language libraries and this large compute function of people. Give an example of Inception out of the Middle East with their massive 4 exaflop computer, that they're not only going to be able to say, okay, here's the correlations ASC 815 to these other assets and all these MSAs. And what that does is it gives the local investor the ability to trust and understand and relate that. But not only that, with those correlations, and we're seeing these little trades and all of these pieces, that's the basis around which markets, where you don't need a guy picking up a phone and saying, hey, Jimmy, I got a bond, let me tell you about it. But all of a sudden we have this going. And the reason we see things like our friends please, I have a question coming in. Sorry, I'm not paying attention to those as much as I need to. As we see all of this data being created, what we're going to see is markets that historically have been inefficient becoming far more efficient. I'm going to give you an example. I like to say that the secondary market for taxidermy is more efficient than the secondary market for high yield bonds. And the reason is, if my wife gets sick of the moose head above the family room, above the fireplace in the family room, she's going to say, get rid of it. It used to be 30 years ago, I would hang a sign on the moose head and say, $400 OBO or best offer, right? And I'd put it out then my driveway or on a street and hope people saw it or take an ad out in a local newspaper. Now I go on eBay and I can see what is the clearing price of a moose head. There's good data on the quality of that moose head, and literally I can price it and it'll be sold and gone in 2 days. That type of data and that type of correlation doesn't exist in high yield bonds in relationship to the security package of that piece of the capital stack in relationship to that underlying asset, particularly because the data lags. That data has typically been gathered and collected by a servicer and delivered. And what we're doing is, by literally speeding up this chain, real-time surveillance under the underlying asset, we're going to make the markets more efficient. We're going to be able to price the assets. And as we do so in this automatic market making, we're going to have this ability to change store of value. And this is going to bring about a new mechanism to broaden or democratize alpha, right? Where are we finding value? And right now, people only look for alpha on a real estate basis, if you're a big pension plan, only in the largest MSAs in the world, because you can't deploy money in size. Does that make sense? And so what we're doing is this role of a bank as the primary intermediary changing. And what we're going to do is we're going to see this automation of middle and back office function, transfer agents, security agents, capital calls, expense allocations, the custodian function, all of these, we're going to be automating the interaction. Everybody's looking at the same piece of data, and across an enterprise or across an ecosystem, we're going to see enterprises collaborating on the same piece of data in order to service an asset pre and post trade, giving that price discovery. And as we do that, we're going to see interoperability on chains. We're going to see markets come together. We're going to see the aggregating of liquidity across silos, but also we're going to see more robust nature where pension funds are going to be able to invest in their own states and their own cities and their own developments. And the problem is, you have somebody who wants to build a $50 million asset in Tallahassee, Florida. There's no way the Florida State Board is going to have access or see that in any way, shape, or form. But to the degree that they can post and say, we're going to fund projects that look like this, that person's going to be able to reverse engineer and literally sell on an automated basis into that and have part of his capital stack filled. This is a data-centric, decentralized capital market structure which is coming. But it only works if we have good data on the underlying assets. I want to also say that's only going to work if we are not trying to anchor every piece of data onto the chain, right? And we talk about this all the time, right? In Boolean algebra, there's 4 functions, there's variables, there's constants, there's operations and relationships. We believe relationships and variables need to be in smart contracts, and operations and constants probably are off chain. Now, some constants will be on chain, right? So every pricing model for every trading book in the world, they think they've got the best pricing model. They're not going to put that on chain. They're going to want to price their own options, et cetera, because they think they've got a proprietary, better than everybody else pricing model. Some people won't care and they'll use an open source one, an open AVM, and they'll price that themselves. Those are, think of as constants. And what we're doing is we're showing here through a zero knowledge proof, this is the data that went in, right? This is the source of origin. This is the proof of process, a proof of output, right? This is the data that went in. This is the data that went out. And 5 years from now, we're going to be able to prove that that calculation, which was open sourced anyways, right? If it's in a smart contract, and if it's up above, you're trusting the brand, and they're going to be able to prove to you this was our calculation engine. Even if they don't show it to you, they're going to be able to recreate the calculation, because we're going to prove this was the state of data that went in.
And what we're doing is we're seeing this automation of functions. And as we see these functions being delivered on-chain and off-chain, we're going to see interoperability develop. We're going to see us living in a multi-chain world, and we're going to see banks providing credit as a primary function, but not as a gating function. We're going to see them as a mechanism of on-ramp and off-ramp to payments. But really, that's the story of where we're going to be. So we have one question here talking about where banks will be in post-2050. I think banks that own relationships with their customers, and they own those relationships digitally, and the custodial and the wallet function is going to be paramount. I think banks that people are going to trust, who are going to service assets, and they're going to trust that brand for the servicing, who are going to act also as an oracle on pricing, those guys are going to be around long term. The role of a bank post that, it's going to transform. And the role of trust as the intermediary between polis, corporation, person, states, that 650-year run, it's coming to an end. So I don't know if there's any more questions for me. I think I'm coming up pretty close on the end of this. I want to remind everybody that when I'm done, there's an event. We're asking everybody to go to the booths that exist, and there's going to be a networking session, and we invite everybody to go to that. But Jason, I don't know if I've got any other questions that have come in for me. If there are, I'm happy to answer them, but I think we're coming up on the end of this. And boy, it's been great to have everybody with me.
Absolutely. Thank you so much, Pat, for your insights here, and everyone for joining in, asking some questions, and a great session here. So yes, as Pat mentioned, we do have our networking hour coming up shortly right after this. Please join us in the expo floor. You'll be able to see each other around the floor based on where your mouse is. If you hover over someone, you can even set up a Zoom call to meet with each other. We also have our sponsors booths where you can meet with each of the sponsors, learn more about them, ask them about what's going on in the markets from their points of view directly, and see if there's any room for collaboration as well with you and your firms. STM as well. I know some of you were looking forward to our STM insights. We will be hosting those in the STM booth as well. So go ahead and join us there directly. And we'll be having a nice little conversation on what we're seeing in the markets. And thank you all. Pat, thank you for your time. And that concludes this session.
For myself, and I figured, what's the main thing we should focus on here? We get a lot of questions from our consulting, our advisory arm, a lot of similar questions, a lot of similar challenges we see from the industry as a whole. So I figured, let's take this half hour upcoming to really dive into some of that we're seeing. So I'm sure everyone can see the little presentation on the screen right now. A little about me, Peter Gaffney, head of research at Security Token Advisors. That's our consulting, our advisory arm. We put out a lot of research. That's how a lot of our asset management and infrastructure clients find us. In fact, we are an independent third party, not a bank, not a broker, not a law firm. We are simply an independent group here. And so we've worked with a number of different and kind of anything in between. So that's a little about us. I guess I could have moved it right there. But we're pretty deep entrenched on the research side, the consulting advisory side, the white touch side. And Herwig and I actually covered earlier today the success network that we have, the whole research consortium, where we aggregate a lot of the industry all in one place. So plenty of different options. If anyone wants to get in touch with us later on, feel free to do so. And so I would like to kick it off really looking at the market landscape here. And so when people talk about, at Peter, STA, how big is the tokenization market? I see a lot of reports listing it as like, $650 million right now. I've seen 800 million. I've seen, $1 billion. Of course, everyone sees the estimates up to 10, 16, 30 trillion, whatever it may be. A lot of people really don't realize that there's a few different facets that go into that overall market size. And so we track a lot of the secondary trading data at Security Token Market, STM.co. And that actually peaked at $20 billion in listed assets. And that was probably this time last year, maybe it was like May 2022, I think. But $20 billion. And right now it's actually sitting around 17 billion all in. And that's across, private equities, pre-IPO shares, real estate, certain commodities, and, globally all on secondary listed exchanges and marketplaces. But really, that's just the tip of the iceberg. So that's just the very tip, what's actively trading right now. We know there's so much more beyond that, that either could be tokenized, that's the furthest cohort, that's on digital rails, working with like on-chain fund admins, on-chain management platforms, even like, API'd just digital interfaces that are now connecting to blockchain, because now you're on the digital rails, and soon you could flick a switch and you could be tokenized essentially. Not quite that easy, but that's how we'll talk about it here. And then even closer to that home run area is where you're actually actively issuing products through a broker dealer, looking to raise capital in the primary issuance phase. Maybe you're working with a Goldman Sachs or a JPM or a Jefferies, and you're actually looking, basically having them underwrite deals. Maybe you're working with just on-chain parties and actually issuing new products on-chain, like we see a lot, and we'll cover a bunch in just a few minutes. But that all contributes to the overall market size. And really, I would put that around $95 billion, and that's based on what we see from some of the industry platforms, from some of their assets, from what we hear behind closed doors from our own clients and just some industry partners that we talk to. And again, that's the whole collective area, the whole collective market. And then you also have repos. So it's not really an investable product, but rather we're seeing all these banks, we're seeing JPM, we're seeing Broadridge, we're seeing recently even UBS tokenizing money market funds, HQLAX, different platforms that are tokenizing high quality liquid assets for repo transactions, for collateral mobility. And essentially, that's not something that I'm going to go invest in, but rather it's what the banks and the parties are making use of. Total volume on that is beyond $8 trillion. You could really thank JP Morgan and Broadridge for that number right there, which is tremendous in my opinion, and something going way under the radar. And the other kind of collage, if you will, of headlines here is really just what I like to use to kind of paint the picture of just really look at the firms that are entering the space and doing things tangibly. So not just from a retail offering a security token to raise capital perspective, but really from a whole holistic standpoint on the capital markets. Okay, here's a couple institutional platforms. Take a look at all the familiar faces you see. Okay, and we're going to talk about these in a bit more depth soon. But like, look at Goldman Sachs with their GSDAP, Goldman Sachs Digital Asset Platform. They officially went live earlier in January this year, 2023. Been in the works for some time. They work with digital asset, DAML's programming language, basically a private blockchain solution. And they issue digital bonds. We'll cover a bit more in depth later, but they're already seeing savings that are getting passed on to their own clients and to buyers. That's tangible progress. That's really what blockchain is for. Everybody loves touting efficiencies. And then you ask, hey, okay, where are the efficiencies? What are you seeing saved, or what new assets are you really raising? This is something very tangible through GSDAP. You have Onyx. They just completed BlackRock's first live tokenized money market collateral push over to Barclays Bank. And that's something very tangible. And they're about to hit $1 trillion in total repo transaction volume in Onyx alone. They actually had a keynote yesterday. Feel free to check that out in the recording section too on your own time. We have Citi a couple of weeks ago who issued Citi token services. They're basically tokenizing institutional client deposits to make use of them in a real-time 24/7 Again, think about treasury management, think about collateral management, collateral mobility, and they're even rolling that out to trade finance and shortening those periods from like 5 to 7 days to just a couple hours on the letter of credit side, which is how that whole industry operates. 2 hours versus 5 days, that's a tremendous amount of manual labor, aka salaries and costs on that side, let alone any reconciliation errors that you're saving now just like that. HSBC, similar on the digital bond side. Broadridge, distributed ledger repo, they're doing literally $1 trillion a month right now. I think it's like 30 to 40 billion a day in distributed ledger tech-based repos. They're working with SocGen, they're working with DRW, some very cool partners on there. Equiland also on the securities lending side, rolled out their own, I believe it's called OneSource. It's basically a one-stop shop for securities lending in order to meet T+1 and eventually T+0 requirements on securities lending and settlement. All Funds works with Alliance Berenstein, huge asset manager on the fund admin side. That's another tremendous use case. Deutsche Bank with their digital asset management administration platform, basically digitizing funds. And HQLAX with good backing from like Goldman, JPM for pure collateral mobility standpoints. very cool use cases, some similar, some different. But as you see, really covering the map in ways that I think most people don't think about when they think about tokenization. All right, and so let's dive into just a couple little tidbits that, really catch my eye. And when I'm talking to an asset manager or a bank and they say, hey, Pete, what are you seeing in the market? What should I look at? I kind of have a theme down now for 2023. It's a very recurring, powerful, few bullet points that keep coming up. And so really, it's not just about the democratization of investment access. It's a very strong case, of course. It's how a lot of us, myself included, got into the space, looking at, fractional investment opportunities, lowering investment minimums, really leveraging that whole side for the retail crowd, even for the lower level accredited crowd. But that's just one very specific facet, portfolio construction, if you will. Really, a lot of the initial savings, a lot of the initial value adds of the technology are going to be seen on the back end for a lot of these big banks, for a lot of the blue chip firms, really just on the operational and infrastructure cases. And so I've kind of been coining this saying, I don't know if it's catching on, maybe you all can help me, but you got to save money before you can make money in the institutional side. We have companies, we saw WisdomTree today, we saw Franklin Templeton today, rolling out WisdomTree Prime and Benji Investments, and they're actually raking in new AUM. And that's new AUM, assets under management, for their new blockchain products that they could actually start charging fees on. And that's great. That's a whole revenue generation. That's a whole new source of revenue beyond the typical business lines. I think that's awesome. But I also think there's a lot, we see a lot of hesitancy. Those are two very trailblazing firms. We see a lot of hesitancy from our own asset managers and some similar parties saying, Peter, we like the technology, we see it, we could issue products, manage that a bit more efficiently, but how are we going to actually get the buy-in to make this stuff happen? We can't just issue a feeder fund and hope that's going to solve all our problems. It probably won't. But to really roll out a whole suite of products, we need to see exactly what we're getting ourselves into. And so I've kind of seen it, and we've been kind of doing a 180, focus on the back and middle office upgrades. If you could reduce all the touch points between investor onboarding to actually securing money in an initial subscription, that's tangible savings, much like the trade finance example I offered before. If you could reduce touch points from 30 to 40 touch points just to onboard an investor and bring them down to a couple to 5 or 10, that's tremendous right there. And when you start seeing those savings, that's when you get the buy-in from the executive teams. It's okay, you guys are going to run with this for a year, 2 years, 3 years. And in the meantime, you'll be saving on that back end. We'll figure out how to commercialize it and scale upwards without scaling our headcount. That's a major key. And that's what will give them the freedom to then explore more product offerings, if you will. So that's kind of how I've been looking at it. And that's something that's been resonating with a lot of the asset managers. Similarly, looking at the industry itself, the players, we know there's a bunch of different, not a bunch, there's a handful of different digital brokers, digital alternative trading systems, or multilateral trading facilities, or other recognized market operators, digital securities exchanges, all kind of on the startup side. But there's also a lot of incumbents now coming in, either upgrading their licensing, or even just new firms, legacy firms with tremendous networks and kind of entrenchment, announcing their intentions of blockchain-powered marketplaces, exchanges, solutions, and whatnot. And that's very powerful because eventually these will all interconnect, and you'll start to see real market aggregation on the primary and secondary side, which would solve a lot of the problems that we're going to look at too. And lastly, something, just think about this, why money markets and treasuries? Why is this the one that's now suddenly catching on? Why is this cohort catching on? And we talked about it in a couple different panels, but we'll look again very shortly. So looking at some active samples here, these kind of more or less line up with what we covered on the previous slide. Not just about investment access. Look at JPM. They're about to hit $1 trillion in collective blockchain-based repo transactions and their tokenized collateral network transactions. Let's put those in the same cohort now. They're expecting $20 million of projected savings on 2023 transactions alone, which was actually less than $1 trillion collectively. And so that percentage piece is what it's like 0.0015 bips. It's super small in the grand scheme of things. But when you roll it out at scale, I mean, $1 trillion in yearly volume, the normal repo market does $2 to $3 trillion a day as is. So when you start scaling this up, that's meaningful savings. You can't scoff at that. And if you're on an innovation team at a bank, At either a sell side or a buy side firm, you can't ignore that, because then you're not doing your job. So that's great precedent right there. Even Societe Generale is part of Broadridge's distributed ledger repo platform, DLR, and they're seeing $100,000 in savings for every 1 million repo transactions. I can't say how often SocGen is partaking in these transactions, so I don't know how long that million really lapses time-wise, but at least we have some tangible mark to kind of keep an eye on in that regard. And now think about what I said before when you're talking about license upgrades and new entrants or legacy entrants. You have OTC Markets Group. Cass had an amazing panel yesterday on the liquidity side where she mentioned they have that inter-dealer quotation system where they could actually plug in with a bunch of different brokers. Instead of going investor to investor and routing orders that way, they're going broker to broker. So these brokers are aggregating their own orders, flowing through OTC markets and finding other brokers, basically acting as market makers on that front. That's extremely powerful. We want to bring liquidity to this market, which is what everyone touts eventually. That's definitely a necessary component. And we even saw, Castle Placement went live with their ATS that now supports digital asset securities, just like OTC Markets Group upgraded their licensing, digital asset securities. And most recently, back in September this year, just last month, London Stock Exchange Group announced its intention of a blockchain-powered exchange, kind of exploring, more or less the global cross-border trading and how that could complement their existing business. I mean, they have some of the deepest ties in the entire capital market system. You cannot ignore that. And if you're a smaller broker, maybe find a way to play with them, find a way to get kind of involved with what they're doing, and they'll help aggregate a bunch of volume, and that'll be to the benefit of the entire industry. Lastly, I talked a bit earlier, a couple of slides ago, about the total market size, and that people keep kind of falling on that $650 million mark. That's only money market and treasury assets on chain. And that's a great piece because a lot of the narratives lately are, okay, if the risk-free rate is upwards of 5% these days in treasuries, how can I possibly park my client's money, $300 million of client capital, into a stable coin generating nothing? Or worse, maybe worse, generating something, but in not so professional ways, or just with higher risk profiles. And so that's become kind of a non-starter for a lot of them. And so seeing these on-chain money markets or treasury funds at the rate levels that we are, it's kind of a no-brainer. Rotate out of stables and into these products. I think that will continue because eventually you'll have these end-to-end digital systems, and to really capture all the efficiencies we love talking about, you're not going to capture any meaningful savings if every time you're swapping out of an on-chain private equity fund, for example, you're going back into fiat, or, oh, I got to go buy my off-chain treasury product with my existing broker. Bringing all that on-chain creates that end-to-end digital ecosystem, lets you stay right there. And whenever you're in between investments, you just park your capital right in that treasury asset on-chain, and you're collecting 5% or whatever the rate may be. So that's a very big value prop there. And that's why you're seeing a lot of different flows into these types of products. All right, what are institutions evaluating? So the institutional playbook from us, forget about the widespread product offerings for now. People commonly look at, let's say, the ATSs, they see the same offerings or the same listings they've seen for the past couple of years. They see volumes kind of weak. But forget about that right now. It's not always about the product. Like I said, things you could issue a product, but if things aren't plugging into your back end or your existing operations as a big firm, it's going to be tough to scale anyway. So for a one and done, that's fine. But if you're really looking to commercialize something and issue a whole eventual suite of on-chain products or similar initiatives, you're going to look at your back and middle offices first. Okay, and that's something big, and that's something we just had Pat O'Meara, CEO of Invenium, on here. His whole company, that's the basis, right? Digitizing that back and middle office, allowing fund admins, accountants, tax assessors, investment bankers, commercial real estate appraisers, anyone, valuation agents, to kind of plug in and get permission into a shared database and offer up all the necessary documents. And that's how you streamline your back and middle offices. You're no longer reconciling among 5 different parties, waiting 15 or even 30 days for documents to come your way. You're getting them in real time. The limitation is still that human component, as fast as they can get it physically done, but as soon as it's done, it's stamped on chain and you're there. Okay, something also that's very cool, looking at from the institutional side, investment banks are getting involved in this type of stuff. We had the mentioned earlier, even with Anthony Morris, CEO of Providence, talking about the Providence blockchain-based HELOC offering, got rated by Morningstar, first of its kind, underwritten by Jefferies, JP Morgan, and Goldman Sachs. Jefferies was involved 3 years ago in 2020, and now they're back in the game. An extremely strong sign from a very solid firm, I would say. And this is something that investment banks can do. They should just be taking on tokenized deals and figuring out how the tech really affects them. In Goldman's case, for example, like I said, they passed 15 basis points through from what they saved on the tech side. On the back office management side, they passed it through to Union Investment Group, which was the primary buyer of that bond. I think it was a 100 million euro bond. I think they probably saved just under $200,000 on that. But that's excess capital that flows their way. Again, that was a single offering at scale. That's nothing to scoff at, and that's some serious business. Okay, and lastly, I already touched on this part, but where do we park client money in digital systems? Probably not stables, maybe stables, but really money markets, treasuries, on-chain deposits. We see all the banks doing it. They're doing it for a reason. All right. And as I'm going through, feel free to, any questions, try to type in the chat and we'll address them as we can. So a couple of things that get affected. Again, this is really institutional focus still. Retail is not going to be looking at repos, but that's okay. We'll get to them shortly. So repo transactions underpinned by DLT and tokenized high quality liquid assets, HQLA. There's a platform named after it, HQLAX. Really looking at the money markets, looking at the treasury products, looking at cash equivalents, looking at kind of anything that's in that realm, in that cohort of products, is what's going to be the Trojan horse to kind of get institutions familiar and back offices, middle offices, and even their counterparties who could be trading firms, buy-side firms, other sell-side groups, getting them comfortable with the technology. I mean, even if you want to look at it from a regulatory standpoint, the SEC is expecting T+1 settlement time on securities transactions by May 24th. And, even at the Equiland, I have a screenshot here in the bottom right. They're a service that does security, fintech focus on securities lending. They have one source, the name of their DLT ledger now, to permission all of their major parties in, because they simply don't think T+1 will be achieved when you're reconciling between 5 different parties all the time. Like, you're just going to be at the mercy of any one of the other parties' staff and their speed pretty much. So T+0 is out of the question without something like this. So I'm extremely bullish on that side. I think this is where a lot of efficiencies are going to be found when you look at securities lending at scale. Again, the repo will be the Trojan horse that gets people comfortable and they start seeing, okay, this is how the technology is being used. And then look at that from other business applications. Trade finance, a great example, securities lending, and beyond that, we'll start to see what happens in the alternative space. In general, I'm thinking as firms get comfortable with the money markets and treasuries, eventually they'll be digitizing their own real estate holdings. I'm not even talking, security token offering real estate projects, but rather their own holdings, whether it's their own funds, their own direct commercial properties of extreme value, hundreds of millions, $1 billion each. And they'll be making use of that, maybe not in repo systems, but in different lending platforms with each other, with major federal counterparties and anything kind of in between. So that's something to keep an eye on. And also eventually this will affect portfolio construction, just a whole new world of precision that could kind of come to this, to the whole capital markets. Right. Now, I keep talking about the repo stuff. I'm sure everyone's tired of hearing about it. I think it's very cool. It's a very bare bones type of focus, which is why it's, kind of unique that we find so much excitement in it. It's because look at how it's typically done. A repurposed transaction, you typically have 2 counterparties and they're both negotiating for the better deal for their firm. And so in JP Morgan, Onyx's first repo transaction with Goldman Sachs, shared ledger. Each side saw exactly how the transaction happened, how long it took from initiation, mid-ground to, return of capital of the asset and completion. 3 hours and 5 minutes precisely. No room for negotiation, no room for back and forth. We didn't have one party saying it was 3.5 hours. We didn't have the other party saying 2.5. And on this specific trade, there were interest was accruing by the minute. So to know that it's 3 minutes and 5 seconds versus 3 hours and 5 minutes versus 3 hours and 30 minutes is a huge difference when you're looking at interest that way. And think about that applied to so many other different facets that are kind of like repos, but with different assets, just anything in the collateral mobility realm, and think about it like that. And that's where you really start to see, wow, this is powerful. This reduces any error. This reduces if my team is, struggling to get the better deals on that side, if we're getting kind of strong armed from certain partners that just may be bigger and kind of more powerful in this specific realm, that's where you really start to see a lot of these benefits, and boom, becomes automated. And again, this is going to be the Trojan horse. You're looking at other types of things, tailwinds from regulation themselves. We mentioned the SEC, T+1, and private fund reporting. You got APRA over in Australia mandating better private asset reporting. And there's a lot happening there with their banks, with their asset managers and their service providers. You have Vanguard working with DLT over there to streamline their own operations. And then you have SEBI in India looking at blockchain for covenant testing in the fixed income and lending space. All very cool stuff. And when you think about it from a, kind of a deeper level, like how are we going to achieve all of this? It's going to simply be through blockchain, through distributed ledger tech, and more specifically through tokenization. Okay, a couple, just to take a look at some of the blockchain dominance so far in tokenization. Keep in mind, we had the blockchain panel yesterday, no particular order here, and there's plenty of names that are active in the space. And these just happen to stand out to me pretty heavily. Providence Blockchain, we see what they're doing on the HELOC side, on the asset-backed security side, and eventually on the private fund side with big companies like Apollo. They already account for 6 to 7% of the entire, not blockchain-based HELOC, but the entire home equity line of credit market as is, which is remarkable, thinking about how early this space is and how much they're already capturing on that. We have Polygon issuing a lot on the private credit side, gaining a lot of traction from existing issuers who are now doubling down and kind of expanding their net to Polygon. Franklin Templeton's a great example. And then, even companies that are just issuing digital bonds like ABN AMRO with Polygon. I'm sorry, that was Stellar, but Polygon still has its own, kind of footprint within the ecosystem as an Ethereum layer too. And we're seeing a lot more flow that way. R3 is actually a private solution, Corda specifically developed by R3. They're EVM compatible now too, which is very cool because now we're seeing the flow from private blockchain solutions to, public solutions, which is, of course, one of the great debates in the industry right now. I talked about that in my opening remarks earlier today. Avalanche, another EVM compatible chain, and they're doing some great work. Avalanche Vista, $50 million fund to deploy towards tokenized assets on Avalanche. They have the Spruce subnet for institutions to actually come play around and get familiar. Wisdom Tree's in on that. Wellington, T. Rowe Price. So all extremely cool stuff. And what they're building within the Spruce subnet can then be rolled out to the mainnet on Avalanche, which is huge. Chainlink perhaps having the best Q3 I've seen. I mean, with their cross-chain interoperability protocol, basically bridging the gap, bridging all these different chains and assets with Chainlink specifically alongside Swift, DTCC, some major parties. Keep an eye on Chainlink and their tangible progress coming out. Digital asset, like I mentioned, with Goldman Sachs, with Broadridge, they're one of the most institutional focused and successful so far companies. Really like the use cases we're seeing out of that on the digital bond side, especially Hyperledger. We had on yesterday as well. A lot happening, especially in Singapore. Look at Bond Blocks doing digital bonds, distributing through Citigroup as the digital custodian. That's a huge marquee case that's kind of under the radar. Stellar, as I mentioned, they're already working with Franklin Templeton, ABN AMRO, Block Time Financial, one of our sponsors of the TokenizeThis conference. And they, of course, have built a nice name for themselves. Lastly, Coinbase's Base, who's really taken on they have potential to take on a large share of the market, and they're really making a splash right away. Definitely keep an eye on them and their integrations as things kind of move further on chain. Okay, I have a couple minutes left here, I see. I'm going to check out. So the real question, let's go to the retail side. Where are the buyers? Who's actually buying tokenized products? And so let's look at raising capital from retail is tough. So brokers are still getting up to speed. They're still curating family offices and private banks for distribution. Like I just mentioned, Citi with Bond Blocks is a great example to just take a big firm and go direct to their wealthy client base. Securitize buying up on-ramp invest to distribute like their Hamilton Lane and KKR products to the RIA channel, right as alongside digital asset offerings. That's all great moves. We need to figure out how to connect to traditional investment banking channels, though, in the interim. That's definitely a necessity right now to really raise meaningful capital. I mentioned Providence and the blockchain-based HELOCs, Franklin Templeton, 300 million in assets. That's nothing to scoff at. It's very impressive with their money market fund. Ondo Finance creeping up on Franklin to a certain extent, raising 180 million for their short-term U.S. government bond fund this year alone. They only came live in 2023. And then, a couple of years ago on the retail level, INX, who we heard from yesterday, and Exodus raising 85 million and 75 million respectively a couple of years back. Looking at the secondary markets for anyone interested in the trading side, like I said, it's about at the time of this, it was like 16 billion, the market cap on secondaries. Right now it's like 17 and a half. Trading volumes are still extremely low. The real question is, should these assets trade at all? I mean, not at all, but should they trade heavily? If they're real estate assets, how much are they going to fluctuate? More so, maybe start thinking of things like a bulletin board system, and thinking about it as like liquidity if you need it, rather than if you're really actively sitting there trading, getting in and out of positions. We're coming up on time, I see, but for any more of our research and insights, we have our State of Security Tokens 2023 quarterly reports coming out. Q1 Extended was sponsored by Providence Blockchain. Q2 was sponsored by Coinbase. We have our RWA report basically covering 13 different blockchains and their use cases right at STM. But we'll be rolling out Q3 also, so keep an eye on that one. Very excited for that with our sponsor, and it'll be huge. And always kind of bringing that content out. For anyone interested in talking to us, it's Peter at securitytokenadvisors.com. But that's really all I have right now. Looking forward to the next panel and kind of wrapping this up for day 2. It's been an amazing day so far. Thank you everyone for listening in. Hope you found this all helpful.
Welcoming all of you here, and particularly we're thankful to have Stefan from
day so far. Thank you everyone for listening in. Hope you found this all helpful.
And Timo from Swarm. So gentlemen, thank you so much for joining us today and providing your insights on crypto. Why don't you guys go ahead and give us an overview of who you are, how you got into this space, and what each of your firms does.
All right, Stefan, you want to go first?
Yeah, I can go first. Thanks very much for the invitation, and sorry for my technical issues. I think because of me, we are a bit delayed. My background, so I started as a technical engineer as an apprentice within Siemens, and then I moved quickly into banking at some point. And there I went from operations until investment banking. And then in 2022, I joined Crypto Finance, and there I'm responsible for all the custody related topics, from custody, payments, settlements. These are all the topics which are going over my table. And in the crypto space, I started in 2017. So I started a little bit with trading and trade and hold, and then I started to be a bit doing some DeFi, and so that's why I came more and more into the space. And as I was working with Jan, our CEO, so at UBS, at some point he called me and said, hey, would be nice if he would join, and we had some discussions together, and so that's why I have joined at some point Crypto Finance. And yeah, that's my small and little journey.
Awesome. Well, thank you for that. Timo, why don't you give us your background and what you guys are.
Thanks, Jason. Yeah, great to be here. So yeah, I guess I'm a techie from the beginning, kind of a computer science guy, right? And started coding really early. And over the years, I built 2 software companies, and then I gradually started moving more and more into financial services. So over time, I've been with 2 venture capital funds, and I also done a lot of M&A work with software and tech companies and so forth. So I think looking at how I ended up in crypto and blockchain as a space, I was basically having completed the work with one of the venture funds. I moved to Palo Alto to work with a couple of investments of my own. I was kind of really trying to look at what AngelList had built and trying to build something similar, but like a cross-border thing based on kind of allowing European investors to invest in Silicon Valley companies. So I built that first, and then we built a portfolio of companies.
And then I set up an SEC licensed firm on behalf of a Nordic investment bank in Palo Alto as well. So I kind of got all the regulatory stuff under wraps and understood like how to operate as a regulated entity. And then also one of my investments became a regulated company in Singapore as well by the MAS. So we kind of built a investment banking platform for mid-market private equity deals called Origin. So I was very much looking at like how to improve like efficiency and using like digitization as a means to improve finance in general. And that kind of brought me into the blockchain space eventually. And so, you know, if you live in Palo Alto, there was like all these people, like Barry Silbert was raising his first money in 2014 for, you know, for Grayscale and that stuff. And then a lot of the early kind of Ethereum and Augur founders and other people were circulating in that environment. So it's like very easy to kind of start tapping into blockchain. And so in 2016, I kind of took a deeper look at it, and then 17 started to spend serious time into the space. And in 2018, we started Swarm in its first iteration, and then 19, we moved it across to Europe and basically set foot in Germany eventually, having kind of evaluated a lot of different jurisdictions. It was kind of really hard to understand what you could build where. We were just like very convinced that we couldn't build what we wanted to build in the US. So hence we moved to Europe as a result. And then gradually kind of just set up shop in Germany when they changed the Banking Act. And we got grandfathered into that program under both custody and trading licenses. So yeah, so that's kind of how we ended up where we are today.
Very cool. Some of that narrative, you know, does translate into what you're doing today. It sounds like, you know, you guys are tokenizing some US-based stocks, you know, similar to what you were doing back in the day with the VCs, trying to get some European investors for those Palo Alto companies. So that's really great to hear that translates. I do want to touch on, you know, obviously this is a panel on custody, but before we dive into the nitty gritty, why don't we start with some basics on, you know, what is the purpose of a custodian for those tuning in that maybe are not as familiar? You know, what is a custodian supposed to do for securities and for crypto?
Yeah, so, well, in my view, I mean, obviously, you know, this comes down to safeguarding assets first and foremost. And then, you know, having basically done that as a kind of the most important kind of platform function, then all the auxiliary functions also need to be there, such as, you know, being able to support transactions and asset servicing and stuff like that. So I think, you know, there's a lot of things that kind of from the beginning looks like, oh, it's only like storing, you know, it's basically like cold storage or like, you know, basically the storing of assets, but there's so much more to it once you start looking at what the requirements are on the institutional side. And yeah, I guess we'll be diving more into that later on.
Absolutely. Stefan, anything to add?
I think the most important is that the custodian gives trust to the investors. And I think that's the main purpose, because if you don't trust someone, then you don't give them your money. And I think trust is the most important asset of a custodian. And then, of course, it's safekeeping assets for you, if it's crypto, if it's tokenized securities, if it's traditional finance assets. And then I think more and more it's also giving the trust to the customers that you basically give them or provide them a real in-time and secure life cycle of the processing. If it's transfers to the custodian, transfers outside of the custodian, or are these transactions which are related to a trade, or then comes to also other topics which are kind of reporting, investigations, and so on. I think everything starts with the trust, because when you don't trust someone, you don't give them money, you don't lend a friend of you money, and I think that's the most important asset of a custodian.
Gotcha. So mostly, you know, safekeeping your assets, servicing those assets and transactions, and trust for the investors, which in turn is definitely, you know, something positive for the issuer. Obviously, you know, we want to have those investors, you know, be involved. So great. So now we understand what custodians do. What are the differences between custodying crypto and custodying a tokenized security or a security itself?
Yeah, I think, well, at its core, I think like, obviously, the bearer instrument nature of crypto makes it like kind of a special thing to custody. So, you know, the solutions kind of from a technology standpoint look very different when you look at like bearer instruments on chain compared to digitized securities where you basically have like an owner registry, and it's like there's more recourse to handle different types of situations on the digital security side than it is on the crypto side. So I think those are like the main differences that we see. And then also from a regulatory standpoint, there might be, depending on how you're set up, there are different requirements for that as well.
Stefan, anything on your end? Any differences that you see?
So I get a lot of confronted with these questions from potential clients or also clients. And I come from the global custody in traditional finance. And for me, I think if you store crypto or let's say securitized assets, I think the processes are sometimes a bit different. But I think at the end, if you have these securitized assets, at the end, you need to provide all these asset servicing services. You will also provide in the traditional finance. And I think if you're a custodian in TradFi or if you're a custodian in digital, I think at the end, you need to be able to process all the edge cases and all the corporate actions, which might come as well then in the securitized or in the digital world. And therefore, I think as a custodian, you need to be able to store crypto and to process them, as well as securitize assets, and also being able to process the TradFi corporate actions within the tokens. So, or within,
Sure.
the digital assets.
So that's definitely something interesting. It's something that came up from a data perspective, or in one of the previous, I believe, keynotes. Someone mentioned that not everything has to be tokenized, and someone else mentioned the fact that not all data has to be on chain either. Data on chain is definitely great and for multiple purposes, but not all types of data, for whatever reason. So in this case, walk us through the process of a transaction, right, start to finish, and where in there does the custodian fit, and which parts of those services are you providing that are on chain and which parts are off chain? And it very well may be different from both of your perspectives on what services you provide. So I'd love to hear both versions.
Yeah, I think it might be. I mean, I think on okay, so one of the things that we do that not everyone does on the custody side is basically to support like tokenized public stocks and bonds. So that's a very different type of instrument to like a lot of like crypto in itself, first and foremost, but also to like natively issued digital securities. So these are basically depository receipts for an underlying real world asset, being it call it a bond ETF or like a Tesla or Apple stock. So that process looks quite different. So typically what happens is like, I mean, obviously, the transaction flow is such that somebody wants to buy one of these real world assets, and we then basically support that from a USDC deposit point of view on our DeFi infrastructure. It becomes an atomic swap into our smart contract that then triggers off a purchase of the underlying security, given that markets are open, and then that triggers basically the purchase of that security gets into our traditional securities custodial account. And then that, once the purchase has been completed, then that basically signals the kind of a clearing signal to issue the depository receipt token on the other side. And then that whole process is it's very particular for that type of real world assets. And it's something that we've built so that, basically the DeFi world can kind of enjoy these like non-correlated assets that are outside of the crypto ecosystem and still use them, as we've seen, growing a lot in the last 12 months. Through MakerDAO and others in the DeFi ecosystem. And so we think that's a really key building block, because that's one of the ways that we can expand like the universal value in DeFi. So that's kind of one of the things that we're doing that's quite unique to us.
Interesting. Okay, so touching on that, if I am in DeFi, right, let's say I have a bunch of USDC, you're saying I don't have to off ramp onto fiat, go purchase a security. I can do it all via your services, stay on chain, and have this automated process. But you guys also offer US treasuries, I believe, Timo. So, staying on the theme of like USDC, right, that's what I'm purchasing with. Why would I want
a US Treasury instead, or why would I use that?
I mean, you can just, like in DeFi terms, you can just look at it as staked cash. So USDC, if you look at that as a US dollar equivalent, basically buying a treasury bond ETF is big, because basically becomes like a staking model for USDC, right? So then you get like the bond ETF yield instead of just holding USDC, where Circle collects all the yield.
Understood. And Stefan, what's your process look like? Which parts are off chain? Which parts are on chain?
At the moment, we don't do DeFi at the moment because our clients, we serve mainly banks in Switzerland, and they are not looking into DeFi. But we are looking into solutions for on and off chain accounts, sub-account structures, where we can serve the clients to make their service to their clients at the end more simple and more structured. There are sometimes somewhere also in the traditional finance, there are some markets which are unsegregated in the TradFi. So as we try to serve those markets as well, so we have to look into it how we can segregate on and off chain. That's what we do towards this topic. So, but DeFi is a topic which might come in the future, but at the moment our client base, which our banks are looking into it, but there are no use cases at the moment which they can follow.
Yeah. And like I said, that's why I said in the beginning, your processes might be different. Again, you maybe have different client bases, which is great. We want to be able to service everyone, and to that end, we have to have those different solutions available. Here in the US, we've seen a couple options. Namely, we saw news come out of BitGo and INX, right? They're starting to work together and have customizable wallet management, right? The idea that your RIA, your family office, or VC funds will have different permissions to be able to access some of those assets, right? So you have like a different role based on role permission based on what your role is in that transaction. You could be a viewer, a spender, an approver, an administrator, and that comes with different permissions to be able to, again, kind of bridge that gap between on-chain and off-chain servicing, and the different components that are involved and different people that are involved in that. So that's something that I've seen here. Fireblocks obviously is doing their own thing as well and getting integrated with other players here in the US on an institutional level. We see a Ripple and Medico as well, working there. And Ripple acquired them. So there's that on the US side. But moving on, all right, so you guys have different things. One of you is a little bit more DeFi, one of us a little more traditional in terms of your client base. But it sounds like you both are working towards institutional adoption of these assets and custody. So what are some of the considerations you specifically have to take into account when you're working with these institutions? Stefan, maybe you want to start on this
one. I think the first point is integration costs. I think our client base, they serve at the moment clients in the traditional finance. I think for them it's very important to offer or have a crypto offering where you don't need to invest a lot into infrastructure or program endpoints or connectivities. That's why I think we see a lot of developments in the market that banks, they offer crypto or start offering cryptos. But in Switzerland, so we have cantonal banks, which are the smaller banks. We have also larger banks in Switzerland. They already offer crypto. And they look into solutions where they have very low integration costs, but where they can leverage their existing current solutions, let's say e-banking solutions, SWIFT solutions, but also their core banking system where you can just integrate, add crypto, and then start trading and maybe custody or sub-custody as they are currently doing in the traditional asset space. So that's what we are seeing at the moment.
Integrations, low cost. You want to make sure you're keeping your old traditional system, but able to integrate easily with other players that are going to enable and enhance that. All right, so that's interesting.
Yeah,
and before
and also we do. Sorry.
Go ahead.
And what we also see that it's going more away from use cases. So we see a lot of adoption that banks are starting to look at the ecosystem and not anymore looking into, oh, we have a client, he has a use case, maybe we do a project or a POC. So they're moving more and more into what kind of ecosystem do I need to build, which benefits me, maybe also other stakeholders, or also like crypto providers or crypto companies which offers access to the digital asset space.
Understood. All right, and Timo, how's it look on your side?
Yeah, I would agree that the integration side, I think maybe almost like turning that around. So we kind of experienced that it's really important to be able to integrate and adapt to like whoever, you know, the institutional clients' processes and like their however they want to build and deliver their services, that we can fit into that. So I find that that's like a very common requirement, and that's obviously, you know, once you're over and above all the usual kind of checkpoint items that you would have to support regardless, right? So I think that's like one thing. And then obviously account structuring always gets a little bit more complicated when you're dealing with institutional clients and so forth. So I think we've seen that like we're yeah, on that side, we tend to, it becomes a little bit of like a project every time, because like, you know, I mean, for example, we have this one client that came out of the US that's doing wrapping, and they have a very particular way that we need to integrate with them in order to support their product on the other side. So, so yeah, I think that integration side, and I agree with you, Stefan, they want to keep it at a minimum from a, you know, especially when it comes from the banking side of things, because that's such a, you know, time consuming and slow process if you need to adapt IT systems. But then also on our side, we see that we're pretty nimble and a small organization. So we're, you know, for us, it's relatively easy to almost like, you know, plug some of the gaps from our side and then make it work basically.
Understood. So you guys are both helping enhance some of these processes. You're working with integrations. Obviously, some of these are a little bit more custom than others based on what the bank needs. But I also wanted to ask, you know, are there any specific requirements in terms of licenses or anything specific that you guys have that you really get to leverage to be able to enable some of these institutions to be able to go to the next step here?
Yes, I think on our side, I mean, I think the German, you know, the BaFin-based crypto custody license, as well as the transactional licenses, I think that's a critical component as to why, you know, some of our clients have chosen us. I think it's like the passportability across the EU that it provides over time, but also it's interesting that German was so early. Like, I mean, we all heard about like the MiCA framework being developed, but they were like super early on, you know, basically going out there and saying like, oh, digital assets are regarded as financial instruments, and therefore any activity related to them should be a regulated activity if it's being performed out of Germany. So they were really clear early on in terms of like how they wanted to handle this. And I think that's helped a lot. That clarity has actually been quite helpful once you obviously, you know, comply with everything. And it's been, you know, quite a long process to get to that point. But, you know, basically once you're there, then I think it actually helps in acquiring the right type of clients as well.
Yeah, we definitely seen news come out of Germany early on as well. You know, as you know, we track a lot of that news for our show and whatnot. Yeah, Germany's definitely made those headlines and has really been a forward thinker in terms of the clarity of regulation and having those licenses available. So Swarm, great for you guys. How about crypto finance, Stefan? You know, what's it look like in Switzerland, FINMA? You know, what's going on your end?
So Switzerland has very advanced regulation, and FINMA already started early with the DLT law. And that's why we also see a lot of banks coming to Switzerland, also with their subsidiaries to run POCs, but also to start a small crypto offering with their, let's say, subsidiaries or daughter companies in Switzerland. So there we see a lot of movement. Also, that law gives the investors some comfort. Also, it's kind of FINMA is also working towards the staking topic, but also looking into other topics. And we see that a lot of banks in the EU area, like the Germany and the other EU states, countries, a lot of banks in those areas, they look and wait until MiCA is in place. And we were also at Cybos in Toronto, and we had a lot of discussions with a lot of international banks all over the world, but also within Europe. And really, Mika is coming, but until Mika arrives, a lot of banks are waiting on the sideline until they can start. And we also see that the BaFin is a bit more careful after what happened after FTX. So they really want to understand what's behind the scenes, which also slows down the approval process. And we really hope that Mika brings a bit more speed into the game, and that the banks can speed up their game as well. That's crypto really starts to move again in all over Europe. I think that's a good thing. And also the passporting topic is very cool, that when you have a license within Europe, within the risk jurisdictions, then that you can passport it as well to other countries. So it's very interesting, but I think we still need to see how the countries react on that.
100%. Yeah. And look, the banks they always have compliance departments that rightfully so, are definitely eager to make sure that, we're being compliant here. We're taking the right steps to either have a proof of concept or to understand how this technology works and have the licenses or partner with someone that has the licenses to move this forward, and not have the SEC or whoever our respective regulatory bodies are knocking on our door. From the US perspective, I'll give a couple of points on the security token or the tokenized security side, and then your crypto side. But essentially, to have things custodied here, we prefer to use what we call a qualified custodian, right? These are entities that have a certain level of license to be able to, custody these. And it could be because of, things that they make check off on a box, a specific license, infrastructure itself. Right. So like, for example, a bank could be a qualified custodian. But we also have special purpose broker dealers that have certain, exceptions and are allowed to do some things with digital assets. You've seen that come out with Prometheum. You've seen it come out with a couple others. But a step above that, even we have the charter banks. These are, I believe there are only 3 chartered banks that are considered national banks, right? To be able to specifically hold and custody digital assets, those being Paxos, Cortego, and Anchorage. So those are the 3 main ones here in the US. But now from crypto side, in terms of, custodying crypto and having it on your balance sheet, it's something that the banks are not able to do necessarily. And I'll give a point on the crypto side, and again, on the security token, when it comes to digital assets, you can't custody them directly. You have to go to one of these partner ones. For example, US Bank, we know they use NYDIG as a sub-custodian. Stefan, you touched on sub-custody earlier, right? So essentially a partner that will do this for you. The idea being that you cannot have it on your own balance sheet. Why? Because about a year ago, the SEC came out with a bulletin called 121, essentially saying, hey, if you're going to have something such as a digital asset on your balance sheet, you have your assets and liabilities. You'll have it on your liabilities as, call it Bitcoin, for example. Hey, we have this much Bitcoin. You cannot have it in the same Bitcoin terms on your asset side. And so that creates, an imbalance. And they did not necessarily provide clarity into how do we account for these? How do we appropriately do this? So that's something that the banks right now are struggling with. They've talked to, multiple consultants. I just had a conversation a month ago with Deloitte here in Chicago, or when I was in Chicago visiting. And same thing, they still don't know a year later how to advise these banks on what next steps are. So in terms of regulation, I think that, some of the other countries are actually a little bit more advanced in terms of clarity, what you can and cannot do, licenses you can have, and what next steps forward look like. But did want to shine a little bit of light onto what the US looks like. So we have the qualified custodians based on licenses, based on, what they have going. And then you have the opposite end with crypto in terms of, where you can and cannot custody that for your balance sheet. We are about to come up on time though. So I do want to take the time to, give you guys an opportunity to tell us about any exciting assets that you guys see being tokenized, whether it's yourselves or your clients. And what advantages you guys have for institutions that they'll be able to leverage, and why should they be working with each of you?
Okay, I think, if I kick off there, I think we're obviously super excited about the real world asset stuff that we built with the tokenized bond ETFs and the stocks. we think that the ability to handle both crypto as well as tokenized assets, real world assets, we think that's critical going forward, because as we build more and more bridges between TradFi and DeFi, we think that like in the end, once everything gets digitized, someday, right? And then you kind of need to be able to support pretty much everything and all types of assets. So I think that's a critical component to build towards. Not to say that we're anywhere close to that yet, but it's directionally, it's something that we're, trying to provide a unique value proposition around, so that you can start constructing portfolios that are basically cross DeFi and TradFi, and then kind of move seamlessly between those two worlds. So I think that's critical, and we're excited about that. And then there's some more things like on the regulatory arbitrage side that we're really excited about. Like, for example, this customer of ours called Wrap.com that's doing a bunch of crypto asset bridging across different blockchains. They basically decided to run that operation out of their European company, where we are basically the custody provider for that service. And they just didn't feel like it was clear enough as to what they could or couldn't do in the US. So they decided to move it elsewhere. And that was just like one out of many examples of, in this case, a live client that we have, but also a lot of conversations that we've had with US-based companies that have basically looked for a jurisdiction that is, number one, credible and provides the trust, the trust structure that Stefan mentioned, but also, allows us to operate the types of, services that they need. So I think that is like the regulatory arbitrage combined with like actually building more and more bridges between TradFi and DeFi. That's our mission and our path.
Very interesting. Yeah, we've heard of some companies considering moving overseas or having subsidiaries overseas to again test some of these things out. Stefan, how about yourself?
I would say I totally agree with Timo. As I come from the traditional finance, so I also tried to make the bridge between traditional finance and digital assets, and I think the first thing is for the end investor, it needs to become more easy to access crypto. Let's say to open a wallet, to maybe store the 12 keywords to access the own wallet again. Public private keys access. I think this needs to become more simple, and then I would say then it's very open. So we can have stocks, we can have bonds, we can have funds, we can securitize or tokenize real world assets like art, which can come more potentially like soccer players, for example. I think what also is like real estate could be a very interesting topic, where you can, in between finance, so you buy a real estate, you tokenize real estate because you need money to build or renovate the building. So I think there are a lot of use cases also with the hedge funds, where you go through the transfer agents, which maybe you still send fax statements around in the fund industry. So I think there are a lot of use cases which can get automated. We can improve the process with the blockchain. And also I think when we see the case with Credit Suisse and UBS in Switzerland, so where investors withdraw their cash or securities or transfer them out. So I think when you see that your assets are secure and segregated in a wallet within the custodian, you have access to that wallet, for example, from the outside through a sophisticated system the custodian provides. So you really see that your assets are secure and safe, which also gives a benefit and also then circles back to the trust. I think there are a lot of use cases, but I think in general the crypto industry is still young, needs to evolve and mature, and the access for the normal investor needs to get more simple in the future. And I think we should work towards that. Then I think the people get more used to it, and then they feel like, oh, I want to explore more, and I want to buy a piece of whatever token-based asset, for example.
Got it. All righty. So it all comes full circle, right? We're looking at, how do we best safeguard these assets? How do we, bring trust to the Web3 world, right? And to investors, knowing that you guys can interact with each other, both TradFi and DeFi, and bridging those gaps, as well as for the institutions, providing some tools for them to be able to participate as well. But keeping in mind, we want to be as compliant as possible. And of course, that does come with stipulations based on jurisdiction, where we're based on what kinds of assets we're working with, etc. All righty. Well, thank you both for your time and your insights and for sharing them with our audience here. For the audience, we'll see you in the closing remarks, which will be the next session. Thank you all. Have a great day.
Thanks, Jason.
Thank you, Jason. Bye-bye.
Bye.
Acquisition to Red Swan to Fusion IQ, Invest Ready, Invenium, everybody that made this summit possible. Again, thank you so much. I believe with the live stream, we've had over 1,000 people tune in already, folks. I think this might be the largest, at least online congregation of people focusing on tokenization. And man, even I learned some stuff. I love to see it. A huge shout out. I'm going to do a quick summary of just everything we're seeing institutionally, just in case you didn't get to stay with us the whole day, though. Again, I checked the quick stats and I saw that over 36 of you joined us for the full day out of hundreds who are on the Zoom platform. And again, hundreds more via the live stream. Absolutely incredible. I'm just blown away, but I hope we all took away some major institutional use cases from today. I want to give a shout out to Peter for doing such a great job today, but he earns his title as the head of institution and the head of research because he is so plugged in, and he already identified long ago in 2022 that 2023 was going to be the year of institutions. And I think that's so much the case. It's so clear after today. We're seeing back office automation. The idea that we can now scale our back end without necessarily having to add more humans to the equation. That's a major trend that every single bank, asset manager, financial institution is looking at to save money. And speaking of saving money, it comes down to bips, folks. Basis points matter when it comes to scale. We're seeing that in the repo markets. We're seeing that in collateralization. We're seeing that across the board, that these savings, again, they add up to millions of dollars when you apply that to scale. But part of that reason is also clearly due to the instant settlement. This is one of those beautiful capabilities that the blockchain brings to the table, the atomic swaps, the instant settlement that we can derive from this is going to change the face of finance and the way we transact, the way consumers participate, the way institutions are managing their assets. Everything will change because near instantaneous results for collateralization, for trading, for settlement, for everything will become the norm, folks. So we better learn how to get used to those new capabilities. Access and distribution clearly are another one of those opportunities. There are new channels being formed where no longer are we going to rely on the traditional intermediaries that run the distribution side of things in Wall Street. Now we're going to see companies like WisdomTree and many others build their own channels, their own capabilities to manage the process, manage the user, manage the investor, and give them a whole host of new capabilities, not just the opportunity to invest in something good, but to take advantage of financial services as we discussed it. Which gets into the building blocks, folks. We're clearly still seeing the inevitable infrastructure being built that will power the future of finance. We're talking about tokenizing bank deposits, the stable coin game, of course, now with the rise of treasury bills and similar money market products. This is going to change the way we manage finance once again, which is going down even into the alternatives markets. We're seeing, of course, HELOCs, we're seeing ABSs, we're seeing private credit, real estate, commercial real estate. The whole thing is getting upended thanks to the advantages that I just mentioned that were never before seen in the alternatives market. So I don't know about you, but I'm hyped. I'm super excited. I already know, especially after today, that 2024 is going to be finally the year of tokenization. People have been shouting that year after year since 2018 when we first embarked on this industry. But I truly believe and know that next year is the year that no longer becomes a question of when. It's already happening. I even garner to think that there could well be $1 trillion crossing next year in the tokenized markets industry in terms of size. Now, we also know that the future isn't going to be driven by tokenization first, as in the apps, the technology that powers the blockchain in the background to enable adoption and to enable acquisition of customers and investors without teaching them about keys and wallets and everything else in order to make it work for the end value proposition. And that means we're going to see all those trillions move faster. It's an absolutely exciting time to be here. I think PDFs and spreadsheets, they're dead, folks. We are clearly seeing that that's not going to be a viable solution to scale the future rails of finance, which is why all of the institutions and the banks, they're looking at this as that alternative, that new evolution in order to grow and scale. So join us for one more day on day 3 tomorrow, where we'll be getting into the weeds of actually tokenizing. We're going to be doing a bit of a workshop style. We'll have AMAs, we'll have some special guests, but you'll be hearing it from the team exactly how we help our clients and how you too can start tokenizing. And with that, I hope you all have a wonderful day. Happy tokenizing, and we'll